Hello friends, today we are going to start with reading security market indexes. So now let's have a broad understanding of what we are going to learn in this chapter. Okay, so now in the chapter cost of capital, we learn that to compute KE as per CAPM model, formula is RF plus beta RM minus RF, where RF is equal to risk-free rate in economy, B stands for beta, and RM is equal to return on Indian equity market. Now my question is how to compute the return that Indian equity market has delivered, or the question is, now let us assume that you want to invest into banking stocks. I want to compute the return what banking stocks has delivered historically. Now all these returns are computed with the help of indexes. So now what do you mean by index? Okay, so now in India there are two stock exchanges main. One is NSE, that is National Stock Exchange, and second one is BSE, that is Bombay Stock Exchange. On NSE, approximately 1600 companies are listed, and BSE approximate 5000 companies. Now one way to compute the return that Indian equity market has delivered, this is to compute the return of entire the 1600 companies, or the second way is with the help of sample you have to make comment about the entire population set, and now that sample is known as, in case of NSE, that sample is known as Nifty 50. Now Nifty 50 is an example of index. It is an index. Now this index is in totality having how many companies? So it is a group of portfolio of 50 companies, and these 50 companies are in a way representing entire stock market. Now what do you mean by indexes? So indexes are prepared to compute the performance of an asset class. So now what return that Indian equity market has delivered, that is computed with the help of indexes. Same wise, if I want to talk about the segment of equity market. Now within equity market, following are the segments. For example, banking sector is there, auto sector, pharma sector. Now I want to compute the return of these sector. So this is going to be computed with the help of sectorial indexes. Sectorial indexes such as Nifty Bank, Nifty Auto, Nifty Pharma. Okay, so now let's go through the notes. What do you mean by security indexes? So a security index is used to represent the performance of an asset class. What is the meaning of asset class? Asset class means to compute the performance of equity market, debt market, real estate market, commodity market. So these are known as asset class, to compute the performance of an asset class, security market, or segment of the market. What is the meaning of segment? Here I am talking about sectorial indexes. Nifty Bank, Nifty Auto, Nifty Pharma. Now the question is how they are created. They are created as portfolio of individual securities. So now in case of Nifty 50, it is a group of top 50 companies. Now my point is, okay, I understand that if I want to compute the performance of Indian equity market, this is going to be with the help of Nifty 50. Now this index is known as broad market index. Broad market means they are representing entire stock market. broad market index, group of 50 companies, and these 50 companies in a way representing entire stock market. Now my point is, it is a group of top 50 companies in your country. Now top in what sense? Top as per market cap, top as per the size of the number of employees, top as per profitability, sales. Now top in what sense? So now maybe majority of you answering that these are the top 50 companies in the country as per market cap. Okay, but the answer is incorrect. Okay, now let us assume that if market cap is the correct answer. Okay, so now let us assume that in Nifty 50 there are only two companies, company A, company B. Now what is the meaning of market cap? This is number of outstanding shares multiplied by current market price. Now let's assume that company A is having 10 outstanding shares, B 10, current market price of A is 10, A is 100, B is 10. So what is the market cap? Now market cap of A is 1000, B is 100. So we can say that Nifty is 1100 points. Okay. Now after 1 year, let us assume that, now I'm giving you a scenario. After 1 year, assume that A doubles and B remains constant. So if A doubles, market cap is going to be 2000, B market cap is 100. Now Nifty is 2100 points. Scenario 1 where A doubles. Scenario 2 where B doubles, A remain constant. Now if B doubles, the market cap of B is going to be 200, market cap of A is going to be 1000, and now Nifty is 1200 points. Now my point is, if company A doubles, then Nifty has delivered a return of 1000 points over the capital of 1100, so approximately 90%. And if B doubles, then Nifty has delivered a return of 100 upon 1100, approximately 9%. Now my question is, if company A doubles, then Nifty has delivered a return of 90%. If B doubles, Nifty has delivered a return of 9%. Why? So now the answer is, sir, look very carefully. In this 1100, A is having more weight. That is why when A doubles, market has delivered a return equal to 90, and when B doubles, market delivered a return equal to 9%. That means in this particular scenario, you have allotted the weight as per market cap. Okay, and since A is having more weight, so the moment A doubles, it is going to have more impact over the Nifty. Okay, now one way to allocate the weight is, so now in totality there are going to be four ways. Okay, so now one way is to allocate the weights is using market cap. Okay, and now if Nifty is on the basis of market cap, then which is the company, which company is having the highest market cap in the country? So the number one company is Reliance Industries Limited, followed by TCS, then HDFC Bank, and on fourth spot it's Hindustan Unilever Limited. So these are the top 4 companies as per the market cap in the country. And if in the Nifty weights are as per the market cap, then Reliance should have the highest weight, followed by TCS, followed by HDFC, followed by Unilever. Okay, so now I have downloaded one fact sheet with respect to Nifty. Let's go through that. So now this is our fact sheet dated 26 Feb 2021. Okay, now it is with respect to Nifty, and in Nifty the top constituents by weightage. So which security is having the more weight? It is Reliance. But on the second spot, it's not TCS, it's HDFC, Infosys, and so on. Now my point is, if it is as per the market cap, then ideally Reliance should have the highest weight, followed by TCS, followed by HDFC, followed by Unilever. But this is not the case. That means in Nifty, weights are not as per the market cap. Okay, now question arises, if it is not market cap, then and why not market cap? Now my point is, one of the purposes of creating the index is, number one of the purpose to create the index is to compute the performance of the market. So this is one of the objective. Compute the performance of Indian equity market. Second is to benchmark the performance, and third purpose is benchmark the performance of your portfolio manager, and third purpose is replicating means repeating, creating a portfolio equal to Nifty. Now replicating Nifty 50 is possible. Now hypothetically assume that this company A is nothing but Reliance. Okay, and out of 10 outstanding shares, just using a hypothetical number, okay, out of this 10 outstanding shares, let us assume that 100% is owned by Mukesh Ambani. Okay, he is the promoter of the company. And now my point is, there are two types of investor, one promoter and one public. Promoter, public. Now Mukesh Ambani ji will keep on selling the shares of Reliance on regular basis. So daily he wakes up, he purchases the share, he sells the shares. He is going to do the trading on Reliance on regular basis? Answer is no. Now promoters on regular basis does not buy and sell the shares. That means in the market, which shares are available for trading? Only those shares which are with the public. Now my point is, hypothetically assume that Reliance, in the case of Reliance, 100% share is held by Mukesh Ambani ji. And now I instruct my portfolio manager that invest my money in Nifty 50. And if accidentally tomorrow Reliance doubles, then you want a return of 90%. Now, if you want a return of 90%, ideally Reliance should be available in the market to buy. That means replicating would be difficult if 100% share is with Mukesh Ambani. Or benchmarking, it will create a question mark over the benchmarking. Now my portfolio manager will not be able to give this much return. So now benchmarking will become difficult. So hence, the weights are not as per the market cap. The weights are in accordance with market cap adjusted for free float. Now what is the meaning of market cap? Market cap adjusted for free float. Now free float means, first you have to compute the market cap of the company. Suppose this is 100 and 20. Now you have to divide this into two parts. Percentage holding with promoters. Now let us assume that with the promoters are having 30% in this company and 60% in company B. Now how much would the public? So this is going to be 70%, 1 minus 30, this is going to be 40. Now market cap adjusted for free float. Now this is equal to, sorry, assume that this is the market cap, sorry. Now this is equal to 100 multiplied by 70%, that is 70. 20 multiplied by 40%, that is equal to 8. So now Nifty is created on the basis of market cap adjusted for free float. So earlier, prior to 2009, Nifty weights was in accordance with market cap, but eventually from 2009, because it becomes difficult to replicate it, now post 2009 they have been shifted to from market cap to market cap adjusted for free float. Now again, let's go through that document. Nifty 50. Nifty 50 is a well diversified 50 companies representing overall market condition in your country. That means it is an example of broad market index. It is computed using free float market capitalization method. It can be used for a variety of purposes such as benchmarking fund portfolio, launching of ETFs. Now let's understand what is the meaning of ETFs. Launching of ETFs. That means one of the purpose of index is to help in launching new product, and that new product is ETFs. So the full form of ETFs is exchange traded funds. So this we eventually cover in portfolio as well. Okay, now ETFs. So first they are going to be traded over stock exchange. So they are traded on stock exchange. ETFs, they are tradable on stock exchange. Second, what is the meaning of ETFs? They are known as passive funds. Now passive funds means they are going to replicate some index. Now for example, there is a ETF by the name SBI ETF Nifty 50. Now what is the meaning of this? So first, the name is SBI. That means this fund is managed by SBI Mutual Fund Company. SBI Mutual Fund Company. Nifty 50 means which index it is going to replicate. It is replicating Nifty 50. And meaning of ETF is, that means it is traded over the stock exchange. Now if I go to money control, I type here SBI ETF Nifty 50. Now that means it is managed by the company SBI Mutual Fund. It is replicating Nifty 50, and to buy 1 unit, how much money you have to invest? That is 155.25. Now my point is, with the help of 155.25, you are buying 1 stock or 50 stocks. So now with the help of this 155.25, in a way you are buying 50 stocks. That means what are the purpose of indexes? One, to compute the performance. Second, to benchmark the performance of your portfolio manager. And third, to create new investment products such as ETF. And to create ETFs, one of the necessity is that you should be in a position to replicate. And to make this replication easy, earlier the weights was in accordance with market cap, and later on they shifted to market cap adjusted for free float, where the meaning of free float is that means you have to make an adjustment for holding only with the public. Why only with the public? Because this is the only quantity which is available for buy and sell, so it is only promoting the liquidity in the market, so hence it should be in accordance with market cap adjusted for free float. Okay, now there are two other methods as well to give the weights. The third method is in accordance with price, and fourth one is equal weighted. Now let's go to the notes once. My LOS 1. What do you mean by security market indexes? A security market index is used to represent the performance of an asset class, security market, or a segment of a market. They are created as the portfolio of individual securities, which are known as constituent securities of the index. Now, how many weight methods there are going to be? 1. Price weighted, equal weighted, market cap. Point to be noted, market cap is also known as value weighted. And fourth one is market cap adjusted for free float. Okay. Now, before I jump to the question part, on each of them, now the next important point is to compute the return. Now, return can be of two types. One, price return. Second, total return. Now, example, I purchase a stock of Reliance at time 0 when Reliance is trading at 100 rupee. By the end of year 1, Reliance value is 120. Now, point is how much percentage I have gained, what is my return? So return is equal to 20%. Now, while computing this 20%, you are only considering the capital appreciation part. Price return. Price return means only capital appreciation to be considered. But now, when we invest in a stock or when we invest in a debt security, we receive dividends or interest. Now, let us assume that I receive a dividend of 20 rupee. So in totality, what is my gain? My gain is 40%. Now this 40% is known as total gain return. So total return means capital appreciation plus dividend. Now it will be specifically mentioned in the question whether you have to consider price or total return. If it is given price, then only capital appreciation is important. If you have to compute total return, then capital appreciation plus dividend is important. Okay, now let's solve one question, how to compute the returns. Question number Question number 9. An analyst has gathered the following information. Now, weight is as per market cap weighted method, comprising of following 3 securities. You have to compute price return. So, question number 9. Particulars. So, security is M, that is then Q and X. Now, price return. So price return means I have to ignore the dividend component. Shares outstanding 5,000, 7,500 and 10,000. Now beginning price P0. Beginning price is 2,500, 3,500 and 1,500. So now market cap at time 0. So now this I'm going to compute in thousands. Okay. So 5 multiplied by 2,500. This is 12,000 500. This is 26250. And last one is 15,000. Now submission is 53,750. Now this is an index. We have created one index where the weights are in accordance with market cap. Now assume that in totality we invested 53,750, out of which 12,500 in M, 26,250 in Q, and 15,000 in X. So the weights are as per the market cap. Now end of period prices, that is P1, is 2,700, 2,500 and 1,600. So now you have to compute value, market cap at the time 1, again in thousands. So 2,700 multiplied by 5,000 divided by this. So this is 13,500. $18,750. And this is 16,000. If I sum up 16 plus 18,750 plus 13500, now it turned into 48,250. Now this is an index where the weights are as per the market cap. At beginning of the period you have invested 53,000. By the end of year 1 it turned into 48,250. You have to compute your price return. So price return that index has delivered is equal to 48,250 divided by 53,750 minus 1. So answer is negative 10.23%. So what is the return that Nifty has delivered by the end of year 1? So delivered a return of negative 10.23%. Answer is B. Now question number 10. So 10 is identical to 9. The only difference is you have to compute total return. Now while computing total return, you have to include dividend as well. So now I'm solving question number 10. So now in question number 10 everything is same. Now market cap P0, so this we have already computed. This is equal to 53,750, and now market cap or market value of your investment at the end of period 1. Now you have to consider total return. Total return means 2,700 is the price and 100 rupees dividend you have received. Now what is the total value? 2,800. 2,800 multiplied by 5,000 shares. So this is 14. Second one, 2,500 plus 150 multiplied by 7,500. 19,875. Then 1,600 plus 100, that is 1,700 multiplied by 10,000 divided by 1,000. So answer is 17,000. So if I sum up, total return this is 50,875. Now you have to compute total return. Total return that index has delivered, that is 50875 divided by 53750 minus 1, that is negative 5.34%. Answer is B. So answer to question number 9 is B. Answer to question number 10 is B. Now point to be noted. Point to be noted. Number 1, total return is always greater than equal to price return. Now when they will be equal, if it is a zero, if we have not received any sort of dividend, then price and total return would be equal. And by default, if there is a dividend paying stock, then always total return is going to be greater. Now in question number 9, your return was negative 10.23. That negative 10.23 has been reduced to 5.34. So total return would always be greater than price return in case of dividend paying stock, and both of them will be equal if stock is paying 0 dividends. Okay, so now point to be noted. Number 1, total return to be greater than price return in case of dividend paying stocks. In case of dividend paying stocks. Second, total return is equal to price return if no dividend received. Double star point. And point number 3, again a double star. Total return equal to price return. Total return equal to price return in case of dividend paying stock only at inception. That means only at starting point, only at the starting point, your total and price return is same. Now once you have received the dividends, you keep on receiving the dividends, total and price return will differ. Okay, so 3 points. Total return to be greater than price return in case of dividend paying stocks, equal if no dividend is received. Total return is equal to price return in case of dividend paying stock only at starting point. Now at time 0, till the time you are not receiving any dividend, both of them are going to be equal. Once you have started receiving dividends, total and price return will differ. So now we have solved one example based upon market cap. Okay, so one method was market cap. Now second method to give weights. Now second method to create a portfolio, to create an index, is based upon equal weight. Okay, now before we jump to this one, so we have covered one practical example of market cap or market cap adjusted for free float. So in practical life, there is one index, that is Nifty 50, where Nifty 50 weights are in accordance with free float market cap. Now second one is equal weight. Equal weight means we assume that we have invested equal amount in each security. Now sir, do such kinds of index exist? Answer is yes. Now if I go to the website Nifty indices, now index, first broad base. So broad base we have covered Nifty 50. Then there are sectorial indexes. And third, and if I go to the fourth one, that is strategy indexes. Now one of the index is Nifty 100 equal weight. Now what is the meaning of Nifty 100 equal weight? First, there are going to be 100 securities in this index. And now what would be the weight of each security? Now weight of each is going to be 1%. Now why 1%? Because we have assumed that we are going to invest equal amount in this 100 shares. So now the another method to give the weight is equal weight. Practical example, Nifty 100 equal weight. Now I'm going to invest equal amount in each security. Now let us assume that. So let's solve an example. Now question number 14. So now you have to compute the return. It is an equal weighted index. So question number 14. Alternative 1, not recommended. Alternative 1, not recommended. Now there are how many securities? Security A, B, C. Now you are creating a portfolio, okay, where price at the beginning of the period is 20, 50, 26, and prices at the end of period 1 is 22, 48 and 30. Now I want to invest an amount, and that amount is an equal amount. So let us assume that at the beginning of the period, amount invested in each stock. Now assume that amount to be 20 multiplied by 50 multiplied by 26. So 20 multiplied by 50 multiplied by 26. So answer is 26,000. Assume that in each stock we invested 26,000. 26,000, 26,000, 26,000. So how much we have invested in totality? We invested in totality 78,000. Okay, so beginning of period amount invested 78,000. So now with the help of this much, how much share you have purchased of each security? Now shares purchase. Now 26,000 you have invested. Price is 20 rupees per share. How many shares you have purchased? Divide by 20, that is 1300. Then 26,000 divide by 50, 520. And third one is 1,000. So these much shares we have assumed that we have purchased. Now prices at the end of period 1 are 22, 48, 30. Now value of your investment. Value of investment at end of period. So this is 1300 multiplied by 22, 28,600, 48 multiplied by 520, this is 24,960, and final is 30,000. So value of your investment is 83,560. Now you have to compute price return. So price return of a equal weighted index is equal to 83560 divided by 78,000 minus 1 equal to, answer is 7.12%. So question number 14, answer is C. But this we have solved using alternative 1, which is a time consuming process. So I won't recommend alternative 1. Now I'm going to get the same answer using alternative 2. Now alternative 2, how to get the same answer? If it is an equal weight, recommended to be used in examination because it's easy. Okay, now particulars A, B, C. Now prices at time at the beginning of the period, that is 20, 50, 26. Prices at the end of the period, 22, 48 and 30. Now you have to compute percentage change in prices. So if it is a price return, consider only the prices. If it is a total, consider along with dividend. Okay, total return. Now percentage change in prices for each security. Now 20 becomes 22. So a return of 2 divided by 20, that is 10%. Then 48 divided by 50 minus 1, negative 4%. And 30 divided by 26 minus 1, that is 15.38%. Now simply you have to take average. Now if I take an average, that is 15.38 plus 10 minus 4, that is summation is 21.38 divided by 3, answer is 7.12%. Now if it is an equal weight, then how we can compute the answer? Simple, compute the percentage change for every security and take up the average. This is going to be the price return. This is going to be the return in case of equal weight. Now indexes are, now the weights can be based upon market cap, free float or equal weights. What is the meaning of equal weight? Meaning of equal weight is that we have invested an equal amount in each security. One way is assume some amount and then compute the return, or second, the simpler manner is compute the percentage change and take up the average. Answer is 7.12. Now let's solve one more question on equal weight, where you have to compute the total return. Now question number 7, you have to compute. Okay, let's solve 6 and 7 together. Okay, so equal weighted, you have to compute price return. Question number 6. So securities A, B, C, price at the beginning is 10, 20, 30. Prices at the end 12, 19, 30. First you have to compute percentage change and then takes up the average. This is going to be the price return. So 12 divided by 10 minus 1, 20%. 19 divided by 20 minus 1, that is negative 5%. This is 0%. Summation is 15. 15 divided by 3, So average is 5%. Answer is B. Question number 7. You have to compute total return. Now while computing total return, in the end of period prices include dividend as well. So question number 7. P1 plus dividend, that is 12.75. Next one is 20 and 32 percentage change. 12.75 divided by 10 minus 1, 27.5. 20 0. 32 divided by 20 divide by 30 minus 1, 6.67. Now if you take up the average, average is 11.39%. So answer to question number 7 is C. So class, now how to compute the weights? One method is equal weight, second method is as per the market cap, and third one is market cap adjusted for free float. Now I'm going to discuss one more method. That one more method is now price weighted. Price weighted means we are going to invest the money. We are going to invest the money in accordance with price. For example, there are two stocks, A, B. Now A, B, let us assume that the prices are 10, 20. Now I'm going to assume that in totality I'm going to invest 30 rupees. Out of that 30, 10 would be invested in A and 20 would be invested in B. So 30. Now by the end of year 1, assume that the prices is 12 and 22. How much you are having in your pocket? That is 34. Now what is the price return of price weighted method? So price return is equal to 34 divided by 30 minus 1. 34 divided by 30 minus 1. Answer is 13.33. Now price weighted. Price weighted means we are going to buy one share of each company. That means in a way we are investing in the ratio 10:20. 30 rupees out of 30, 10 invested in A, 20 invested in B. It turned into 34. How much return we have earned? That is 13.33. But now how institute solve this question is, in case of price weighted, they compute value of index. So value of index they compute at time 0, and then they compute value of index at time 1, and then they compute the answer of price return. So now question is, so what do you mean by value? So now if in question specifically given a value, then you have to compute value. Okay, now how to compute value? What do you mean by value? Now in totality we assume that you have invested, this is your total investment, 34. Now the meaning of value is how much invested on an average in each stock. So value at time 0. Now value at time 0 is 30 divided by 2, that is 15. Value at time 1 is equal to 34 divided by 2, that is 17. Now what is the price return? 17 divided by 15 minus 1 equal to 13.33. Now point to be noted, if it is specifically given what is the value of the index at time 1, then the value of index is total investment divided by number of constituents in the portfolio. Now in my case the number of securities are 2, so 34 divided by 2, 30 divided by 2. And now how you can compute the return? So value is 15, 17. Now what is the return? 17 divided by 15 minus 1. So answer is 13.33. So now let's solve one question on price weighted as well. Question number 8, price weighted, and you have to compute price return. So I'm going to ignore the dividend component. Question number 8. Price weighted means we are going to purchase one share of each company. P0. This is A, D and G. 25, 35, 15. Total investment. We assume that we invested 75 rupees. Now you have to compute value. Value is 75 divided by 3, that is 25. Now P1 prices is 27, 25, 16. Investment turned into 27 plus 25 plus 16. This is 68. Now value is equal to 22.67. Now you have to compute price return. So price return is either 68 upon 75 minus 1 or 22.67 divided by 25 minus 1. So answer would be same in both the cases. Answer is negative 9.33%. Okay. So class, what is the answer for 8th? Answer for 8th is B. But in question, if it is specifically given what is the value at the beginning or at the end, then values are going to be 25 and 22.67. So now let's conclude. What do you mean by indexes? So indexes are used to compute the performance of an asset class or market segment. Then how they are constructed as portfolio of securities, and these portfolio of securities, these individual securities are known as constituents. Then in totality we can allot the weights in 4 ways: market cap, free float, market cap, free float, total, price weighted and equal weighted, where the meaning of market cap is we are going to invest in the ratio, in the weights as per the market, where the meaning of market cap adjusted for free float is we are going to compute revised market cap, where we are going to multiply market cap with the public holding, and then we are going to invest in this particular ratio. Third, equal weight means we are going to invest equal amount in all the securities. And fourth one is price weighted. We are going to invest in accordance with the prices. That means the assumption is I'm going to hold a single share of each company in the index. Now you can compute 2 returns. One is known as price, one is known as total. If you want to compute only the capital appreciation part, price return. If you want to compute the return, total return inclusive of dividend or interest, then that return is known as the total one. Okay, so now we have covered LOS 1, LOS 2, and in LOS 3 and in LOS 4 there are 4 methods, that is price weighted, equal weighted, market cap, which is also known as value weighted, and market cap adjusted for free float. Now I'm coming to my LOS 3. Now what are the choices that you have to make while creating an index? Now first is to decide the target market. That means now if you are creating an index, what this target market is going to compute. So now let us assume Nifty 50. We want to create a broad market index which in a way is representing the entire Indian stock market. So target market is, now what that index is going to compute. So first decision rule, double star, is to decide the target market. And now in my case, I want to create an index which represent the return of entire Indian equity market. So this is my target. This I want to compute. Okay. Now second, which securities from the target market to include? So in case of Nifty 50, top 50 companies as per free float market cap. Third question. No, so top 50 companies. Okay. Third, the appropriate weight method. So weight is going to be as per free float market cap. Now question number 4th and 5th. How frequently to rebalance and reconstitution is required? Now 2 important words. One word is rebalancing and second word is reconstitution. Okay, now important. Now I understand that Nifty is a group of top 50 companies as per free float market cap. Now my point is, in simple ways, it is a group of top 50 students. Now my point is, these top 50 companies will keep on changing on regular basis. Now for example, once there's a company Yes Bank. So Yes Bank was performing really well. Now if I talk about 3-4 years ago, so this bank was performing really well, and then there are some corporate governance issues, and eventually it led to the downfall of the bank. Now it is no more. Now it is not no more in the top 50 companies in the country. Same wise, there is a company which is performing really well over the years, that is Britannia. Now my point is, these 50 companies will keep on changing on regular basis. Now we are going to include and exclude the securities in this? So the answer is yes. This concept is known as reconstitution. Now what is the meaning of reconstitution? Adding new securities and excluding the earlier ones. Now in Nifty, now Yes Bank is no more a bigger company. There is a corporate governance issues. The bank is led to the downfall of the bank. Now it is no more a bigger company. Now we are going to exclude this. And now we are going to include new companies which are performing better in the Nifty 50. This concept is known as reconstitution. Now when reconstitution happens, so now it works. Now NSE says we are going to compute, so this is the 6 months period. Okay, now let us assume that this period starts from 1st Feb and end on 31st July. So this is the period, and during this period we are going to compute average free float market cap of the companies. So we are going to compute average during this 6 months. We are going to compute average free float market cap, and those who have companies who are in the top 50, that will be included and remaining one will be excluded. This is reconstitution. Now earlier Yes Bank was performing well, so Yes Bank average free float was in the top 50, but eventually the market cap reduces, free float reduces. Now if the market cap falls below top 50, if it is not in the top 50, then we are going to exclude that security and we are going to include the near one. This concept is reconstitution, and in case of Nifty, reconstitution happens every 6 months. Now there are two indexes, And as on date, can you let me know which stock is going to be included and which is to be excluded? The answer is yes. We can make a guess. Okay. Now there are two indexes. One, Nifty 50. That means group of top 50 companies, ranking 1 till 50. Next is Nifty Next 50. So Nifty Next 50 is a group of companies with a ranking of 51 to 100. Okay. So now I have downloaded one Excel. Now the company which is having the highest weight in Nifty, that is Reliance, followed by HDFC, Infosys, and so on. So this is the company with rank 1, 2, and so on. Now let us which is the 50th company in the list? Now 50th company in the list is Indian Oil, and Indian Oil has a free float market cap of 24,000 crore. Okay. GAIL has a free float market cap of 26,000 crore. Now if I compare this with Nifty Next 50, so these are the ranking: 51, 52, and if I drag, okay. So now compare free float of Adani Greens, Avenue Supermart, that is DMart, Info Edge is Naukri.com, Tata Consumer. So these are the free float of company having a ranking of 51, 52, 53, 54. Now Adani Greens has a market cap of 45,000. Indian Oil has a free float market cap of 24,000. Now my point is, can we comment that in the next reconstitution it may happen that Indian Oil is going to be excluded and Adani Greens to be included? Same wise, GAIL to be excluded and Avenue Supermart to be included. Then UPL with a free float market cap of 30,000 to be excluded and Info Edge to be included. The answer is yes. These are the rough guesses that yes, in the next reconstitution it may happen that Indian Oil, GAIL, UPL may be removed from Nifty 50 and stocks like Adani, Avenue, and Info Edge to be included into Nifty 50. Now I'm very much confident that Adani Greens and Avenue Supermart cannot make to Nifty 50. Now why so? I'm very confident that Adani Greens and Avenue Supermart cannot make to Nifty. Yes, there's a possibility for Info Edge, Tata Consumers, ICICI, Lombard, Dabur. Now question is, why sir? How you can comment upon this? Now, to be included in Nifty 50, there are two requirements, there are two conditions. Number one, you should be in top 50. One condition, which Adani Greens will satisfy, definitely. Second condition is, you should be available in derivative markets. So now what is the meaning of derivatives? Now derivatives have two segments, that is known as FNO, futures and options segment, FNO segment. Now this we will learn in detail in the derivative chapters. Okay, but today derivatives are not, so for every stock derivatives are not available. Okay, so now derivatives are not available for Adani Greens, derivatives are not available for Avenue Supermart, that is DMart. Derivatives are not traded for these securities. Hence I'm confident that they are not going to make to Nifty 50. But yes, I have probability that Naukri.com, that is Info Edge, and Tata Consumers may be included into Nifty, and GAIL and IOCL to be excluded. Okay, so what do you mean by derivatives? This we will learn in detail in the derivative chapter. But for Adani Greens and Avenue Supermart, derivatives are not available. There is no as such condition in next Nifty 50. So that is why they are in this group. But to be included in Nifty 50, there is a requirement of derivative market. So now again, let's go through that fact sheet. Now, the company that they should be in top 50, and the another condition is company that are allowed to trade in FNO segment. FNO means future option segment, are only allowed to be included in the index. Now if I go to money control, now there's a stock Reliance. So now in case of Reliance, there's one word, future options. So future options means they are basically representing the derivative market. So for Reliance, definitely there is a future market. Okay. Now if I type here Adani Green. Now for Adani Green, I will only get NSE BSE. Very carefully, in case of Reliance, I was getting future options as well. Since Adani Greens is not present in derivative segment, so Adani Greens and Avenue Supermart will not make up to Nifty 50, but very confident that Info Edge and Tata Consumer may be included and IOCL and GAIL to be excluded. Now my point is, if you have to bet upon a share, if you want to buy any share, now you know one thing, that eventually Tata Consumer and Info Edge are going to be included. They are going to be included. They are going to be included in a batch of good students. And IOCL and GAIL are going to be excluded from, removed from Nifty 50. Now if you have to bet upon, if you have to buy a share, then those shares are going to be, now you can earn a short-term money by buying those shares which are going to be included and by selling those shares that are going to be excluded. Typically market is bullish over those shares that are going to be included and bearish over those shares that are going to be excluded. This concept is known as reconstitution, and reconstitution happens at every 6 months in case of Nifty 50. Now let's go through the notes. Reconstitution. Now it is necessary that when a security mature, so this in maturity we are talking about debt, this I eventually discuss. This is necessary when security mature or when they no longer have the required characteristics to be included. Now Yes Bank is no more a top 50 company in the country, so we have excluded that and included a new company in that case. Same wise, there was an index Nifty Bank. From Nifty Bank we removed Yes Bank and new entrant included, that is Bandhan. So this is known as reconstitution, and in case of Nifty, reconstitution happens at every 6 months. Now again let's go through. So which target market to be included, which security from the target market to be included, appropriate weight, and how frequently you want to reconstitution. Now I have skipped only one point, that is with respect to balancing. So this point is left, rest I have covered LOS 3. Now I'm moving to LOS 6. Then class, eventually I'm going to discuss all the LOS. Okay. Now what are the uses of security market indexes? Now number one, so while computing KE as per CAPM, RF plus beta, RM minus RF. Now if you want to compute RM, market return, that RM is going to be computed with the help of indexes. Second, beta. Now again we will learn in portfolio what do you mean by beta. In a stock there are two kinds of risk. So total risk has two parts: systematic risk and unsystematic risk. Systematic risk and unsystematic risk. Now beta computes systematic risk, and what is the formula for beta? The formula for beta is covariance of my stock, covariance between the stock prices and the market divided by variance of the market. Now my point is, if I want to solve using this particular formula, I want to compute beta, I would be requiring market. Now what do you mean by market? This again market we are going to compute with the help of indexes. Now what is the uses of market indexes? Number one, it is the reflection of market sentiments. Now before COVID, before lockdown, Nifty was trading at 14,000 points. So this Nifty was trading at 14,000 points. And the moment there's a news that there's a lockdown, there's a COVID, Nifty fall by almost 40% points, 40%. Now Nifty reduces to 7,500 points as on 23rd March. So now market almost fell by 40%. So they in a way represent that in the upcoming year maybe the profitabilities are going to remain under pressure. So Nifty in a way represent the sentiments of the market. And now today Nifty is trading at approximately 15,000 points. Now all the companies have come up with very good results. Now again this gain of 100% is representing the positive market sentiments. So Nifty represents the market sentiment. Now important word. Now the word is proxies. Proxies for computing systematic risk. Proxies for computing KE. Now why the word proxy is written? Now point to be noted. Nifty 50 is not equal to market return. It is not equal to actual return that equity market has delivered. It is not equal to actual return. It is just acting as a proxy. Now what is the meaning of proxy? The meaning of proxy is based upon a sample you are making a comment about population. So point to be noted. Nifty is only acting as a proxy for computation of total return, for computation of systematic risk. It is not computing the exact return, it is only acting as proxy. Now important, if in one of the option what proxy is missing, for example uses of systematic risk to compute systematic so one of the uses of indexes to compute systematic risk, answer is incorrect. What is the correct answer? It is acting as a proxy to compute systematic risk. So important word class. Now if in question it is given that what are the following are the uses of security index. Okay, uses of security index. It is written to compute systematic risk. Answer is incorrect. Then what is the correct answer, sir? Indexes used as proxy to compute systematic risk. Now this is the correct answer. So if word proxy is not there, that means this is not the correct answer. It is acting as a proxy to compute systematic risk. Acting as a proxy means whatever the answer going to be, that answer is an approximate one. That is on the basis of a sample. It is not belonging to entire population. With the help of sample, we are making a comment about the population. So what proxy is important. Then proxies for asset allocation. Now again, what is the meaning of this? Now let us assume that you are having 100 rupees in your pocket. Despite that equity market has delivered a good return, you are not going to put entire money into the equity. Now you will create a diversified portfolio. Now let us assume that you want to put now you want to decide how much shall I put in equity and how much shall I put in commodities such as gold. Okay, and how much in real estate. Now my point is, first you're going to compute the historical returns of all the asset classes, and then you will decide that based upon the risk and the return, you will decide that how much weight you're going to invest in each of these asset classes. That means the one more purpose of security market index is to help the portfolio manager in deciding asset allocation, how much money to be invested in equity, in real estate, and in commodities such as gold. So again, proxies for asset allocation, then benchmark of manager performance. Now there are two kinds of manager. One, active managers, and one, passive. Now what is the meaning of active and passive? So passive are the ones who are only replicating the portfolios. Now for example, I am one of the fund manager with SBI, and now I'm just replicating Nifty 50. So if I'm just replicating Nifty 50, this is known as passive funds. What do you mean by active? Active means where, based upon the research that analyst has conducted, now he decides in which stock or in which sector he wants to invest money. That means he's taking the discretion. So in the active strategy, the discretion is with the management. Discretion is with the manager. Okay, and within the passive, the manager is doing nothing but replicating Nifty 50. So two kinds of managers. Now my point is, the manager who is using the passive strategy, at any given day his return will be equal to Nifty 50. So do we need to benchmark? Answer is no. But now if I'm going to an active fund manager and I say this is my 100 rupees invest, now I'm going to benchmark his performance against Nifty 50. Now I will say that I want a return, at least you should beat the market. That means I'm going to benchmark your return against Nifty 50. Now two fund managers, passive, active. Which fund manager usually charges a higher fees? That is a active one. And now if I'm paying you a higher fees, I want you to at least beat the market. So again, another use of market indexes is to benchmark the performance of active fund manager. And then last use is to introduce new products like ETFs for the fund managers using passive strategy. Now LOS 6. What are the uses of market security? Number one, reflection of market sentiments. If market is up, that means profits are going to be higher. If market is low, that means expectation that profits are going to remain under pressure. Then proxies to compute KE, proxies to compute systematic risk. Then proxies for asset allocation to benchmark the performance of active fund managers and to create new tools, new investment products such as ETFs. So this is LOS 6. So with this, I have covered LOS 1, LOS 2, LOS 3 partially, LOS 4 partially, and LOS 6. Now friends, let's understand what is the meaning of rebalancing. Okay. Now we have to understand the meaning of rebalancing. So what was the meaning of reconstitution? Excluding Indian oil, and including Tata Consumer is an example of reconstitution. Now, what is the meaning of rebalancing? So let us assume that we created one portfolio where there are 3 securities, and these 3 securities has a market cap of 1000, 2200 and 3600. That means I assume that collectively I have invested 6800 rupees, or Nifty is equal to 6800 points. And tomorrow we decide that today is the date of reconstitution, and we decide that A is going to be excluded and a new stock D is going to be included, where D has a market cap of 3000. Okay, now we are going to create a new portfolio. Now there has going to be reconstitution. Now what will happen? Now D will be included, B will be there and C is there. Market cap of D is 3000, B is 2200 and C is 3600. Now I want to create a portfolio where the weights should be in this particular ratio. Now in totality, if I make up the summation is 8800. Now I want to create a portfolio where 34% is invested in D, 25% in B and 40% in C. Okay, but my point is, what is your investment value? How much amount you have already invested? So already Nifty is at 6800 points. I have to make a new portfolio where the weights would be in this particular ratio. That means now I have to invest 6800, but 6800 in such a way that 34% is in D, then 34% is in D, 25% is in B and 41% is invested in C. I want to invest in this particular manner, so that again my investment values will be equal to 6800. Now how I'm going to perform this? Now how this entire reconstitution works? So first, today you are going to exclude A from your portfolio. So if A is excluded, how much money would be inflow? So there's going to be an inflow of 1000. So with the help of this 1000, you are going to purchase D. But my point is, how much total investment should be in D? Total investment should be in D equivalent to 2318 rupees, but only you have invested 1000. Now where we are going to get more money? Now I'm going to liquidate B as well. So B value prior to reconstitution was 2200, but now the revised value is 1700. Now I'm going to sell B for rupees 500. I'm going to sell the shares only worth 500 rupees. I'm going to sell share C valuing for 818. Now in this manner I'm going to accumulate how much money I'm going to accumulate, that is 2318 rupees, and this money will be invested in D. Now again I repeat, reconstitution. How reconstitution happens? You decided that okay, A to be excluded, D to be included. Now one day prior to reconstitution, Nifty is at 6800s. So it's very evident then that very next day when Nifty will market open, Nifty should be equal to 6800. Now you have to adjust the weight of D, B and C in such a manner the weights are in accordance with market cap. And total value 6800 should remain unchanged. Now you decided that A is going to exclude. We are going to get 1000 rupees. Now look very carefully. Earlier, the investment in B was 2200. It has been reduced to 1700. That means we are going to sell the shares valuing 500 rupees. In case of B, we are going to sell the shares valuing 818 in case of C. Collectively, we will get 2300, and this 2300 will be invested in D. Now changing the weights of B and C. Now changing the value of B and C, this is known as rebalancing. Now their weights has been changed. The moment Tata Consumer will enter, GAIL will exclude, the weights of the remaining constituents has to change. Now earlier the weight of B was, in the total portfolio the weight was 32%, but in the revised portfolio it will reduce to 25%. So changing the weights is known as rebalancing. Now in case of Nifty, when rebalancing happens, it happens, reconstitution and rebalancing happens at every 6 months. Now my point is, let us assume that now let's consider there is an equal weighted portfolio, weighted, and you decided that I want to invest in A, B, C only. So these are the three securities, and you decided that I'm going to invest in equal amount, that is 600, 600, 600. This is time period 1, time 0, and the very next day when the share market opens, the prices of A, B, C will change. Now let us assume that the price of A is 700, 800 and 900. Your total investment was 1800. Now it has been changed to 2400. Now my point is, this portfolio was created on an assumption, on a condition that weight of each and every security will remain same, will remain constant. Now my point is, the very next day when the share market opens, weights have been changed. Weight of A is now 700 upon 2400, weight of B is 800 upon 2400, and weight of C is 900 upon 2400. Now again there is a requirement for rebalancing. You have to rebalance in such a way that every security is going to have equal weight. Now total value is 24. If I want to rebalance, then my investment in each stock should be 800, 800, 800. Now to rebalance, you will buy 100 rupees more, 100 rupees shares more of company A, and liquidate 100 rupees share of company C in order to rebalance. Now my point is, in case of equal weighted, the requirement for rebalancing is on very next day. Though you have decided that we want to rebalance after 6 months, let us assume, but the requirement is on very next day. Now which index will require the most rebalancing? Now the index that requires the most rebalancing, frequent rebalancing, that is the equal weighted. In case of equal weighted, the very next day we need that the index should be rebalanced. Now let's go through some fact sheets. So there is a website, niftyindices.com, and we have one equal weighted index as well. That index is Nifty 100 equal weight. So now here, if I click upon fact sheet, okay, now in totality there are 100 securities, but now each and every security is not having a equal weight. It is based upon equal. Tata Motors is having a weight of 1.68, Adani Transmission is having a weight of 1.60. Ideally the weight of each and every security should be 1. Now weights has been changed. Then there is a requirement for rebalancing. Now when you are going to rebalance, now it is going to rebalance on semi-annual basis. Though you are rebalancing on semi-annual basis, but the requirement is on very next day. Okay, so now what is the meaning of rebalancing? Rebalancing means, in order to keep the weights consistent with the index weighing method, securities weights must be adjusted. this is known as rebalancing, and this rebalancing most frequently required in case of equal weighted. So class, important point, a double start point. Which index requires the most frequent rebalancing? And that is, the answer is equal weighted. Double star point. Equal weighted index requires most frequent rebalancing. The requirement for rebalancing is on very next day, but we decided that okay, we are going to rebalance on every 6 months. Rebalancing means changing the weights. Okay, now friends, let us assume that we created one index on the basis of price weighted method. We have 3 stocks, A, B, C, and the prices at the end of day 1 is 10, 20, 30. Okay, so that means in totality we have invested 60 rupees, and value is equal to, value of index is equal to 60 divided by 3 equal to 30. Now let us assume that by the end of day 1, company C split its stock into 2 parts. Now the moment company C will split its stocks into 2 parts, in the market price will reduce to 15. And now my point is, after 1 year, prices of A is 12, this is 22, and price of C is 17. That means now the value of your investments are, the value of your investment is 17 plus 22 plus 12, that is 51. Now if I compute the return like we have solved previously, 51 upon 60 minus 1. So we will get the correct or an incorrect answer. Now very carefully, when I purchase the share, I purchase for 30, and later on company C split its stocks into 2 parts. Now that means by the end of year 1, now I'm not having 1 share, I'm having 2 share, where 1 share has a value of 17. So by the end of year 1, there is a negative return or a positive return. So eventually the answer is positive, but using the formula 51 upon 60 minus 1, we will get a negative answer. That means now we have to make some adjustment. Now important. So if you have to compute return, that is price return. Now if you have to compute the return, so now these are the prices at which you have purchased. Now revised day 1 prices are going to be, this is 10, 20. Now you have purchased shares for rupees 30, but in this 30 now you have got 2 shares. So effectively how much value per share? Per share value is 15. Now to compute price return, you are going to, this is 45. Now to compute revised return, you are going to compute 51 with 45 and you will get the answer. So my price return in this case is 13.33. Okay, so now whenever it is given that it is a split, so you cannot compare directly 60 with 51. You have to make adjustment, you have to compute revised day 1 prices, and then on the basis of that revision you are going to compare it with 51. So now eventually your return is equal to 13.33. So this is alternative 1. But now at times in question it is given that you have to compute value. Now my point is how to compute value. So now let's solve one question on this. Question number 51. A price weighted index is composed of following three securities: prices before split at the end of day 1, and where Z completes a 3-for-1 split at the end of day 1. Okay, so question number 51. Now you invest your money in 3 stocks, X, Y, Z. Prices are 10, 20 and 60, where Z splits its stock into 3 parts. So now if you are going to split your stock into 3 parts, what is going to be the revised price? 10, 20, 20. That means eventually I invested 50 at day 1 and it turned into 19, it turned into 12, 19 and 22. So investment value is 53. You earned a return of 53 upon 50 minus 1 equal to 6%. Okay, so there's no doubt in the calculation of this, but now my point is what question is demanding. So in the question now you have to compute value of the index after the split. Now you have to compute value of the index. Okay, now my point is before split you invested 90 rupees with a value of, now the value is equal to 90 divided by 3, that is 30. Now I want the same value post split in case of day 1. Now post split, if these are the prices, I want the value equal to 30, then what should be the new divisor? Now how we compute value? That is 50 divided by X equal to 30. Now my new divisor is going to be, 50 divided by 30 equal to X, or X is equal to 1.67. Now question is saying what is the value of the index at the end of day 2. Now the value of index at the end of day 2 is 53 divided by 1.67. So answer is 31.73. Now point to be noted, if you have to compute the return, so using alternative 1 we can compute the return, and return is 6%. But now if it is specifically given that you have to compute the value, now first you have to compute the revised divisor, and using that revised divisor you have to compute the value at day 2. So now, though it's not numerically important, but yes, theoretically it's a very important point. So now let's go through the notes. Now price weighted index, the divisor which is initially equal to number of securities in the index, in my case that is 3, which is originally equal to number of securities in the portfolio, that is 3, must be adjusted for stock splits, must be adjusted for stock splits. Now how I have made an adjustment? My initial value should remain constant. Now you have to compute the revised divisor, and while computing the value for day 2, now you are not going to use divisor as 3, you are going to use divisor as 1.67. So now some important theory points. Which index will require the most frequent rebalancing? That is equal weighted. Equal weighted will now require most frequent rebalancing. Theoretically important point, double star. Second, in case of price weighted index, the divisor must be adjusted for stock splits. the divisors must be adjusted for stock splits. So both these points are theoretically very important. Now one more point. Market cap is known as momentum effect. So market cap, value weighted index have momentum effect. And now there is one more word, that is fundamental weighted index will have contrarian effect and value tilt. So important. With market cap, what is momentum effect, and with fundamental analysis, with fundamental weights, what is value tilt, double star, and contrarian effect. Now what is the meaning of all these words? Now a point is market cap, momentum effect. Now let us assume that the market weight of Reliance is keep on increasing over the period. Now if market cap of Reliance will keep on increasing, the weight of Reliance in Nifty 50 will. Now the weight of Reliance in Nifty 50 will keep on increasing. This is known as momentum effect. Momentum effect means as the market cap is increasing, your weight in the index is continuously increasing. Momentum. Now the word is contrarian. What is the meaning of contrarian? The meaning of contrarian is, now if your market cap increases, your weight in the index will reduce. Now what is the meaning of contrarian? As the market cap will increase, your weight in the index will reduce. Now which weighing method is having a contrarian effect, that is fundamental weighted index. Now question is, what is the meaning of fundamental? Now let's understand with the help of example. Now let us assume that there are two stocks A and B, where market cap of A is 700 and market cap of B is 300. So if I want to give a weight using market cap method, then stock A has a weight equal to 70%. Stock B has a weight equal to 30%. So this is the weight method as per market cap. Now my point is, if I want to give weights as per earnings, so now it is given that 2020 earnings for company A and B respectively. So if I want to give weights as per some fundamental factors, that is earnings, now weight of A is going to be 50, weight of B is going to be 50%. Okay. Now you have to compute one ratio, that is earning yield. The formula for earning yield is your earnings divided by market cap. Now in case of stock A, your earning yield is going to be 2.26%, 2.86%, and in case of B it's 6.67%. So first word was value tilt. Now the meaning of value tilt is, those stock will have a higher earning yield, will have more weight using the fundamental weighing system than the market cap. Now look at the weight of B only. So as per market cap, weight of B is 30. As per earning method, weight is 50. Now a company which is having a higher earning yield, that the weight of that company will eventually increase. Now this is the meaning of value tilt. Now what is the meaning of value tilt? Whichever company is having the higher earning yield. The weight of that company will eventually increase using earning method in comparison to market cap method. Value tilt. Now value is more tilted towards stock number B. First word. Second word is contrarian. Now my point is, if the market cap of these companies will keep on increasing, if market cap of these companies will keep on increasing, the earning yield will reduce. Now earning yield reduce, as a result of which your weight will reduce. So important, two words, value tilt, contrarian. It is based upon earning yield. Now as market cap increases, earning yield will reduce. As a result, weight reduce, contrarian effect. Contrarian effect, why? Market cap is increasing, weight reduces. Second, value tilt. Value tilt means stock which is having the higher earning yield will have more weight under fundamental in comparison to market cap. So it is tilted towards that stock which is having a higher earning yield. So from the point, let's go to the notes. Note that compared to market cap, fundamental weighted index assigns a higher weight to stock B. Stock with higher earning yield will be more heavily weighted, and hence the word is value tilt. In contrast to market cap weighted index, in which the stocks moves in the same direction as it prices, fundamental will have a contrarian effect. That means portfolio weights will move away from securities whose prices have increased. So contrarian means your price increase, weight will reduce, and tilt means weight will increase of that stock which is having a higher earning yield. So these 2 points you have to remember in case of fundamental as well. Now I'm again coming back to the notes. So friends, we have covered LOS 1, LOS 2, LOS 3, LOS 4, LOS 5 and LOS 6. Okay. Now friends, I'm moving to my next LOS. Describe the types of equity indexes. So now first type is broad market. The example of broad market is Nifty 50, Sensex 30, that in a way are representing the entire stock market. Then second one is sectorial indexes. Sectorial indexes such as Nifty Bank, Nifty Pharma, Nifty Auto. So these represent how a particular sector is performing. Then these sectorial indexes are important in determining whether the fund manager is better at stock selection or sector allocation. Now, for example, you are an active fund manager and now you decided that I want to invest heavily in, now your return is greater than the passive funds. So you have beat Nifty 50. Now I want to check where you have invested money. Now let us assume that your main return is because of a bank like HDFC. Okay, so in your portfolio there is only one bank. That bank has outperformed. Now that is because of HDFC Bank. That means you have a better art of stock picking. So your stock selection was very good. Okay, but now let us assume that you have beat Nifty 50 and majority of your money is into the pharma stocks. Pharma like Sun Pharma, Cipla, like these stocks. Ipca Laboratories, like these stocks. Now to determine you are an active fund manager, you have beat the market. Now you have beat the market because of better stock selection or because of better sector selection. So it helps in determine that as well. Okay, so now style index, sector indexes. Sector indexes means sectoral indexes where they compute the performance of a particular sector like Nifty Bank, Nifty Auto, and they help in determine whether whatever the return that you have able to beat Nifty, now that Nifty you have beat the market, that is on account of better stock selection or on account of better sector. Okay, now in Nifty, if I go to the fact sheet, so in Nifty the main weight is of financials. So now financial sector is having a weight of 40%. Now my point is, if you are successful in beating Nifty 50 return in particular year, for example Nifty has delivered a return of 20 and your portfolio return is 25. So that means you have the way you have invested, that is different from Nifty. Now your weight may be possible that your weight in the financial service is less, okay, because you have beat the market. In Nifty the main weight is of financial, so you have invested less in the financial stocks, and let us assume you have invested more into telecom. So that means you know which sector is better performing. Okay, so you have a better art of sector selection. Could be possible that you have only one stock, that Airtel has performed well, then that is on account of stock picking. So the return which you are getting, that is on account of stock selection or sector allocation. Okay, so this is one of the use of sectorial indexes. The next is style index. Now what is the meaning of style? Now in the market there are two kinds of stocks, one known as value and one is growth stocks. Okay, so there are two kinds of stocks, value, growth. Now the most expensive stock in the world is Tesla. Okay, so now currently Tesla is trading at a multiple of PE multiple of 1000x. So for 1 rupee of earning, people are paying a price of 2000. So now my point is, it is a very expensive stock in the automobile sector. My point is, will it be termed as value or growth? So growth is also known as quality. Okay. Now people are paying a very high price, very high price. That high price is on account of why people are paying such a huge price for Tesla, because of future growth prospectus. That means, what do you mean by growth stock? Growth stocks are those stocks which are trading at a high multiple. High multiple. Now this high multiple could be on number of reasons. For example, good management, better corporate governance, stable and consistent growth for historical years, or going forward there's an anticipation that yes, growth would be tremendous. For example, in case of Tesla. Now what is the meaning of value stocks? Value stocks means stocks which are trading at a very low multiple. Now this low multiple again could be for a number of reasons. That means one stock is valued, one stock is growth. Now if I want to give you an example, in the FMCG sector there are two companies, one HUL, one ITC. So profitability of ITC, annual profitability is 14,000 crore and HUL is close to 7,000 crore annual profits. These are the actual figures. Okay, and market cap of Hindustan Unilever is close to 5 lakh crore and ITC market cap is close to 2.5 lakh crore. Now which stock is a value, which stock is a growth one? Now look at the multiple of, so this is the earnings, this is the price. Now compute PE multiple of HUL, 5 lakh divided by 7,000. So this is close to 70x, approximately 70x. PE multiple of ITC, 2,50,000 divided by 14,000. That is close to 18x. Now my point is, for 1 rupee earning of ITC, people are paying a price of 18, whereas for 1 rupee earning of HUL, people are paying a price of, investors ready to pay a price of 70. which one would be termed as value, which one would be termed as growth. Now HUL is termed as growth stock, which is trading at a high multiple, and ITC would be termed as value stock because it is trading at a lower multiple. Now high or low multiple could be for numerous reasons. Now why ITC is trading at such a low multiple? That is because this company earns majority of the revenue from tobacco, and keeping in mind that it is not good for the society because of ESG factors, it is trading at such a low multiple. Now we want to create index on this as well. So what is our criteria? Now let us assume for growth our criteria is any stock with a multiple of greater than 50x. For value our criteria is any stock with a multiple of less than 20x. Okay, and now you are going to club this multiples with the market cap. Now for example, you want to create a index and it is only for blue chip companies. So in our country, what do you mean by large cap? Any company which is having a market cap of greater than 30,000 crore, that is a large cap stock. Now style index. First you have to bifurcate between, so value or growth, you have to give some filters, and then you have to club this with market cap. Now for example, I want to create an index for large cap value stocks. Now large cap value stocks means company should have a market cap of greater than 30,000 crore and value is trading at a P multiple of less than 20x. So this would be known as style index. So do such kinds of index exist? The answer is yes. Now here if I click upon strategy indices, now one of the is Nifty 100 quality 30. Quality 30 means group of growth stocks. Same wise Nifty 50 value 20. Value 20 means these are those stocks which are trading at a lower multiple. Okay, so this is an example of style. The next one is multi-market equity index. Multi-market means now here instead of talking about a single country, I'm talking about multiple economies, multiple market equity indexes. So one of the example is Morgan Stanley Capital Investment World Index. Now in this index they have comprised 23 developed market countries. In totality, there are going to be 1500 securities that they have included. And if I go by the weightage, which stock is having the largest weight in this particular index, that is Apple, followed by Microsoft and so on. And if I go by the countries, the largest weight is of US, followed by Japan, UK, France, Canada and others. Again, sectorial weights, that is with information technology, financials, healthcare and so on. So now you have to decide, now you have to think how many types of equity indexes exist. Number one, broad market. Example of broad market is Nifty 50, Sensex 30. Multi-market equity index, that means instead of talking about a single country, multiple countries are involved. The example is Morgan Stanley Capital Investment World Index. Sectorial indexes means Nifty Bank, Nifty Auto. Style, the example of style is Nifty 100 quality, Nifty 50 value. That means here we are talking about value or growth stocks and combining this with the market cap. Okay, so these are the different types of equity indexes. Now I'm moving to fixed income indexes. So class, now this much is important. Okay, now we are moving to another indexes for other asset class such as fixed income, real estate, hedge funds and commodities. Okay, so I would not be discussing much here with respect to fixed income, real estate, hedge funds, commodity, because we have a specific chapters for all these. Okay, so we have 6 readings on fixed income, 2 readings for real estate, hedge funds and commodity. Okay, so here my discussion is going to be very limited. Okay, now what do you mean by fixed income index? Now they would represent the debt market. Okay, now debt market, there are 2 markets now. One asset class is equity. Second asset class is debt. Now, in the introductory chapter of equity, you will learn that equity is a broker market. Now, what is the meaning of broker market? Suppose I am having a share like Reliance and now I want to sell this. So if you want to sell this, there is a ready demand for this particular share in the market. So demand is there. Only you just need a demat account. And now let us assume I am opening my demat account with HDFC Bank. So HDFC with HDFC Securities. So my demat account is with HDFC Securities. Now I will open up my demat account and place a request for sell, and automatically my share are going to be sell. That means what broker is doing? Broker is only providing me with a platform where I am going to sell or buy the securities. Broker market. Demand is already there for your share. Now debt market. Now how debt market works? Suppose today a company like Reliance wants to issue commercial paper or bonds. So now first of all, if you want to issue commercial paper, let us assume you want to issue for 1000 crore. So Reliance wants to issue 1000 crore commercial paper. The company will first go to JP Morgan. Now JP Morgan will purchase this lot from Reliance for 1000 crore. Okay. And Reliance will upfront receive 1000 crore from JP Morgan. Now JP Morgan will sell this to other investors. Now it is the responsibility of JP Morgan to find the investor for this particular commercial paper. Now debt market is nothing but a dealer market. What is the meaning of dealer? Now suppose I have a property and now I want to sell my house. So we typically visit property broker or property dealer. So we used to visit dealer. Now what is the meaning of dealer? I want to sell my product. Now the role of dealer is to create the demand or search for the buyer in the market. In case of broker, there's a buyer, there's a seller. Only you need to provide the platform. For example, Ola, Uber, they're just providing the platforms. Same wise, dealer market. I want to sell my property. Now you have to search for the buyer. Now JP Morgan will search for the investors who are interested in buying this commercial paper. Now if you want to buy equity, so for equity there's a liquid stock exchanges, NSE, BSE. But if you want to buy debt securities, then you have to visit the dealer's office. Now compare debt vis-a-vis equity. Now debt market. In debt market, you are dependent upon dealer. And compare this with equity market, it is more liquid or illiquid. Now it is illiquid market. Now my point is, if you want to replicate Nifty 50, so you understand that in Nifty, HDFC has a weight of 10%, Reliance has a weight of 10%, and so on. So now let us assume if you want to invest 1 lakh rupees, 10% would be invested in HDFC, 1 lakh rupees 10% invested in Reliance, and so on. So it is very easy to replicate it. Now my point is, in case of debt market, replicating the index, recreating the index, copying the index is easy or difficult. Since the market is illiquid, since we are dependent upon dealer, replicating debt indexes is very difficult. So first point. Second, in case of Nifty 50, there are how many securities involved? There are only 50 securities. But now in case of fixed income securities, there are going to be 100 of securities. Now again, replicating becomes easy or difficult. So replicating a fixed income index is pretty difficult. Now let's go through one practical example. So now there is an index by Morgan Stanley USD corporate bonds. Okay, now there's some important words. Now first of all, now in this they have bifurcated this on the basis of maturity. So let us assume maturity is 0 to 3, 3 to 5, 5 to 7, 7 to 10 plus 10 years, and then aggregate. So what is the meaning of aggregate? Aggregate represents the entire borrowing. So entire borrowing, that means aggregate. Now look at the number of securities: 583, 573, 415, 503, 940. Collectively 3000 securities are there. Now my point is, replicating index, compare this with equity. There are 100 of securities that you have to purchase if you want to replicate. It is easy or difficult. So compare debt securities with equity one. It is difficult to replicate debt instrument. It is difficult to replicate debt indexes. Now my point is, let's go through the notes once. Now, index providers are dependent upon dealer for the prices, and the securities are often illiquid. Second point, since they are widely in their numbers, the number of constituents are very high, it becomes difficult and expensive to replicate. Now my next point is, they are having a higher turnover. Now what is the meaning of higher turnover? Higher turnover means higher reconstitution. Now debt will have higher reconstitution in comparison to equity. Why? Now equity, let's understand equity. So now equity, specifically if I talk about Sensex 30, so it is a group of top 30 companies. Now which company was the number one as per the free float market cap in 1990? The company name is Reliance. Company highest market cap in 2000, that is Reliance. Company with the highest market cap in 2010, that is Reliance. Company with largest market cap in 2021, that is again Reliance. Now my point is, reconstitution, changes. Compare equity. Now in the equity you won't find much changes. Only the changes would be on 49, 50, 40, 48, 49 and 50th spot. The tops more or less will remain same. Now in 2005, TCS and Reliance were the biggest company as per the market cap. As on day today, also TCS and Reliance are the biggest one. Same goes with HDFC. So reconstitution happens at 47, 48, 49 and 50th number, but not in case of top spots. So top more or less will remain constant. Now my point is, what is the life of Reliance? Now life of Reliance is infinity. So I can say that Reliance will remain here for an infinite period. Now compare this with debt. Now whenever you borrow debt, that is for a finite tenure. For example, you want to borrow for 2 years, 3 years, 4 years, 5 years. Now once that period is over, once that 2 years period is over, now the loan has been repaid. If that loan has been repaid, now we shall exclude that security and include a newer one. Now compare this with equity. Where do you think there's going to be higher turnover, higher reconstitution? The meaning of turnover means now the securities which has been repaid, that will be excluded, and new securities which has been issued, they are going to be included. So reconstitution in case of debts are going to be way higher in comparison to equity. Number one, in case of equity they are going to be 30, 50 constituents. Compare this with debt. In case of debt there are 100 of. So where do you think the turnover will be higher? In case of debt, the turnover is going to be higher. Now important, compare debt versus equity. Number one, illiquid, dealer market, large number of securities, draw from large universe, large number of securities, high turnover, difficult to replicate. Difficult to replicate. Now let's go through the notes. They are difficult to replicate, higher turnover, and dependent upon dealer, and hence the market is illiquid. Now my first point. Okay, so in this also they have mentioned turnover as well. So turnover is 42.89%. Now what is the meaning of this 42.89%? That means out of total securities, 42.89% has been removed and new securities are included. In case of Nifty, there is hardly one or two securities are being included and excluded. So reconstitution in case of debt is way more. Okay, so now again I'm coming back to the notes. Now fixed income indexes can be classified by issuer. Now issuer can be government or the corporates. Collateral means whether you have given any sort of securities. That means the borrower has pledged some assets, yes or no. So if you have pledged, this is a secured loan. In case of secured lending, rate of interest is less. If you have not pledged anything, that is unsecured lending. Unsecured lending will typically have a higher rate of interest. For example, personal loan. Okay, then coupon paying, whether it is coupon paying or non-coupon paying. Maturity 1 year, 2 year, 3 year. Credit risk. Now credit risk has two components: investment grade versus high yield. Now what is the meaning of investment grade and high yield? Now whenever you are going to borrow money, you have to get yourself rated. Now rating scales are AAA, AA, A, BBB, BB, B, C, D. Now any rating BBB and above is known as investment grade. And any rating BB and below is known as non-investment grade. Okay, so now over non-investment grade, now if you want to invest in a bond from Jet Airways, so they have already defaulted, so rating is D. Will they offer you higher rate of interest or lower? Now if you want to invest in that particular bond, your risk is higher, so you want a higher rate of return. Typically a company like Maruti Suzuki, they are AAA rated, so they borrow at a lower cost because there is a lower risk. Now as the rating will keep on reducing, borrowing cost will keep on increasing. Okay, so based upon the rating scales, we can also do the bifurcation. So if I go to the notes, now here they have bifurcate on the basis of maturity, on the basis of rating, that is A minus. Means what is the significance of A minus? Now consider it as A only. A, BBB, A. Okay, then on the basis of coupon. So these are the bifurcations possible. Now on what basis bifurcation is not possible? That is coupon frequency. Bifurcation is not there. Only you can bifurcate maximum type of issuer, maturity, credit rating. So these are the basis for bifurcation. And in totality, the bond market is represented by aggregate debt funds. So aggregated debt funds means in terms of US, what is the aggregate coupon? That is 3.71%. Now this aggregate is representing the entire debt market. So in US, the average coupon is 3.71 with the average rating of corporates being equal to A minus. So this is representing the entire debt structure of the country. Now again, if I move to the notes, aggregate index can be further be divided into market sector, economic sector, or some other characteristics. Okay, so that's it. In detail, we are going to learn about the fixed income in the fixed income chapter. Now I'm moving to my next. Describe indexes for alternative investment. Now number one is real estate. So as of now, only you need to remember these three names: appraisal index, repeat sales, and indexes of real estate investment trust. So for real estate, there can be 3 types of indexes: appraisal, repeat sales, and last one is indexes of REITs, real estate investment trust. So only you need to remember these 3 names. This will eventually be covered in detail under alternatives. Now next one is hedge funds. Now what is the meaning of hedge funds? So they are very much similar to mutual funds. So now how mutual fund works? So they collect money from retail investors. Now there are large number of retail investors providing money to mutual funds. So in case of mutual funds, there are large number of investors, and typically each investors contribute a smaller amount to the mutual funds. They collect the money and then they invest into companies. So they can invest into debt securities, into equity securities as well. Okay. Now how hedge fund works? In case of hedge funds, basically the persons who invest in hedge funds are high net worth individuals. That means the number of investors in case of hedge funds are relatively less, but quantum of investment per investor is way high. So this is the way hedge fund works. So now here the number of investors are going to be less, but the quantum of investment per investor is going to be way high. So they provide their money to the fund manager. Now fund manager will invest this money. Okay, now my point, how mutual funds are different from hedge funds. Now in a country, mutual funds are not allowed to borrow money. Now for example, they collect money from these investors and will invest only this money going forward. They cannot borrow further money from the market. That means borrowing money in case of mutual funds is not allowed. Further, they can invest money only in debt securities and in equity, and specifically in equity only into listed companies. That means a mutual fund can invest money only into debt and only into listed company equities. Now hedge funds can invest money anywhere. They can invest in derivatives, they can invest in real estate, they can invest into private equity, into listed equity, into debt, into anywhere. They are allowed to invest anywhere. And now my point is, they are also allowed to take borrowings as well. Now compare mutual funds and hedge funds. Which one is more risky? Now hedge funds are more risky, and with respect to mutual funds, the regulators is very stringent. Why? Because they are dealing with the money of retailers. But here the person involved are high net worth individuals. That means over mutual funds, the regulations are very strict. Now my point is, over mutual funds there is a regulation, there is a requirement to disclose their annual performance. But you think that over hedge funds there is no as such requirement. Now my point is, over mutual funds there is a requirement to disclose their annual performance, but no as such regulations for hedge funds. Now my point is, if there is no regulation, and if they are disclosing any number, for example, my annual performance of a hedge fund is, let us assume 25% per annum. They invest into very risky securities, into illiquid securities as well. Now my point is, verifying this number, possible, not possible. So verifying this number, first of all, it's not possible, first. Second, by default, whatever the number they are going to quote, that will have a upward bias. Now why upward bias? Now let's assume you're asking me, so what is your passing score? Now by default, if you're asking my passing score, so number is going to be an inflated one. That means always it's going to be an upward bias. If I say a downward number, then it's going to impact my customers. So hedge funds, first of all, there is no regulation. They invest into risky securities, illiquid securities. Now whatever the number they are quoting, first of all, that is verifying that number it's very difficult, and prima facie, because of conflict of interest, high probability is whatever the number they will quote, that is going to have an upward bias. So now hedge funds. Because hedge funds report their performance to the index voluntarily, there is no regulation. The performance of the hedge funds can vary substantially, and index return may have an upward bias. So first of all, hedge fund himself decides to which fund he is going to declare the value, and by default high chances are that they are going to have an upward bias. Now important, for a hedge fund index, constituents, that means the hedge fund manager, determine the index to whom he want to disclose his return, and possibility is that whatever the return is going to be, that is an upward bias. Okay, now friends, I'm moving to commodity index. So now in case of commodity index, there are two main problems. One, the method of it, and second is performance is dependent upon future prices, not the actual commodity. Okay, now for example, so this is a commodity market in a country, that is MCX. Now there are two kinds of delivery, or there are two kinds of markets. One, spot or cash market. Second is derivative market. Now for example, if you want to buy a gold, physical gold, now you can go to the jeweler, pay the price, and take physical delivery. So this is the way cash market works in case of commodity. So you want to buy a jewelry, for example you want a gold coin, go to the jeweler, pay the price, and take the physical delivery. Now whatever the price that you are going to pay today, that will be an actual price as on date. That means the price is going to be spot price. Okay, the price prevailing as on date. But now how derivative market works, and MCX is a derivative market. That means here no one is interested in taking the physical delivery. So there is no physical delivery. Okay, physical delivery means no actual exchange of commodity. So no one is interested in physical delivery. There is only profit and loss computed. Profit and loss computed on net basis. For example, if I go to MCX and I want to buy gold. Now first, it's a derivative market, so you won't be getting spot prices. So gold, now if I want to buy gold, price I have to pay is 44,930. But this price I need not to pay today. This price is payable on 5th April 2021. Now what is the meaning of this? The meaning of this is, if I today purchase a lot, the meaning of this is I as an investor will pay 44,930 rupees as on 5th April to take the delivery of the gold. Okay, so this I entered into a future transaction. I'm not buying today, I entered into a future transaction. Now let us assume that tomorrow the price increased to 45,000. Now what I will do, I'm going to square off this particular transaction. Square off means this is my buy price, this is my sell price, and now I want to sell. And the moment I will sell, I will make a profit of 70 rupees. That means in the commodity market, no one is interested in taking the physical deliveries. Only on net basis, profit and loss are being computed, and that profit and loss is transferred to your account. Now my point is, in the derivative market, the price that we are talking about first, that is not the spot price. This is a future price. Now what is the spot price of gold? So if I click upon this, you will get the spot prices. Now the current price of the gold is in Ahmedabad is 44,177 per 10 gram. On the contrary, future is trading at 44,936. Now how to compute this future price? This we will cover in derivative. But now my point is, first problem is, in case of commodities, whatever the price you are going to see over the exchange, that is not a spot price, that is a future price. And hence we cannot say that. Now, for example, during the period, gold appreciated by 15% per annum. Let us assume. So earlier gold was at around 100, and now gold is trading at the rate of 115. But it may not be the case that by investing with the help of MCX, your return will be exactly to this. No doubt your return is going to be close to 15%, but again, it is not going to be an exact return. Plus, in case of commodity, there is some concept like rollover. Okay, so this we have to discuss in alternatives. Just point to be noted, first, whatever the prices in case of commodities they are not the actual price, they are the future price, and hence the performance may different. The performance if you invest in the security in the MCX in the exchange may differ from the actual return of the gold. So they're dependent upon the future prices, and while computing a return, we add a component for rollover yield as well. Now, because of these two factors, our return may not be equal to actual return of gold. Okay, one problem. Second is, now how to determine the weight of each commodity. Now, for example, what should be the weight of Reliance in Nifty 50? So that is in accordance with market cap. Now, how to compute the weight of commodities? What should be the appropriate method for commodities with respect to weights? So now, if I go to fact sheet with respect to MCX commodity index. So now in this index, the highest weight is of crude oil. Now crude oil has a weight of 30%, gold 24%, silver 14%, and so on. Now my point is how they have determined the weight. So they have determined the weight based upon liquidity and the physical market size in India. Now what is the meaning of physical market size? That means the current demand multiplied by the current prices of the gold, and liquidity means how many people are ready to buy in the market. So based upon that, they have decided the weightage. So how they have decided the weightage? Now for example, gold, that is the physical market. Now the number of buyers in the market, how much quantity they want to buy, number of buyers, or number of, that is the demand, multiplied by current demand multiplied by current market price. This is the physical demand for gold. Same way physical demand for crude oil, physical demand for silver. In this way, we computed the physical demand, and based upon that, we have assigned the weights. So in case of commodity, what is the biggest problem? How to assign the weights. And second, whatever the performance is going to be, that is on the basis of future, that may not be equal to actual commodity prices. Now think very carefully. Now suppose over MCX you are buying crude oil. So MCX over crude oil, will you get the delivery of this commodity? You will never get the delivery of this commodity. It is only meant for the speculating purpose. Today I bought crude oil. Now it will have some future date. Okay, I'm going to buy this at future date, and before the expiry of this future date, I have to square off. Square off means I have to book my profit or loss. Suppose if I buy crude oil today at, if I put here crude oil, now crude oil is at 4819 for one barrel. 4819. But again, it's a future transaction with the expiry of 19 March. So if today I buy at 4819, tomorrow the price is 4820, and if I square off, my net profit is 1. Same as if the prices falls, for example, to 4800, then I booked a loss of 19. So before the expiry of this future date, you have to cancel or you have to square off your transactions. So class, with this we have covered this chapter. Now I have to solve the remaining practice problem. Now before I move to the practice problem, this chapter is pretty simple. Okay, so let's revise first all the concepts, and then I would be jumping to practice problem. Now first, LOS. What is the meaning of security market index? So the meaning of security market index is to compute the performance of an asset class, security market, or the segment of the market. They are constructed as portfolio of individual stocks known as constituents. Then in totality they are going to be two returns: price return, total return. Then while creating an index, always the first step is going to be to determine the target market. Then which securities from the target market to include, the appropriate weight method, how frequently you want to rebalance, and the constitution. What is the meaning of rebalancing? Rebalancing means changing the weights. Reconstitution means including new asset and excluding the ones which don't have that required characteristics. Then in totality, how many weights method? Price weighted. Now in case of price weighted, you have to remember one word, that divisor must be adjusted for the stock splits. Then equal weight. Most frequent rebalancing is required in case of equal weight. Market cap is also known as value weighted. Now it has a momentum effect. Free float again have a momentum effect. It is the market cap adjusted for holding with the public. And last one was the fundamental. In case of fundamental, two important words: value tilt, contrarian, where the meaning of value tilt is a company having a higher earning yield will have more share, and as the market cap will keep on increasing, the share will keep on reducing. Contrarian, value tilt. Then rebalancing, reconstitution we have done. Then what are the uses of security market indexes? Market sentiments, proxies to compute systematic risks, proxy for asset allocation, to compute the performance of active manager, and to discover new products for fund managers following the passive strategy. Now types of equity index: broad market, Nifty 50, Sensex. Multi-market, the example is MCX World Index. Then sectorial indexes: Nifty Pharma, Nifty Bank. Style indexes: market cap plus value or growth. Example is Nifty 100 quality, or Nifty 50 value 20. So these are the examples for style. Then fixed income indexes. We are dependent upon dealers. They are highly illiquid. There are large number of constituents. Now because of this, it becomes very difficult to replicate fixed income indexes. We can make further classification on the basis of issuer, collateral, coupon, maturity, credit risk, but no such bifurcation on the basis of coupon frequency. Then aggregate index, it represents the total credit environment in the country. Then in case of commodity, the biggest problem is with respect to the weights, and whatever the performance you're going to get, that has two components: one, future prices, and rollover yield. It is not based upon the actual prices. In case of real estate, there are going to be three indexes: appraisal, repeat sales, and indexes of rates. Last one, hedge funds. The problem is that they voluntarily decide to which hedge fund, to which index they want to report their performance, and there is a possibility that there is going to be an upward bias. So class, with this we have completed this chapter. Now I'm moving to the practice problem parts. So I request You have to try yourself to solve that, and if unable, then only you're going to watch the video. Okay, so now I'm moving to practice problems. Practice problem number 1. Now a security market index represents security market, market segment, or asset class. Answer is C. Security market indexes are constructed and managed like a portfolio of securities. Answer is B. Question number 3. When creating a security market index, what is going to be the first step? That is going to determine the target market. 1 month after inception, the price and the total return of a single index will be equal if you have not received any sort of dividends. Answer is C. Then question number 5. The value of price and total weighted and total return index will always be equal only at inception. Answer is C. Answer is A. Question number 1, answer is C. Question number 2, A, 3A, 4, C, 5, A. Now I'm proceeding further. 6 we have solved, 7 solved, 8 we have done, 9 done, 10 done. Now 11th. When creating a security market index, target market will, so it will tell you from the which securities from the universe you want to include. Now for example, now in my case, let us assume that we want to compute sectorial return of banks. Now your first filter is banks. So first filter that you have provided to the software, that is going to be banks. Now target market determines the investment universe. Now only from the banking stocks you are going to find out the companies to be included in the index. So what is the purpose? The target market determines the investment universe. Now question number 12, price weighted, and you have to compute price return. Okay, so price weighted, price return. Question number 12. So your P0 is 20, 50, 26. So answer is 7. Answer is 96. After 1 period, this is 22, 48, 30, 7, 10. So 4 rupees return over 96. This is equal to 4 divided by 96. That is 4.167. Answer is B. 13th. For a value weighted means market cap, return is equal to, question number 13, value weighted means market cap. Now security A, B, C. So outstanding, $300, 2,000. Price 20, 50, 26. Now market cap. $300 multiplied by 20, that is 6,000. 300 multiplied by 50, 15,000. 2,000 multiplied by 26, that is 52,000. So if I sum up, $73,000. Now P1. P1 is 22, 48, 30. 22 multiplied by 300, that is 6,600. 48 multiplied by 300, 14,400. 30 multiplied by 2000, that is 60,000. Answer is 81,000. Now 81 divided by 73 minus 1. Answer is 10.95. Answer is 10.95. Answer is B. 14th we have covered. Now 15th requires an adjustment to the divisor after the stock split. That is in case of price weighted method. Now question number 16, double star. Question number 16, double star. Now before I jump to 16, I want to make some analysis with respect to 13 and 14. Okay, so question number 13, your answer was, as per the market cap, your answer is price return is equal to 11%, and as per the equal weight, price return is equal to 7.1%. So question is exactly similar. Question number 13, question number 14, question is exactly similar, only the weights method has changed. Now my point is, in market cap, the answer is higher. So market cap weight method has a higher answer in comparison to value weight, in comparison to equal weighted. In comparison to equal weighted. Okay, now my point is, now as per the market cap weight method, which security was having the highest weight? Now very carefully, question number 13. Now which security is having the highest weight? 6,000, 15,000, 52,000. Which security is having the highest weight? Now you invested majority of the money in stock C, and in case of market cap, you invested majority of your money in security C, and in equal weighted, you invest in equal proportion, equal weight, and when each stock is having a weight equal to 33.33%. Now my question is very simple. The return of market cap is more, or the return of market cap is more in comparison to equal weight. Security C has more weight as per the market cap, and here the return is higher. Now I want to make some comment with respect to C. C market cap return is higher, and that higher is because of because the weight of C is higher in the market cap. Now my point is, there are three securities, C or A and B. Now C is the one which has the highest market cap, so I can name it as large cap stock, and A and B as small cap stock. Now my point is, C outperform or underperform in comparison to A and B. Now market cap weight, answer is higher. This method has invested or has given more weight to C. Now my point is, C has outperformed or underperformed small cap. So in this case, important, double star, if market cap weight method gives an answer greater than equal weight, that signifies that large cap outperformance given a more return, outperform in comparison to in comparison to A and B. Now look at the return that large cap has delivered. Now a stock of 26 has become 30. So C has given a return of, annualized return of 30 upon 26 minus 1 equal to 15.38%. On the other hand, A has delivered a return of 22 divided by 20 minus 1, that is 10%. And B has delivered a return of 48 upon 50 minus 1, that is negative 4%. Now my point is, I'm going to make a comment that C has outperformed A and B. Now question number 16. If price return of a equal weighted is greater than market cap. Now it is the opposite. That signifies that which stock has outperformed. Now if it is the other way out, the return of equal weighted is more in comparison to market cap. Now market cap has given more weight to C. That signifies that small cap has outperformed in comparison to large cap. So answer is, the most likely explanation is outperformance of small cap capitalization stock. Answer is C, 16 double star. 17, float adjusted market cap is the market cap multiplied by the number of shares available to general public. Answer is C. Then which one is subject to value tilt? That is fundamental weighing. Rebalancing is the process of adjusting the constituent securities weights to maintain consistency with the weights method. Now equal weight. Now equal weight means you should invest in equal proportion. Now to maintain this, you have to keep on rebalancing. 20, which one requires the most rebalancing? That is equal weighted. Reconstitution reduces. Now it increases turnover. So reconstitution is nothing but turnover. So it increases turnover. A is incorrect. Reduces the need for rebalancing, incorrect, because of which there is a need for rebalancing. B is incorrect. Now reconstitution reduces the likelihood that the index includes security that are not representative of the target market. So answer is C. 22. Now B is incorrect. Why B is incorrect? Because it is written as proxy to compute unsystematic risk. Incorrect. Then proxies for specific asset in asset allocation model. Yes, so answer is C. B is incorrect because it is written unsystematic risk. Now 23. Uses of market index do not include serving as a, so they are involved in launching new investment products such as ETFs, benchmarking of the performance. Now why A is incorrect? Again double star. Measurement of systematic risk. No, answer is incorrect. It serves as a proxy to compute systematic risk. The word proxy is missing, because of which A is incorrect. So 22 answer is C. 23 answer is A. What proxy is missing, because of which A is incorrect. Now 24, sectorial indexes is most accurate. Sector indexes, so they provide a means to determine whether the fund manager is more successful at stock selection or asset allocation. Answer is B. Which of the following is an example of style? Within style, market cap plus value or growth. Answer is C. Which of the following regarding fixed income is more accurate? Liquidity issue makes it difficult for investor to replicate. Answer is A. 27. An aggregate fixed income index, aggregate means totality, can be subdivided by market, economic sector, to create more narrowly defined indexes. Next, least likely on the basis of fixed income, that is coupon frequency. Commodity index values are priced on future contract prices. Which of the following is most correct? The performance of the commodity index can be different from that of underlying commodity because they depend upon future prices. Which of the following is not a real estate index? Repeat sales is there, appraisal is there, initial sales index is no. So B is incorrect. Unique feature of index fund indexes is they are frequently equal weighted, no. They are determined by the constituents of the index. That means the fund manager will decide to which index they want to disclose their performance. Answer is B. Returns of hedge funds are biased upward in comparison to equity. The constituents of fixed income are going to be more. That means they are going to draw from a larger universe. Okay. Now 35. So 35 is an important. So by default, you are going to consider both interest and dividend. Okay. Value of the index as on 31st March 2013 is 1000. Okay. Total return is negative 4.5. Total return. That means inclusive of dividend and interest. Now you have to compute the value of the index as on 1st January 2013. So question number 35. January 13, 31st December 13. So now 31st December price is 1000. This is the price. Plus you have earned interest 23.5, dividend 21.5. Okay, this is dividend. And now in totality you are having a negative return of 4.5%. So now my point is, if X is invested here, so by the end of year 1, how much you are having? X 1 minus 0.0450 equal to .955x. Now your total return, how much in totality you have earned, cash flow you have generated. This is the by selling of the asset. This is the interest, dividend. Now in totality you have generated a cash flow of a cash flow of 1045x. 1045. Now 1045 is equal to 0.995x. X is equal to 1050.25. I think I made some mistake. So this is going to be 955. 955. So 1045 divided by 0.955. So answer is 1095. So initially I invested 1095, and now by the end of year 1 I'm having the value of 1045. That means a negative return of 4.5. So total return is given. In totality I'm having in my pocket this much money, and there's a negative return of 4.5. That means I'm having 0.995x of my original investment. So what was X? Your X was 1094. Now a portfolio of security representing a given stock market, given a security market, market segment or asset class, they are described as security market indexes. Now 37 your starting value of the index is 1000. Now this is the price return and dividend income. Which of the following is most accurate? Okay, so now let's start with option number A. The value of price index is 998.1 by the end of third quarter. So 37. Now your starting value is 1000. Now there is a quarterly price return of 3% by the end of quarter 1. So if you invested 1000, there is a positive return of 3%. So value by the end of quarter 1 is 1000 multiplied by 1 plus 3%. This is equal to 1030. Now quarter 2. So in quarter 2 there is a return of 2%. 1030 multiplied by 1.02. Answer is 1050.6. And now in Q3 there is a negative return of 5%. That is 1050.6 multiplied by 0.95. So answer is 998.07. So correct option is option A. Now B and C. Okay, now why C is incorrect? Price return is 1.26. Now you invested 1000 rupees. Now by the end of quarter you are having 998. So price return is going to be a negative value. So C is incorrect. B, the total value of the total value of the total return index is going to be below 1000. So let's solve this as well. So you invested 1000. Now you have to compute your so how much dividend you will get? 1.5. Okay, so you have got a dividend of 1.5 as well. So 1.5 of 1000. So in totality you have get a return of 15. Okay, so now if you get a return of 15 as dividend, so what is the value at the end of year third? 998.07 plus 15. So it is going to be any value greater than 1000. So B is incorrect, C is incorrect. Price return is negative and total return is a value greater than 1000. Why greater than 1000? So considering the price, it should be 998.07. But you have received a dividend of 1.5% over your investment. That is 15 rupee. So value is going to be greater than 1000. B is incorrect, C is incorrect. 38. Which of the following will require most rebalancing reconstitution? That is equal weighted. Now which approach of indexing will give security X a weight of 18%? Okay, so now equal cannot be there because under equal the weight is going to be 33. So B is incorrect. Now let's start with price. So if price is an answer, then weight is 100 plus 200 plus 110. That is 410 you are going to invest. Out of that 410, 100 rupees is in security X. So answer is 24. Even C is not the correct answer. So B is incorrect, C is incorrect. Now what is the correct answer? That is going to be market cap. Let's compute market cap as well. 39. Now market cap of X is 10,000. market cap of Y is 200 multiplied by 150, that is 30,000. Market cap of Z is 110 multiplied by 300, that is 33,000. If I sum up, answer is 73,000. Now what is the weight of X? 10 upon 73. I think I have made some mistake. 10,000, 30,000, and 33, 63, 73. And 70, 73, not 10 divided by 73. Okay, sorry, class, market cap is already given. Okay, so I made a mistake, sorry. 100, 150, 300, market cap is already given. Sorry, I made a mistake. Now 100, 150, 300, that is 450, 550. Now what is the weight? 100 upon 550. Answer is 18. So correct answer is A. So as per price, answer was something different. As per equal, answer should be 33. As per price, the answer was 100 divided by 410, that is 25%. So correct answer is A. So it was directly given market cap. Okay, by mistake I have computed, I assume it to be number of outstanding shares. Okay, so directly given market cap. Answer is A. 40. You have to compute total return of a equal weighted total return. Okay, now question number 40. So price is 40, 50. Now include dividend as well, that is 39, including dividend 39, and 53.5. Compute percentage change and then take average. So 39 divided by 40 minus 1, this is 0.025 negative, and then 53.5 divided by 50 minus 1, that is positive 7%. Now take up the average, divide by 2. So answer is 2.25%. Answer is C. 41. Which of the following is most appropriate as a consumer goods ETF? So now, consumer goods, is it a fundamentally weighted style or sector? Now consumer goods means FMCG sector. So it is talking about sectorial indexes. Under fundamental weight we talk about earning yield, and under style we talk about market cap plus value or growth stocks. So answer is B. 42. Which of the following regarding indexes for alternative is most accurate? Okay, commodity prices return based on the changes in the prices of underlying. Incorrect. A is incorrect. Then B, commodity index consists of market weighted. Incorrect. It is not possible to compute. Correct is C, hedge funds will determine their results will be included in index. Answer is C. Now MSCI all country index is an example of multi-market. Answer is B. Then 44. The index weight that will results in shifting away from the security that have increased in relative value. shifting against, that means contrarian. Which of the following is a contrarian one? That is the fundamental weighing. Which of the following regarding a commodity index is most accurate? Now, the commodity index return will differ. Answer is A. 46. Which one of the following regarding rebalancing reconstitution is most accurate? Now, A is incorrect. Reconstitution क्या? Now, because of reconstitution, there is a requirement for balancing. So C is incorrect. A is incorrect. Answer is B. Answer is B. Now, why B? Now, when there is going to be a reconstitution, now for example, reconstitution will happen, IOCL we have to exit, and Tata Consumers we have to buy. Now, all the passive fund managers, they have an obligation to sell IOCL and they should buy Tata Consumer. That means it will create a buying pressure on the Tata Consumer and selling pressure over Indian Oil. So the reconstitution will affect their prices. Why affect? Because suddenly for a single stock there is a buying, and for a single stock there is going to be a selling pressure. So answer is B. 47. Security market indexes can be used to calculate alphas, which can be described as. Now, what do you mean by alphas? Now, whatever the return that passive fund manager has delivered, or whatever the return that Nifty is delivered, let us assume that value is 15%. Now, this is the market return. Now, I want the active fund manager to beat this. For example, the active fund manager generate a return of 15, and this difference is known as alpha. So how much alpha the fund manager has generated? That is equal to 3%. Now, answer is difference between the return of a actively managed portfolio and return of a passive portfolio. So answer is, this is known as alpha. Answer is C. Now, 48, important. Assuming that the beginning value of the free float market cap is 100, you have to compute ending value. So only you have to compute the ending value, that means ending price. So dividend is going to be ignored. You have to compute only the ending price. Okay. Now, question number 48. So now you are having stocks A, B. Now shares outstanding is equal to 5,000, 2,000. Then percentage of share in market float, that means with public. So public holding 90%, 100%. Okay, and now P0. P0 is 40 and 68. Now market cap adjusted for free float. So this is going to be 5,000 multiplied by 40 multiplied by 90%. That is 1,80,000. Then 2,000 multiplied by 68 multiplied by 100%. 1,36,000. 3,16,000. Now assume that this value is equal to 100 points. Now year-end prices P1 is equal to 45, P1, P2 or P1 for A is equal to 45 and B is equal to 60. Now end values, this is 45 multiplied by 5,000 multiplied by 0.9. This is 2,25,000. 60 multiplied by 2,000. This is 1,20,000. Answer is 3,22,500. 500. Now, what is return that market has delivered? Price return 322,500 upon 316,000 minus 1. So return that market has delivered, that is 2.056 percentage. Now assume that if it is 100 points, then by the end of year 1 it is going to be, by the end of period 1 it is going to be 102.056. 102.50 102.056. So answer is A. 48, answer is A. Now using interpolation technique you can also do. Now 100 points or 316,000 is equal to 100 points. 1 is equal to 100 upon 316, and now 322,500 is equal to 100 upon 316,000 multiplied by 322,500. So 100 divided by 316,000 multiplied by 322,500. Answer is 102.056. So answer is A. 49. Which of the following concerning different types of indexes is least accurate? Least accurate. So least accurate is B. Equity indexes draw from large number of constituents in comparison to fixed income. Answer is incorrect. Now 50. Contrarian effect. So if contrarian is given, answer is fundamental. Answer is C. 51 we have already done. 52. For portfolio managers of passive funds, market indexes are least useful as for benchmarking their performance. Why? For benchmarking, because their return is equal to the market index. So we don't benchmark their performance. Answer is B. 53. Which of the following least likely to be included in the returns of commodity? That is actual prices. They do include future and rollover yield, what we are going to discuss in alternative. Okay, but they do not include spot prices. So friends, with this we have covered this chapter. Okay, so you have to thoroughly revise, you have to solve all these 53 problems before proceeding to next chapter. Thank you. Today I'm going to start with reading market efficiency. Okay, so it's going to be a theoretical and a simple chapter. Okay, so in this we will learn about market efficiency, when a market will be known as efficient and when markets are inefficient. Okay, so now starting with my LOS 1. Now my LOS 1 is described market efficiency. Now in an efficient market, security prices reflect all information fully, quickly, and rationally. Now, for example, there's a stock like Reliance, and now they are planning to enter into Geo, and this data is available in the public domain. That means company has made the announcement. And now if the markets are efficient, then the security prices, for example, today Reliance is trading at 2100, then the security prices reflect all the information fully, quickly, and rationally. So important word is rationally. Fully, quickly, and rationally. Only the unexpected new information should have a response from the trader. That means in an efficient market, the security prices all reflect all the public information, all the information that is available. Hence, it is not possible, for the active manager to earn a positive return for a hence for an active manager, it is not possible to consistently earn a positive risk adjusted return. Now, there are two kinds of managers. One manager is active and one manager is passive. So in case of passive, my return is exactly equal to the return of the market, and the market means Nifty 50. And now if market is delivering a return of 15%, now active manager cannot beat this return, if the markets are efficient. And now my point is, if markets are efficient, then which strategies we should follow? If markets are efficient, you cannot make an abnormal return. And if markets are efficient, then which strategies we should follow? That is going to be a passive one. Now, let's go through this bullet point. If the markets are fully efficient, active investment strategies cannot earn positive return. That means they cannot beat Nifty 50. They cannot beat Nifty 50 for a longer time. Efficient means security prices reflecting all the information. For example, today Reliance is trading at 2100. Now this 2100 reflect all the information with respect to Reliance which is available in the market. Now, if they are planning to buy some retail business, if they want to enter into Geo, everything market is reflecting, the price is reflecting all this data. Okay, now I'm proceeding. Now there are two words. One word is market value and second word is intrinsic value. Now, what is the meaning of market value? Market value is the value at which stock is currently buying and selling. For example, in case of Reliance, the market value is 2100. Now, what is the meaning of intrinsic? So, intrinsic value means this is the value as per analyst. It will differ from analyst to analyst, and it is a value which you anticipate. Now, for example, you in case of a company like HUL, you made the forecast, and based upon that, based upon your valuation model, you have computed some value. For example, as per your estimates, HUL has a value of 3000. Now, this is going to be known as intrinsic value. So, intrinsic value means the value as per the analyst, and market value means the value at which the stock is currently buying and selling. Now, my point is, if markets are efficient, market value, what is the difference between market value and intrinsic value? If the markets are efficient, then these values should be equal. And if these values should be equal, then difference between the two should be 0. Now, in our country, RF is 7%, or currently RF is 6%. And for a consistent period for the last 40 years, Sensex has delivered a return of 15%. Okay. Now, my point is, what is the beta of the market? Market beta is equal to, we have learned this, market beta is equal to, so market beta is 1. Now, my point is, if you want to invest into Indian equity market, what is the return that you're going to get in the entire equity market? If you want to earn in the Indian equity market, what is the return? 15%. And now my point is, if markets are efficient, will there be any trader, any investor in a position to beat this return? So if markets are efficient, it is not possible to beat this return. Every person, every investor, every trader in the market is going to earn 15%. This is the meaning of market efficiency. Now, there are the factors. Now, what are the factors that contributes to market efficiency? factors that contributes to market efficiency. Now, if in the market there are large number of participants, there are greater information available. So now two factors, large number of participants and greater information availability. Both these factors tend to make markets more efficient. Now, what are the factors that reduce market efficiency? That makes the markets less efficient. Number one is restriction to short selling. First word. Then high cost of trading and gathering information. And second is restriction to arbitrage. Now, what is the meaning of short selling? Now, if in any country there is any sort of restrictions, those restrictions are going to make markets inefficient. But only one restriction is good that I'm going to discuss eventually. But all types of restrictions that you're putting in, that makes the market inefficient. Now, first word is restriction to short selling. Now, what is the meaning of short selling? So now tomorrow I'm going to start with one more chapter, that is market organization. In that we are going to learn the meaning of this. But prima facie the meaning is, for example, today there's a stock like PVR. And now I think that because of COVID, the cinema business is going to be hampered and the company and the share price may decline substantially. Now, this is my estimates. Now, if you think that the share is going to up, so how the procedure is? Buy the share and then sell. Okay. But now, if you're thinking that you're not having the share, but you think that this share is going to decline, now how it will work? First, you will sell. Now, for example, currently PVR is trading at 2000. Now, today you will sell the share. And after some time, let us assume your anticipation is that after 1 year, it may decline to 1400. Now, when the price will reach 1400, you will buy it. And in a way, you are going to book the profit. So this is known as short selling. So simply, what is the meaning of short selling? The meaning of short selling is you are selling the share first and then buying it. Again, your profit is equal to 600. Normally, how it works? First, you buy the share, then sell at a higher price and book the profits. This is a normal scenario. But what is the meaning of short selling? You first sell the share. Now, the point is from where I'm going to get the share. So now you will borrow the share from your broker. Sell in the market, and eventually after a year, you're going to return it back to your broker. In this way, you're going to make up the profit of 600. Now, point to be noted, in our country, short selling is not possible. It is possible only with the help of derivatives. This we will discuss in the derivative chapter. But the way which I have explained, that sell the share, borrow from your broker, then again buy it, this scenario is not possible in our country. Now, restrictions to short selling. Restrictions to short selling makes the market inefficient. Now, restrictions to short selling makes the market inefficient. Class, am I clear with the word short selling? First, you have to sell, you have to borrow from your broker, and then once the prices have declined, you again buy it, return back to your broker. So in this way, you will make the profit of 600. Now, my point is, if I'm bullish on a share, that means I think that the profitabilities are going to be very high. For example, in case of HUL, how it will work? If you want to book capital appreciation, you're bullish. First buy, then sell. In this way, you're going to book your capital appreciation if you're bullish. And if you're bearish view, first sell with the help of borrowing the share from your broker, then buy. In this way, you're going to book capital appreciation. This concept is known as short selling, and short selling is not permitted in our country. Class, am I clear with this word? Okay. Now, second word was high trading cost. Now, for example, today, if we buy the share, so now you have to pay brokerage, to the broker. For example, I'm having a demat account with HDFC. So now you have to pay brokerage to your broker. Then you have to pay GST. Then there are some sort of stamp duties. And then there is one more test. There's a tax that is securities transaction tax, then turnover tax. So these are the taxes which are levied by the government. Now, these are not substantial enough in a country. Now, my point is, if these taxes, these brokerages are high, makes the market efficient or inefficient. Now, if you want to trade, you have to pay high amount of stamp duty, security transaction tax, turnover tax, brokerage, GST. Now, higher trading cost will eventually makes the market inefficient. And one more inefficiency is restrictions on arbitrage activity. Now, what is the meaning of arbitrage activity? Now, if a same commodity, if a same share, same commodity is trading at a different price at the same time. Now, in our country, there are two markets, NSE, BSE. Now, let us assume that in NSE, the price is 2100. In BSE, the price is 2000. Now, what you can do, buy here and sell here. In this way, you're going to make the profits 100 rupees. This is known as arbitrage. Again, in the practical life, arbitrage in our country is not possible. So in our country, making arbitrage profits is not possible because both the markets are efficient enough and share will be trading at the same price. Now, if I go to any share, so now in money control, if I put Reliance, now the price of NSE is 2009.10 and price of BSE is 2009.50. So NSE 2009.10, BSE 2009.50. Now my point is, can I make the arbitrage on a share like Reliance? The answer is no. Now why the answer is no? So now again, now in one case the price is 2009.10 and in another case the price is 2009.50. Now you may think that I buy from this market, sell here. In this way, I'm going to make a profit of 40 paisa. But the answer is incorrect. Now, whenever you're going to buy the share, you're not going to pay this price. Whenever you're going to buy the share, you have to pay brokerage along with it. You have to pay GST charges. You have to pay stamp duty plus security transaction tax. Now, net, assume that my cost works out to be 2010. Now, same wise, whenever you're going to sell the share, you have to pay brokerage, again GST, stamp duty, STT. Now, whatever you're thinking, you will be getting less than this. Eventually you will be getting 2009. Now, my point is, are you making profit? Answer is no. Eventually, you end up making the losses. So again, restrictions to first class. Have you understood the meaning of arbitrage? Buying from one market, selling at another market at the same time. This is known as arbitrage. Now, if there are any sort of restrictions, these restrictions makes the market inefficient. Now, these restrictions makes the market inefficient. So now, factors which promotes market efficiency: large number of participants and greater availability of information makes the equity market efficient. Restrictions on short selling, arbitrage, and high trading cost. This makes the markets inefficient. And now last point. But one sort of restrictions is very much good for the market. Now my point is, suppose that I'm working with Reliance and I'm the CFO of the company. So a CFO, Chief Financial Officer, So he's the one who is directly dealing with the financial statements. Now the results of the Reliance are not available in the public domain. Okay, the results of for this quarter is not available in the public domain, and the results are very good. Okay, so the data is not available in the public domain, but I, being a CFO of the company, results are very good. Now my point is, am I allowed to buy the share of Reliance prior to the results disclosure? Now this is known as insider trading. Insider trading. Now, one sort of restriction is very good. Restrictions on one sort of restriction is very good. Now, restrictions on insider trading makes the market efficient. So important. Restrictions on short selling reduce efficiency. Arbitrage reduce efficiency. Short selling reduce efficiency. But restrictions on insider trading makes the market more efficient. Now, class, please go through slide number 3. In US market, short selling is allowed. In our country, short selling is not allowed. In our country, short selling is possible with the help of derivatives. Now, question number 1. This is restrict. Impede means restrict. Do not affect, contribute. Restrictions. Now, if you are restricting, then it makes the markets inefficient. Okay. Question number 2. With respect to market efficient theory, allow short selling. Now, if you're allowing short selling, short selling will increase market efficiency. So, slide number 4, answer is A. So, allowing short selling will increase the market efficiency. Now, restrictions that will contribute to market efficiency. Restrictions that will contribute to market efficiency. Now, restrictions on insider trading with non-public information. With non-public means that data is not available in the public domain. Will most likely restrict market efficiency. Will most likely reduce market efficiency. Answer is A. So question, slide number 5. First is C, second is A. Now, if the markets are efficient, what is the difference between intrinsic and market value? So that is 0. Now, important. Now, before we jump to this one, currently Reliance is trading at a market price of 2100, and as per you, the intrinsic value is 3000. What is your recommendation, buy or sell? What is your recommendation, buy or sell? So your recommendation is buy, and typically we buy when the share is overvalued, undervalued. Overvalued, undervalued, undervalued. Now please answer this question. So intrinsic value of an undervalued share is greater than market value. So both the answer is B. Now the word is market value. Market value of an undervalued asset is equal to. Now go through the options very carefully. Now, in case of Reliance, market value is 2100. Intrinsic value as per analyst is 3000. A, B, C. Go through the options very carefully. Answer is B. B. Now, in an efficient market, share price is change will only on account of new information coming into the market. Plus, slide number 7, first answer is B, second answer is C. Okay, now before I proceed to the LOS D in E, so quickly. Now, if markets are efficient, that means all the data all the information has been reflected in the security prices. Which strategy to be followed? Passive. Okay. What is the meaning of intrinsic value? Value as per the analyst. Second, what do you mean by the current market price? The price at which currently share can be bought and sold. Okay, very good. Second is, now the share is undervalued. If share is undervalued, which value is going to be more? Share is undervalued, so intrinsic value would be more than market price. Now, restrictions on short selling, arbitrage, high trading cost promote reduce market efficiency. Okay, okay. Then there are two factors which promote the efficiency. Those two factors are dash number of participants, okay, large number, and second was trading cost, high or low trading cost, high or low trading cost. So no, low trading cost plus more data would be available in the public domain makes the market efficient. And final one is one restriction will makes the market efficient. That restriction is restriction on insider trading. Okay. Now I'm moving to LOS D. You have to explain what is the meaning of weak form, semi-strong form, and strong form of efficiency. Okay. Now LOS D, double star. So now one form is weak, semi-strong, and strong. Now, what prices reflect? What prices reflect? So, all the past price and volume, all public information, all info, including private information. So now there are three forms of the market: weak form, semi-strong, strong. Security prices reflect past price plus volume data, all public information, all info, including private. Now, to trade in a share, there are two ways. There are two types of analysis. One analysis is known as technical, and second one is known as fundamental analysis. So there are two kinds of analyst, one fundamental, one technical. Now, for example, today I look at the chart of Reliance, and yesterday Reliance declined by 2%. And now today, I don't know what is the management. I don't know much about the management, what a business company is, what is the profitability, what is ROE. I don't know anything about the company. Okay. Now, simply by looking at the chart, and now I predict that tomorrow Reliance is going to fall. Simply by looking at this chart. Now, looking at the chart, and you're going to buy and sell the share, those analysts are known as technical ones. So now, technical analyst. So these analysts, they are basically traders. They are not investing in this stock for long term. They're basically a short-term investors. Looking at the chart, they are going to buy and sell the shares. So it is very much possible that today a technical analyst buy Reliance at 2009, and later by the end of the day, it is selling the share at 2020. So they keep on buying and selling the shares on regular basis. They're basically traders. They're not investors. Now my point is technical analyst. Technical analyst, simply by watching the charts, by going through the charts of the company, they buy and sell the share. One way. Second way is fundamental analysis. Now, what is the meaning of fundamental? Fundamental is, for example, I want to buy Reliance. I'm buying Reliance. Now, what is my rationale for Reliance? So strong corporate governance. I've gone through the annual report of the company. I've gone through the profits. I've computed the ratios. I have done proper peer comparison analysis. Industry research has been done. And based upon that, I concluded that I want to buy Reliance. Oh, I want to buy HUL. Now my point is thorough research of the sector, proper peer comparison analysis. I'm well aware about the management, corporate governance, annual report, every stuff. This type of analysis is known as fundamental. Now my point is, which one has the long-term horizon in the company? So fundamental or technical? Now fundamental are the ones which are investing for long-term. They are known as investors. And the ones who are using technical, they are known as traders. Okay. So they are known as traders. So class, am I clear with the word technical, fundamental, trader versus investor? Now my point is, now the market can be of three forms: weak, semi-strong, strong. Now my point is weak form, efficient. So if weak form market is weak form efficient, that means the prices are reflecting all the past prices and volume data. So if markets are efficient, if markets are weak form efficient, do you think that earning money with the help of technical analysis will be possible? Past prices and volume. So whatever the chart is, that chart is reflecting all the past prices and volume data. Now, if the chart is reflecting, now this is the chart. And now on this chart, let us assume that you concluded that this is the chart. And now on this chart, you concluded that the Reliance is going to up, that the Reliance may be up by 1% tomorrow. Now, in the weak form efficient, we are saying that market is weak form efficient. That means whatever the price today is, that price is reflecting all this data. It is reflecting all this data properly. If it is reflecting all this data properly, it has captured this data, then earning money with the help of technical would be possible. I just repeat again. Now, I'm using the word, there are two ways, there are two words. One, weak form inefficient, and weak form efficient. Now I'm using the word market is efficient. Market is well efficient to capture all the past price and volume data. So market is well efficient to capture all the past price and volume data. So if market is efficient with the help of technical analyst, can you make money? Achha, what is the meaning of? Achha, okay. Again, what is the meaning of efficiency? If markets are efficient, it is difficult to earn money. So if markets are efficient, it is difficult to earn money. Now my point is, markets are weak form efficient. Efficient means they have the prices are reflecting all the past price and volume data. Now, do you think that technical analyst will work? It is easy to earn money with the help of technical analysis. Is it easy to earn the money with the help of technical analysis? So here, technical analysis will not work. But in which country, in which market, the technical analysis will work? Where the market is weak form, inefficient. Now again, I'm coming back to my previous. I'm using the word that markets are weak form efficient. If markets are weak from efficient, that means prices reflect, the stock prices reflect all past prices plus volume. Technical analysis will work, yes or no. Market is efficient. I'm using the word efficient. Technical analysis will work or will not work. So what will not work? That is going to be technical analysis. Now, what will work? So what is going to work? That is going to be, you can earn money with the help of, you can earn extraordinary returns with the help of, you can earn extraordinary returns with the help of fundamental analysis and insider trading. Class, am I clear with row number 1? Fundamental analysis and insider trading. Am I clear with row number 1? Okay, so before I jump to row number 2 and 3. Okay, so now my first question is, market is weak firm, inefficient. If market is weak firm, inefficient, technical will work, yes or no? Inefficient. Technical will work, yes or no? Inefficient. If markets are inefficient, technical will work. If markets are weak firm efficient, technicals are not going to work. Okay. Now, semi-strong. If markets are semi-strong, efficient, again I'm using the word efficient. If markets are semi-strong, efficient, the stock prices will reflect all public information rationally. So now, for example, Reliance is planning some capex. They are entering into a new business. They are going to reduce their debt. All this public information is well captured, rationally captured in the security prices. Now my answer is, will fundamental will work? No. Technical, all information, including all public information, including past prices and volume. Second, will technical will work? Fundamental will not work. Technical will work. Neither fundamental nor technical. Both of them will not work. Then how to make an extraordinary return? That extraordinary return is possible only with the help of? It's only possible with the help of insider trading. Now, row number 1, row number 2. In row number 1, fundamental analysis, you can earn money. Which strategy? Take active, passive. Using fundamental, you can earn money. If you apply your brain, you can earn money. Active, passive. So in case number 1, we suggest a strategy of active. In second case, fundamental will not work. Fundamental will not work. If you apply your brain, that's not going to work. Which strategy shall I follow? That is going to be a passive strategy. Now further, I'm dividing efficiency into 3 parts. Weak form, semi-strong, strong. Now, if market is weak form efficient, that means technical will not work. We can earn the money with the help of fundamental insider. Now, if fundamental is working, then the strategy to be followed is active. Chalo. Now, I'm coming to my row number 3, strong efficiency. If market are strong form of efficient, then it's going to capture, then it's going to reflect, the stock prices are going to reflect all the information, including private data, including past prices and volume, including everything. Now my point is, what will work? What will work? What will not work? Okay. What will not work? It is reflecting all the information, including private data. What will not work? Now, fundamental will not work. Technicals will not work. Insider trading will not work. Nothing, you cannot earn money with either with the help of fundamental analysis, technical analysis, or insider trading. What will work? Nothing will work. Which strategy to be followed? Passive or active? Again, in this case, I'm going to follow the passive strategy. Now, thus it's a double star, highly testable. Now, go through the tables, then I'm going to introduce more difficulties. Now, my point is, if markets are highly efficient, easy to make money, difficult to make money. Now, again, I use the words, markets are highly efficient. It's easy to earn money, it's difficult to earn money. So as the efficiency will keep on increasing, it becomes difficult to make money. Okay. High efficiency is equal to difficult to make money. Okay. Now I'm starting. So first word that I'm using is, that is weak form. That is weak form efficient. Now, if market is weak form efficient, that means the stock prices are reflecting all the past data and volume. You cannot earn money with the help of technical analysis. Technical analysis will not work. Correct? Okay. Technical will not work. But now, if in the question it is given that market is weak form inefficient, market is weak form inefficient. Now, if market is weak form inefficient, that means the prices are not reflecting past data and volume. Now, with the help of technical, can I earn the money? Can I earn the money with the help of technicals? Answer is yes. So now, if market is weak form inefficient, here you can earn the money with the help of technical, fundamental, and insider trading. Here, all the three strategies are possible. Okay, so this is first, weak form inefficient. Second is weak form efficient. Weak form efficient. Here, only two strategies will work. Those two strategies are fundamental and insider trading. Okay, third, market is semi-strong efficient. Now efficiency has increased. We can earn money only with the help of insider trading. And fourth is market is strong efficient. Efficiency has further increased. Strong efficient. Using which strategy you can earn money? Nothing. Nothing will work. That means in this case, you should invest passively. You should invest passively. Here, actively. Now, my point is, class, in our country, there are number of technical analysts and fundamental analysts in the country. Okay. Now, my point is, our country is having which form of inefficiency or which form of efficiency? In our country, technical, fundamental, insider trading, everything works. So which form of efficiency we are having? So now we fall into the category of weak form. We fall into the category of weak form inefficiency. Now, inefficiency means using all these techniques, you're going to make the money. As efficiency will keep on increasing, it's become difficult to earn money. Class, am I clear with this? So Scenario 2, 3, 4. In our country, that does not work. We are inefficient. We are weak form of inefficiency. So there's no country in the world that is weak form efficient, semi-strong efficient, or strong efficient. All the markets in the world are weak form inefficient. As of now. Class, can I proceed further? Check now. Okay. Now, question number 1. Reflect only past prices and trading volume. Market is weak form efficient. Okay. Then, which of the following best describe semi-strong form of market efficiency? Security prices reflect all publicly available data. So slide number 9, first answer is A, second is B. Now, if markets are semi-strong efficient, fundamental analysis will lead to profits that are equal to, you cannot beat the market, that are equal to 0. Next, the prices reflect all data, including private, including public. That is known as strong form efficient. Class, both the answers are B. Now, go through this point, double star. Now, if markets are efficient, then active mutual fund managers' performance has been inferior to passive index strategy. That means you cannot beat the market. You cannot beat the passive fund managers. Now, go through this particular point. If markets are semi-strong efficient means fundamental will not work. If fundamental will not work, then which manager will perform better? Then passive fund managers' return is going to be greater than the ones who are using active strategies. Answer is B. Next, if markets are semi-strong efficient, the risk-adjusted return of a passive one relative to active are going to be, so return of passive will be greater than active. That means answer is B. Now, technical analysis works, assumes that market are double star. Technical analyst assumes that markets are weak form inefficient. Answer is B. Fundamental analyst assumes that market are double star. Okay, so this question is double star. Okay, now my point is, you say that fundamental strategy will work. So now in totality, there are 4 scenarios. 1, 2, 3, 4. My first question is, in which 2 strategies you can earn money with the help of fundamental? So now that is possible in case of 1, in case 1, and in case 2. In case 1, in case 2. That means I simply say that if you're saying that fundamental analysis will work, that means that has 2 conclusions. Conclusion number 1, market is weak form Market is weak firm efficient. Conclusion 1. This is conclusion 1. And second conclusion is market is semi-strong. Market is semi-strong in efficient. Now go through the question again. Class, again I repeat question number 2, question on slide number 12. Answer is C. Now I'm proceeding further. Okay. Now, if markets are weak firm inefficient, if markets are weak firm efficient, semi-strong inefficient. So semi-strong inefficient means fundamental will work. Then which of the following is likely to produce the abnormal returns? Which of the following is likely to produce the abnormal returns? So fundamental works. Then you have to follow the strategy active based upon fundamentals. So answer is C. Now, an increase in time between an order is placed and order is executed. Now, for example, I want to buy Reliance. Today, I place the order at 9:25. My order will execute by 9:45. It will increase market efficiency, decrease market efficiency. So tomorrow we will learn that the orders are executed within fraction of seconds. So if the time is increasing, it makes the market inefficient. Then last one, with respect to market efficiency, a company, so markets are efficient. Okay, so markets are efficient, and a company whose share price reacts gradually to the release of news indicates that markets are efficient. It is given that markets are efficient and share prices are increasing or decreasing. So it is given that markets are efficient. So if markets are efficient, that means by default, we are going to assume that this is the strongest firm. So market is strong firm efficient. Share prices are increasing, decreasing. That will be an account of new information in the markets. So market is strongest form of efficiency is having. Now, if it is the strongest form of efficiency, then it will be on account of only new information about the company. So question number 1, answer is C. Question number 2, A. Question number 3, answer is C. Now, before I jump to next concept, so let's revise it. Okay. So double star important. Okay. So I'm starting with weak firm inefficiency. If market is weak firm inefficiency, which strategy will work? Inefficiency. So that is technical, fundamental, insider trading. All three will work. Okay. Market is weak firm efficient. Which strategy will work? That is going to be fundamental, insider. Okay. Third, market is semi-strong efficient. Now, if market is semi-strong efficient, insider, and if market is strong form of efficient, so if there's a strong form efficiency, nothing will work. Double star, highly testable. Same wise, since fundamental will work, you should follow the active strategies to earn abnormal return, active strategies, and in the last two, you have to earn using passive strategies. Now my next concept is anomalies. Now, what is the meaning of anomaly? Now, anomaly is something that deviates from efficient market hypothesis. That means agar हम कह रहे हैं that market is efficient. Now anomaly is that something that deviates from being market efficient. So in a way, the markets turned into inefficient. So now we have to understand the meaning of market anomaly. Now, first anomaly that has been observed in case of US market is that is in the month of January. So now in America, the companies prepared their financial statements using calendar year. So calendar year means it starts from 1st Jan and it ends on 31st December. Okay. Now my point is, suppose you buy, you are a mutual fund company and you invest in a stock like DHFL or in a stock like PC Jewelers. Okay, so you're a mutual fund company and whatever you have invested in, so by the end of whenever this calendar year will end, you have to disclose your holdings, in which stock you have invested money. And now being a mutual fund company, you have to disclose your holdings. Now my point is, if a mutual fund discloses that it has invested in DHFL, PC Jewelers, Yes Bank, so it will promote the investors' confidence, yes or no? Your mutual fund is investing money in DHFL, PC Jewelers, these are the company which has been bankrupted now. Okay. So now if you have invested in these stocks, then eventually it brings a bad name. Okay. Despite being an analyst, you are very much confident that yes, PC Jeweler will rebound or DHF will rebound, but you don't want to disclose this to your investors. Now, one way is there's a law that only you have to disclose the holding as on 31st December. And I don't want to disclose this. Now, what you will do as a mutual fund analyst, you will, in the month of December, you're going to liquidate the positions. That means you're going to sell the positions. By selling this, you will not be having any share as on 31st December, DHFL, PC Jewelers. Will there be requirement to disclose? You're not having any share of these companies. Will there be any requirement to disclose? Answer is no. And now, again, in the month of January, you're very bullish on this share. And again, in the month of January, you're going to buy the shares. Now, my point is, that means in America, it is observed that in the month of December, there is a dash pressure in the market, buying or selling in the month of December. In the month of December, it has been observed that there has been a selling pressure in the market in the month of December. And in the month of January, there is a buying pressure. My point is very simple. If there's a selling pressure, market will increase or market will reduce. Share price increase, reduce. If there's a selling pressure, market will decline. Share will decline. And if there's a buying pressure, market will increase. So now what has been observed in case of US? So in case of US, in the month of January, it has been observed that January effect, it has been observed that you can earn abnormal returns in the month of January. It is again deviating from market efficiency. And in the month of January, you can earn the abnormal returns. Now my first point, that abnormal return is possible on account of, what is the reason for that? The first reason is window dressing by mutual fund companies. So because of mutual fund companies, there's a selling pressure in the month of December. There's again a buying pressure, because of which in the month of January, US market delivers an extraordinary return. It has been observed. Second reason why in the month of January market delivers a positive return, that is on account of taxes. Now my point is, suppose in a country the tax law is whatever the capital appreciation you have realized, on that realized capital appreciation, you have to pay 30% tax to the government. So let us assume this is the law in our country. Now, suppose I bought one share 100 rupee, and during the period I sell this for 130. So I bought one share, I sell that for 130. So what is my capital gain? What is my capital gain? 30. And on this 30, you have to pay 30% to the government. That means in a way your liability is 9. Now, let us assume that this figure was 100 crore, 130 crore, 30 crore. That means now in this financial year, I have a liability to pay 9 crore tax to the government. And taxes would only be paid on the realized gain. Realized gain means which has been shares which has been sold. I have one more share in my portfolio, and that share was which I purchased for 200, and now currently it is trading in the market for 160 crore, or it is currently trading in the market for 180 crore, and that is in the share name is Tata Motors, and I'm still bullish on this share. I'm very bullish on this share. But now to reduce my tax liability, this loss is unrealized as of now. Unrealized, that means I have not sold the share, and I'm very bullish on this share, and I want to hold this for one more year. But now to reduce my tax liability, I'm going to reduce my tax liability. I'm going to sell this share in the month of December. And if in the month of December I'm going to sell this, I will book a loss of 20 crore. So 20 crore loss, 30 crore profit. Now net, I would be paying tax to the government only on 10 crore, 30%, that is going to be 3 crore. Now, what is the reason? What is the reason that has been observed in America that in the month of January, in the month of December, market falls, and in the month of January, market increases? So the reason is, number one, window dressing by mutual fund companies, and second reason is tax saving, because of which in the month of December market falls and January market increases. So these are the two reasons. This reason is January effect. Two reasons: tax saving, window dressing. Okay, now I'm proceeding further. Next one is cross-sectional. Now, what is the meaning of cross-sectional? Now, there are two kinds of stock. One, size, or one, value. Now, I'm going to divide into two parts. Now, within value, I'm going to divide further two parts. That means there are two kinds of stock. One is value and growth. Value stock, growth stock. Now, answer: which stock will trade at a higher multiple, value or growth? For which stock you're going to pay a higher price? So now growth stocks are the one for which we are paying high multiples, and that high multiple is on account of number of factors. For example, growth which the company is delivering in the past, because of better corporate governance, because of better management. So there could be a number of reasons. So those companies which are trading at a higher multiple relative to their industry, they're known as growth stocks. Same wise, what is the meaning of value stocks? Value stocks means those stocks which are trading at a low multiple. Again, there could be a number of reasons. Now, these are known as value stocks. Now, what has been the strategy of an investor like? So now, before we jump that, there are two stocks: HUL, Hindustan Unilever, trading at a PE of 70x, ITC, trading at a PE of 14x. Now, my point is, which one is value, which one is growth? Value, growth. So HUL is a growth stock, you're paying a high multiple, and ITC is a value stock. Now, if you want to become a good investor like Warren Buffett, you should be in a position to identify this stock. So where the potential of return is higher. Now they always promote that you should have a value investing. Now, what is the meaning of value investing? You should be in a position to identify those companies which are trading at a low multiple, which are available at a lower prices, and eventually they have the potential to become a bigger company. Only then you can earn the massive gains. So you should identify value investing. What is the meaning of value investing? At time zero, you have to identify those companies which are now everyone knows. If you want to invest in an auto stock in a country, everyone knows that you should invest in Maruti. If you want to invest in a banking stocks, then that is the HDFC. Now, value investing means identify those bank, that company which has the potential to become next HDFC. Only then you can earn the make good money. So that is value investing. Now, what has been observed in case of US again? Now, in case of US, it has been observed that the value stocks, now in our country, Hindustan Unilever is giving a good returns. But now if I talk from a country like UK, where there's a parent company Unilever has not delivered any return for the last 5 years in UK. In our country, it is delivering. Okay. So now what has been observed in case of US? In case of US, it has been observed that value stocks surpass the return offered by growth stocks. Okay, so it has been seen in case of US market. Now my point is, this is known as one of the cross-sectional, that it is better to invest in value instead of growth stocks. Now my point is, in India, can we clearly identify what is value, what is growth? Now, if I want to make a research on FMCG sector, there are companies like Dabur, Britannia, ITC, HUL, Tata Consumers, then your Nestle. So I give you the multiple of each and every company. Dabur, let us assume, is trading at a multiple of 60. Britannia is at a multiple of 50. ITC at a multiple of 14, 70, 80, 80. Now, these are the multiple at which it is trading. Okay, so in totality, there are 6 companies. What is industry average? Industry average 60, 50, 14, 60, 50, 14, 70, 80, 80. Industry average is equal to, now industry average is equal to 59. Now you have to identify value growth. Dabur at a higher multiple. Dabur is growth. Britannia is value. ITC value. HUL growth. Tata growth. Nestle growth. Now this we have identified. We know about each and every company. All these companies are in FMCG sector. We computed their profits. We computed this ratio. Now my point is, value, we conclude that value, in keeping in mind the history, value has surpassed the growth stocks. Now my point is, using this, you have found out that we should invest in Britannia and ITC over the other FMCG stock, because one day they will trade at a multiple equal to 59. Now my point is, which analysis you are using? Fundamental, technical? First, fundamental, technical. Which analysis you are doing? Fundamental, technical. Now you are doing fundamental analysis, and based upon your fundamental analysis, based upon your research, you concluded that value stocks will surpass growth. Now you're assuming that which form of efficiency you're operating in. Fundamental is working. Markets are semi-strong, efficient, or markets are semi-strong, inefficient. So now, based upon historical returns, you can earn money by investing in the value stocks. If I conclude this, then which form of efficiency you are assuming? Semi-strong, efficient, or semi-strong, inefficient? Semi-strong, efficient, semi-strong, inefficient. So we are assuming that the markets are semi-strong, inefficient. Now, important. Now, go through this particular word. Class, please go through this particular word. Now, cross-sectional means value versus growth. Now, cross-sectional anomaly is a contradiction to semi-strong and strong form of efficiency, because all the information used to categorize stocks by their PE is publicly available. Class, am I clear with this particular point? Double star. So now we started with what do you mean by anomaly? Anomaly means that deviate from market being efficient. So now first, inefficiency is on account of January effect. So in the month of January, market increases. That is on account of two factors. Those two factors are market increasing in the month of January. One, tax saving. Second, window dressing. Then we started with cross-sectional. Within cross-sectional, there were two parts: size, value, growth. Now simply we say that based upon the history, if you invest in value stocks, you can earn more money. Now you're assuming that markets are semi-strong. You're assuming that markets are semi-strong, inefficient. Okay. Now size. Now there are two kinds of companies. Okay. One is mid cap, small cap, and then it's the large cap stocks. That is the blue chip companies. Now my point is, where do you think in percentage terms, there's a possibility to earn a higher return if you start investing in blue chips or if you invest in small cap? Now historically it has been seen that the small or the mid caps has delivered a higher return on per annum basis in comparison to large cap stocks. That means these companies have greater potential for growth to deliver higher return in comparison to blue chips. Now why? Because these companies are already trading at a very high multiple, a very high base. Now for example, if I compare Reliance with Bata, now Bata is a company with 15,000 crore market cap. This is the market cap of Bata. On the other hand, Reliance market cap is 15 lakh crore. So if I compare, this is 15,000 vis-a-vis 15 lakh. Now there's a chances that yes, in percentage terms, tomorrow Bata may deliver a higher return. That means mid or small cap may deliver a higher return with respect to Reliance. Now my point is, which one is more risky? Blue chips, small cap. Which one is more risky? Now again, the risky is weaker corporate governance, is management issue is with the small cap, and it has been seen that by investing in the small cap stocks, you can earn, or small cap indexes, you can earn more return as compared to Nifty 50. Now my point is, again, all the data is available with respect to the market cap, with respect to the companies, Bata, with respect to the Reliance. Which analysis you are doing? Now you're saying that it's better to invest in the small cap stocks. Again, you're using fundamental analysis, and you're assuming that markets are weak from inefficiency. Now, if I go to Nifty indices, there are two indices. One reflecting the bigger stocks, that is the Nifty 50. And if I download the fact sheet, now Nifty has delivered a return of 17% for the last 5 years. Okay, so this is the return that Nifty has delivered. Same wise, there is one now in India, mid cap and small cap have not performed well, but still Nifty small cap. So if I download the fact sheet, so okay, maybe we're not getting the correct answer in this case because in India the mid cap and small cap have not performed well. एक और ले लेते हैं, एक सेकेंड, मिड कैप भी देख लेते हैं. Okay, now if I compare mid cap, so for the mid cap, last 5 years return is equal to 21%. In case of small cap, it is 13%. And in case of Nifty 50, last 5 years return is equal to 17. Now again, what has been observed? It is observed that the small or the mid cap for a longer term, they have given a higher return in comparison to the large cap. But what is the problem with the large cap? What is the problem with the small cap? The problem is that they are risky. They are more risky, and there are corporate governance issues. Now, if I want to compare one more ratio, now look at the standard deviation. Standard deviation means volatility. Now, standard deviation in case of Nifty 50 stocks. So standard deviation in case of Nifty 50 is 18%, 5 years, whereas in case of mid cap, volatility is 22, and in case of small cap, volatility is 23. So you're going to earn the higher return, but that higher return is on account of higher risk. Again, with the help of fundamental analysis, you can invest. And again, we are saying that we are assuming that markets are inefficient. So by investing in the small or the mid cap, you can make more money. You can beat the market. You're assuming that markets are semi-strong, inefficient. Now, again, there are two stocks. One is overreaction, and next is momentum. So there are two kinds of stocks. One, overreaction and momentum. Now, if I look at the stock like Adani Greens, we don't know anything about the company. The stock name is Adani Greens. And now look at the chart of this company. So if I see the chart for now, I want to see the chart for last 1 year. Okay. Now, 1 year before, stock was at 135 rupee, 19th March 2020. It is keep on increasing. Now, this is the chart of the company. So my focus is over this particular phase. This is the chart of the company. And today's stock is trading at somewhere close to 1300. Now my point is, if you want to make only on the basis of the chart, if you want to make some sort of estimates, what do you think? Share will continue this rally or will reduce? Now, look at the chart very carefully. The stock was trading at 135 rupee. Today's stock is 1100, and the stock chart price is like this. So now what do you think? If you want to bet upon, so assume that this is the career graph for Virat Kohli. Now what do you think? This will continue like this, or there will be a sudden drop? Now you have to make an estimate. Momentum effect, momentum that it will keep on continuing with this momentum, or overreaction. This is an overreaction from the there's an overreaction from the investors, and it may decline. Now stock now my point is, with the stock with such a strong momentum, it is continuously growing. And if you see below, there was something volume. Volume means buying and selling. So volume has also increased. Now people are buying more share with the view, and shares is continuously increasing. Now prices continuously increasing and volume continuously increasing, it signifies that there is a bullish view. Now there are two kinds of stock. One momentum, one momentum, one overreaction. Now in this case, the shares are continuously increasing with increasing volumes. Now my point is, if I want to make some estimates with respect to share price, then I may assume that it may continue this rally for future. Now this stock is known to have momentum effect. And today, if we buy in this stock, we are going to make some money, let us assume. Now, if you're doing this, which sort of analysis you're doing? First, which sort of analysis? The analyst is technical analyst. And you're thinking that technical analyst will work. What is your assumption? Market is weak form inefficient, or market is weak form efficient. So now you're assuming that market is weak form inefficient. Now, what is the meaning of overreaction? So now if I look at the chart of SBI, so when their quarterly results was available, the company delivered a very strong results. So State Bank of India. And in a single day, share, I think, increased more than 15%. So now have a look at the chart of SBI. Now my focus is okay. So now class, look carefully on 3rd Feb 2021. On 3rd Feb 2021, share was trading at 335. 3rd Feb. So 3rd Feb 2021, share is trading at 336. And now on 5th Feb, just 2 days, on 5th Feb, share is trading at 397. So in 2 days, share has increased by how much percentage? Share has increased by how much percentage? In just 2 days? So in 2 days, share has increased by approximate 20%. Okay. And now today share is trading at 367. So now today the date is 20th March. 20th March, again share is trading at 367. Now my point is, on that particular day, when there was a spike till 400, and today share is trading at again 367. Now my point is, that spike on account of overreaction. Now what was the meaning of overreaction? Now based upon the results, you think that the results are good, but no doubt the results are very good. but you have overreacted on this particular information. And as a result, now if we analyze historically this data, if we analyze this, then on that particular day, specifically 3rd, 4th, and 5th Feb, you overreacted on that particular information, because of which share breaches the level of 400. But this is not the true intrinsic value. And again, it's going to bounce back. Now, my point is, there are two kinds of technical analysis. One is known as continuation patterns, where continuation meaning is this pattern is going to continue in the future. They are known as momentum as well. They are known as momentum as well. Second one is the reversal. What is the meaning of reversal pattern? Now, if the share is declining, now the pattern is going to reverse. Now there has been an overreaction. Now again, share price is going to increase. Now my point is, if I start from a point of view of Bandhan. So Bandhan results were very bad. Okay, Bandhan results were very bad, and stock was trading at 400. And in a single day, it reduces to 300. Okay, and now again it is trading at 650. So this particular fall is known as plus this particular fall 400 to 300. This particular fall is known as overreaction. And this increase is known as reversal. Now being a technical analyst, you have to identify with the help of charts when this reversal will happen. And now, for example, you're a good technical analyst and you identify these particular points. You make this money. Now, again, you're going to assume that the markets are which form of inefficiency? You're making the money with the help of technicals. So which form of inefficiency? So that inefficiency is going to be weak form. So now important. There are two kinds of stocks. Value, size. It has been value, growth. It has been observed that value gives a higher return in comparison to growth. You assume market to be semi-strong, inefficient. Then it has been observed that small cap, mid cap given a higher return in comparison to large cap. You assume that semi-strong. Now you are able to identify the continuation patterns and the reversal patterns in a share. Now my point is, you're assuming that market is weak form inefficient. Now, being a technical analyst, you have to identify when the reversal is going to happen or when it's going to continue. So if you think that the momentum is going to continue, that is known as momentum. And if you think that it is going to reverse, that is known as overreaction. Class, clear with the momentum and overreaction word? Now please solve question number 20. Least likely January effect. Answer is B. Okay. Now, which one? Okay. Which one is inconsistent with weak form efficiency? That means example of weak form inefficient. So now we have not done A and C yet, but one of which is example of weak form inefficiency, and that is going to be momentum and overreaction. Momentum is known as continuation pattern. Continuation pattern means, like we see in case of Adani, we concluded that this pattern may continue for short term, and we may earn money. Now, 23rd double star. Researchers have found that value have performed growth. Value have performed growth. Now, if you want to exploit this, you will going to buy the shares with above average. Now, you are going to pick up the value stocks. Value means which are trading at low multiple. Value stocks means which are available at cheap valuation. 23rd double star. Researchers have found that values have consistently outperformed growth, and investor wishing to exploit the value effect will purchase the stock with above average. Now, there are three options. You want to purchase the stock which is available at lower valuation with above average dividends, above average dividends, option A. Option B, which is trading at high price to book value. Third is high price to earning value. Now, out of the three, which option is representing value stocks? Option A, B, C. Value stocks means available at a lower price. Available at a lower price. Now, this is available at a higher price. It is available at a higher price. Now, what is the meaning of dividend yield? The meaning of dividend yield is how much dividend as an investor you are getting. Now, ITC has a dividend yield of 6%. Unilever has a dividend yield of 2%. Which one is the value stock? That is going to be ITC. So value stocks are the one which are trading at a lower multiple or over which we are receiving a higher dividend. So answer is A. Question number 27. Least likely. Least likely. Now, as per your analysis, you can earn money by investing in the value stocks. Value stocks means you're investing by using fundamental analysis. Now, if fundamental analysis will work, that means it is semi-strong, inefficient. Semi-strong, inefficient is equal to weak form of efficiency. Now, question is asking which form of efficiency is it? Strong, semi-strong, weak. You are able to earn money only with the help of fundamental. So which form of efficiency is it? So answer is C. Class 27th clear hai? Now 27th. You are able to make money with the help of fundamental. Fundamental means markets are semi-strong, inefficient. Semi-strong, inefficient means market is weak form of efficient. Now you have to mark ABC. So answer is C. Class, am I clear with 27? If you are able to identify continuation and reversal pattern, you are a technical analyst. That means you're assuming that markets are weak form, inefficient. Same wise, you're able to identify value versus growth, and you're putting your money in value. That means you're doing a fundamental analysis. That means you're assuming that markets are semi-strong. Markets are semi-strong, inefficient. Semi-strong, inefficient is equal to weak form, efficient. So which least likely to be contradict? So answer is C. Okay. So with this, I'm not proceeding further. Okay, class. Okay. Thank you. Now, market efficiency. So first one was when the markets would be efficient. Now, markets would be efficient enough if the stock prices reflect all the available information quickly and rationally. That means changes are only on account of unexpected new information. Now my point is, if the markets are highly efficient, then which strategy should follow to earn money? Which strategy? Which strategy? Class, please, all of you. Now, which strategy? Now, if markets are highly efficient, then we suggest that you should follow the passive strategy. Now, what is the meaning of passive? That means you have to buy Nifty 50 ETFs, or you have to invest in Nifty 50 stocks. Invest passively. Invest in the same weight as it is in the Nifty 50. That means, in simple words, you have to buy Nifty 50 ETFs. Okay. So this was LOSA. Then market value, intrinsic value. Now, my point is, when the share would be undervalued when there's a buy recommendation, and buy recommendation would be when intrinsic value is intrinsic value is intrinsic value is intrinsic value is greater than market value. What is the meaning of market? The price at which it is currently bought and sold. Now, what are the factors that affect the market efficiency? Now, if there would be large number of participants, if there's a greater availability of information, large number of disclosures, it is going to increase the efficiency or reduce the efficiency. It is going to make the markets more efficient. Same wise, any sort of restrictions will make the market inefficient. For example, restrictions on short selling. Restrictions on short selling will make the market inefficient. Plus, high trading cost, high brokerage, high trading cost, high stamp duty, high GST will reduce the market inefficiency. It will reduce the market efficiency. But now my point is, one sort of restriction is very good for the market. That restriction is restrictions on insider trading. Restrictions on insider trading, so that we want to protect the unsophisticated investors. It's very good that insider trading should not be allowed in the country. Okay. Now, this we have covered. Okay. Now, LOSD and E double star. Now, the market can be of three types. Efficiency can be of three types: weak form, semi-strong, and strong. So, if market is weak form efficient, that means prices reflect past data and volume. So if it reflects past data and volume, then can you earn money on the basis of technical analysis? Can you earn money basis on technical? No, technical won't work. Then which strategy you're going to follow to earn money? That is fundamental analysis and insider trading. Okay. Semi-strong. It reflects all the data available in the public domain, including past data and volume, public data. So now, if it captures all the public data, then what will not work? Technical analysis will not work. Fundamental will not work. Then you can earn money. You can earn abnormal returns with the help of insider. Now, strong efficiency. It includes all the data, including private data. All the information, including private. What will not work? Now, technical won't work, fundamental won't work, insider trading won't work. Now, nothing will work. So which strategy you have to follow? So now here you have to invest passively. In second case, fundamental will not work, passively. And in case number one, you should invest actively. Now my point is, if you are able to make money with the help of technical analysis, technical means with the help of charts. If you're able to make money with the help of technical analysis, market is weak, firm, inefficient. So now if you're able to make money with the help of technical analysis, that means market is weak, firm, inefficient. Okay. If you're able to make money with the help of fundamental analysis, you're able to earn extraordinary return, abnormal return with the help of fundamental analysis. It is known as semi-strong. It will be known as semi-strong, inefficient. And now if you're able to make money with the help of insider trading, abnormal return, market is strong. You're able to earn abnormal return with the help of insider trading, then this is going to be strong, inefficient. A very important concept. Now I want to solve some couple of questions on this concept. This is LOS E and G. Question number 21. Markets are semi-strong, efficient. What are going to be the abnormal profits using fundamental analysis? Equal to 0. 22. All public and private data. Then it is strong, efficient. 23rd. If markets are semi-strong, efficient, passive will return mostly be outperform. Question number 25th. 25th answer is B. 26th answer is C. Now I'm proceeding further. Okay. Now, what do you mean by anomalies? Now, the anomaly means scenario where you can earn abnormal returns. So now, anomaly means when you deviate from efficient market, or simple words, these are the scenarios when you can earn abnormal return. Now, my point is, first one is January effect. Now, in the month of January, it is seen in the US that you can earn extraordinary returns. Now, that extraordinary return in the month of January is on account of buying pressure. Okay, so January you can earn return on account of buying, and in the month of December there is a selling pressure. Now, my point is why in the month of December and January buying and selling pressure has been seen. There were two reasons. Number one is going to be the tax saving, and second one was the window dressing, because of which there's a significant buying pressure in the month of January. There are two reasons. Number one, tax savings, and number two, that is going to be the window dressing. Then we talk about cross-sectional. Now, within cross-sectional, there were two parts: value and growth stock versus size stock. Now, value growth. Now, there are two banks. One, HDFC, which is trading at a PE multiple of 30x, and Kotak, which is trading at a PE multiple of 35x. Now, historically, it has been seen that, first, out of these two banks, which one is a value, which one is a growth stock? Which one is the value, which one is the growth stock? Plus 30, 35. Now, whatever is selling at a higher price. Now, Kotak is selling at a higher value, higher price. So, Kotak is a growth stock and HDFC is a value stock. And now, if we see the results, now historically, value has always given a better return in comparison to a growth stock. So, based upon the historical data analysis, value has given a better return in comparison to growth. Now, my point is, if by investing in value stocks today, I can earn the abnormal returns. Now, my point is, if you're going to earn abnormal returns by investing in the value stocks, which are available at a lower multiple, now you are earning money with the help of which analysis? Trading at low multiple. That means which analysis you're performing? Which analysis? There are two kinds of technical, fundamental. Now you're doing fundamental analysis. You're comparing prices with earning, and based upon that, you selected that I want to buy HDFC. Now, if you are able to earn abnormal return with the help of fundamental analysis, then you assume that markets are dash inefficient. Markets are, you're earning money with the help of fundamental analysis. Then markets are dash inefficient. Markets are semi-strong inefficient. By investing in the value, it has been seen that you can earn abnormal returns. That means fundamental analysis is working. That means market is semi-strong inefficient. Okay, now I'm coming to size. Now, within the size, now there are two bands. Now it has been seen that small cap or the companies with a lower market cap able to perform better. Okay. Now point is there are two banks. One is Kotak and one is HDFC. HDFC has a market cap of 10 lakh crore. Kotak has a market cap of 3.5 lakh crore. Now, as per this statement, we should invest in. It has been seen that companies with smaller market cap performed better based upon the historical data. You can earn abnormal return. So now this is again the size effect. Now you have to compare the market cap of both the companies. You have to know about the management, which analysis you're performing, which analysis, they should be in the same line of business. They should be exact comparable. So which analysis you're performing, that is going to be fundamental. Again, if you're going to buy Kotak based upon this analysis, you're assuming that markets are dash inefficient. You're assuming that markets are semi-strong inefficient. So now we have covered under anomaly two things. One, January effect, cross-sectional. Within cross-sectional, we have done value, growth, and size. Now I'm proceeding further. Now next one is, now there's a stock like Adani Greens. Okay, and you don't know anything about Adani Greens, what company does, which line of business, what is the management. Now my point is, if you look at the chart, what is your observation? Buy or sell? So just have a look over the Adani Greens. So now if I put here Adani Greens. Now Adani Greens has a higher growth in comparison to Tesla as well in terms of percentage. Okay, so now at current moment, Adani's is growing at a higher rate than the Warren Buffett than Elon Musk. Okay, now look at the graph for last. Now 6 months before, share was trading at 600. 6 months before 600. Right now it's 1100. Okay, 1 year before. 1 year before, share was trading at 141. Right now, share is 1200. 3 months before, 3 years before. 3 years before, share was at 30. Share was at 30, and currently share is at 1100. Now, my point is, based upon this data only, you will buy the share, you will sell the share. You will buy the share, you will sell the share. The graph is like this. The graph is continuously like this. You will buy the share or sell the share. Now, this is known as momentum effect. Now, what is the meaning of momentum effect? The momentum effect says that the rate at which share is currently growing, it is with such a good volume, and the growth is such a constant, is as of now such a constant, that in the near future, this may continue this particular journey. Now my point is, this is known as momentum effect. Now only on the basis of chart you identify whether I want to buy yes or no. Now my point is, based upon which analysis? Based upon which analysis? That is the technical. And now you're assuming that market is dash inefficient. And I'm assuming that markets are weak form inefficient. Okay. Now I want to give you an overview about the FMCG sector as well. Now, within FMCG, entire FMCG in this particular year has given a very good return. Entire FMCG. Now, name any company. Dabur, Britannia, then your Tata Consumer, HUL, Nestle, Tata Consumer. Name any stock. Any stock has given an extraordinary return, except for single stock in the market, except for single stock. And that stock is having the highest profitability amongst the all. That company is highest profitability. The company with the highest profitability, the company name is ITC. Now, entire FMCG has delivered a very good return. Only one stock, that is ITC, and it is the stock with the highest profitability among all the companies. To just give you how big the number is, how large the profits are, if I club the profitability of HUL, Nestle, and Britannia, the profitability of these three companies, then it becomes ITC. But entire FMCG has delivered a good return except for one company, that is ITC. Now my point is, do you think that, now let's look at the chart of ITC as well. Now let's see for last 3 years. This company is the only company in the FMCG that has delivered a negative return. Now last 3 years. Last 3 years prior, the share was trading at 256. Now 3 years before. Currently, share is trading at 222. Now my point is, do you think that this will continue or the patterns are going to reverse? Entire sector is growing except for one company. And this company is the one with the strongest profitability, with the good ROE. Do you think this trend will continue or trend is going to reverse? Trend is continued or trend is going to reverse. Now there's a possibility that this trend may reverse, and now HUL may deliver the higher, now ITC may deliver the higher return. Why? Now, because the entire sector is delivering the return. These companies are with good corporate governance. There are no corporate governance issues. The company is bank on delivering the good numbers, good dividend. Everything is good with the company. There's not a single point over question mark. Now, I don't think that this effect is going to be continued, and now it's going to reverse. Now, this is known as overreaction effect. What is the meaning of overreaction? That means now, for those stocks, which has not performed well, whereas the entire sector is performing only by looking at the charts, whereas the other sectors are performing, now we are going to bet upon this particular share, that is ITC. Now, looking at the chart, you decided to buy that I want to buy ITC because it has already fallen a lot. This would be known as which effect? It will be known as, now the pattern is going to reverse. That means now the share price is going to increase. This is known as overreaction effect. And now you are buying only on the basis of chart. Now my point is, if you're buying only on the basis of chart, you are assuming that it is a dash inefficiency. That is going to be a weak form in efficiency. Now, I want to give one more example with respect to overreaction. So there's a company that is Tata Motors. Now, Tata Motors was trading at around, I think, so the share was trading at around 450. Okay. And the share reduces to 70 rupees in the market. And this 70 rupees price is 15-year lowest level. 15-year lowest level. Okay. For this company, Tata Motors. Okay. And now my point is, now again, there has been some Jaguar issues because of which it has fallen a lot. Okay. But now company comes up with a statement that now we are going to enter into the electric vehicles. We have already launched one car, that is the Tata Nexon. This Tata Nexon car is the largest selling EV in the country. And there's a huge potential, keeping in mind the continuously increasing petrol diesel prices. We see a huge potential for electric vehicles, particularly in India. And on the other hand, now the Jaguar sales are back to pre-COVID level in China. So Jaguar basically earns from China, and now the sales are back to pre-COVID level. Now my point is, what your take on this? This pattern is going to continue. That means it will fall further, or there's going to be a reversal. Now there has to be a reversal. So by looking at the chart, it has already fallen a lot. There has been an overreaction. Now you want to buy. So simply by looking at the chart, you are able to make abnormal profits. This is an anomaly, and this anomaly is known as overreaction effect. So now how many anomalies? Number one, January. January is an account of two factors: tax saving, window dressing. Then cross-sectional. Cross-sectional is having two parts: value, growth, size. They assume that markets are semi-strong, inefficient. And finally was overreaction. Overreaction means reversal. And last one is continuation. Continuation is known as momentum effect. They assume that market is weak form, inefficient. Now one more anomaly. Now my point is, right now you have seen that DMart open up at a premium of 100%. Indigo IPO open up at a premium of 75%. Burger King open up at a premium of 85%. Now my point is, by investing in IPOs, can we earn extraordinary money, abnormal returns? So we think, not always, but means keeping in mind the trend. Now there are a number of examples. IRCTC. Second one is Burger King. Then it's Indigo Paints, DMart, Mrs. Vector. Now, if you see all these IPO, at least they have given a return of 50% on the day of the first trading day. Now, my point is happiest mind. Now, my point is, then the next one is Dixon Technologies. Now, my point is, can we earn abnormal returns by investing in the IPOs? Can we earn abnormal returns by earnings by investing in the IPOs? The answer is yes. So now when you can earn abnormal returns. So abnormal returns is possible when you invest in IPO. The next, what they have discussed, that is the earning surprises. Now the company name is Havells. Okay. So recently Havells, this company is basically into the manufacturing of electric goods. Okay. Now Havells come up with their quarterly results. Okay. And the results were very good. Despite being the lockdown, this company is able to book a good profits. Same wise, there's one more company, that is Muthoot Finance. So this company is into the gold lending business. Now, despite the lockdown, so there was a lockdown, complete lockdown, and despite this, company was in a position to book the highest ever quarterly profits in the scenario of lockdown. So now let's look at the chart. Let's look at the income statement first. The company name is Muthoot Finance. Now I want the quarterly financials. Now lockdown was in the month of March. These figures are in million. So now March is fourth. नहीं, June is fourth one. March में तो नहीं था, last में था ना, June के महीने. 1, 2, 3, 4th June. Now look at the June. Now the earlier profits were 841 crore, then again 841 crore, and despite there's a lockdown, company was able to book a profit of 853 crore. Despite there's a lockdown, no consumer, no transaction, nothing. Same, there's a company that is Havells. Okay, so Havells was able to book a good profit. Now there are earning surprises. The moment this news comes in the market, they booked the highest ever profits. Now share will go up or down. Share will up or down. Now share will go up. Now it opens up at 1,000 rupees. And it opens up at the 1,000 rupees, and within a single day, it is a company with 50,000 crore market cap. Within a single day, the share jumps by 20%. Within a day, 1,200. And next day, again, it jumps by 5%. Now, earning surprises. Now, what is written in the book? When there are earning surprises, when the company books very good profits, the adjustment does not complete on the single day. They need couple of days, market needs couple of days to analyze this data. During this period, again, you can earn abnormal returns. So ideally, if the markets are efficient enough, the price at which it is open up, now let us assume post 5% increase, the value is 1260. So now if markets are efficient enough, then the moment it open up, so this is a theoretical concept, okay? The moment it open up, it should open up at 1260. That means the adjustment to the new news should be immediately. But what happened in practical life? Now the market takes couple of days to for this earning adjustment. And again, during this period, you can earn the abnormal profits. So now in totality, how many anomalies are there? January, that is an account of two factor, size value, then size value that is known as cross-sectional, then momentum overreaction, earning surprises, and by investing in IPO. Now one more anomaly is there. That one more anomaly is, now there's a fund that is close-ended fund. So class, have we discussed what is open-ended, close-ended? Open-ended funds, close-ended funds. Acha, now again with a limited knowledge, in detail we will cover in portfolio. So now there are two types of mutual funds. One open-ended and another one is close-ended. Now close-ended are similar to as of now, though there's a thin line of difference, but as of now you can imagine that it is nothing but equal to ETF. Okay. Now let us assume you want to invest in a mutual fund. Now let's discuss from the point of view of open-ended. Now let us assume you invested in one of the let us assume HDFC blue chip fund. Okay, so this is open-ended. Now this fund has invested money in Reliance and TCS only. And now every day the fund will disclose NAV. What is the meaning of NAV? What is the market value of these shares? Now, if you want to invest more, so you can invest more at this particular NAV. Similarly, if you want to redeem this, by redeeming whatever the units you are having, you will get. By redeeming whatever the units you are having, you will get. Now, plus, if you want to buy more, you can buy more units at a NAV. Similarly, if you want to redeem, you want to liquidate your existing units, what amount will be transferred to your account? So again, the amount that is going to be transferred, that is equal to NAV per unit. Now my point is open-ended. So in case of open-ended funds, if you want to buy more units, you're going to visit. You want to buy more units, you're going to visit your mutual fund office. And same wise, if you want to liquidate, then again you're going to visit. Now, if you want to buy, you want to liquidate, at every given day you have to visit the HDFC, and HDFC will pay the price or will transfer the amount equal to NAV, whatever the NAV is on that particular day. Okay. Now, how close-ended funds works? Close-ended. Now, the meaning of close-ended is, now the fund has been closed. That means now no new units will be issued. Now no new units are going to be issued. Now my point is, if I want to liquidate my existing units, now that if you want to sell, you have to go to, now if you want to liquidate, need not to come to HDFC, go to stock exchange, and liquidate your units. Same wise, if you want to buy more units, then do you need to visit the HDFC office? Do you need to visit the HDFC office? No. Again, go to stock exchange and buy the units. Now my point is, in case of open-ended, you will exactly get, in case of open-ended funds, you will exactly get, if you want to liquidate, you will exactly get, now you will exactly get NAV. Now my question is, ideally, in case of close-ended funds, In case of close-ended also, you should ideally get NAV. In both the cases, whether it's an open-ended or close-ended, you should get NAV in both the cases. Now, here the regulation of SEBI is, here the SEBI says that mutual funds, to the retail investors, you have to pay NAV. And if they want to buy more, that more will be issued at NAV. But in the close-ended, now close-ended will be dependent upon exchanges. Now close-ended will be dependent upon demand and supply. Now my point is, despite the NAV should be 20, but if there is no seller in the market, there are only buyers in the market, only buyer. Now my point is, will he pay equal to 20, more than 20? Buy is more, buyers are more, sellers are less. So he's going to pay more. Same wise, there are more number of sellers in the market, more number of sellers than buyer. Now my point is, equal to 20, less than 20. Equal to 20, less than 20. Now this is now equal to 20, less than 20. Now this is going to be less than 20. That means close-ended funds, you will not get exactly equal to NAV. It depends upon demand and supply. And typically what has been seen? Now typically it has been seen that close-ended funds trade at a value less than their NAV. Now why less than? So in majority of the cases, it has been seen that they are trading at a less than their NAV. Now what are the rationale for that? Number one rationale, since the liquidity is not there. So on account of illiquidity, they are trading at a lower than their NAV, illiquid. And second is, now every year, what will happen in case of ETF? In case of ETF, mutual fund company will going to debit some amount. They're going to charge some amount, and that some amount is on account of management fees. Since they are managing your money, so they're going to charge an amount. Now, in this case, now since the moment I purchase the unit, now SBI is going to debit my account. So on account of management fees, whenever there has been the transaction, that transaction has been less than NAV. So there are two reasons. One, since ETFs are not liquid enough, so there's illiquidity, because of which they trade at a discount. And second reason is, tomorrow, whosoever will purchase unit now, he has to pay the management fees. So he recover that management fees from the buyer, from the seller. So these are the two reasons on account of which NAV trades at less than, ETFs trade at less than their NAV. Now let's take one practical example. There is one ETF, that is Bharat 22 ETF. Now this is by ICICI Mutual Fund. And now let's look at what is the NAV. Now currently the class NAV is, per unit value is 36 rupees 84 paisa. Okay. Now, but it's an ETF. If you want to buy, you want to sell, that is over the exchange. Now, if I put here Bharat 22 ETF, now in the market, currently the rate is 36.77. Now it is trading at a discount to NAV. What is the reason? First, liquidity is less. And second, tomorrow management is going to some charge fees. That fees, now till that time they're managing their money, your money, but now tomorrow I have to pay this fees. So I want to recover that from the seller. So on account of these two factors, ETFs trade at a discount to their NAV. Now, important point, when you can earn the abnormal returns. Now you can earn the abnormal returns. Now there's an anomaly, there's a deviation from market being efficient. You are buying a fund at less than their fair value. So this is another example of so in totality, these six anomalies you have to remember. Again, important from the point of view of theory. Can I proceed further? Now, last one is the consumer behavior. Okay. Now, it has been seen that in the market that the investors behave irrationally. So, market efficiency deals only with that market is efficient or not. But in the past, it has been seen that the investors, the traders behaves irrationally. Now, before I jump to the main points, so these are all the points are double star. Okay. Now, before I jump to the main points, let's understand one of the scenario of consumer behavior, how consumer behaves. Now, my point is, first time the navigation system was launched by audio-based navigation system was launched by BMW in the cars, and that was launched in the country Germany first. Okay. Now, despite this navigation system is 100% accurate, internet is available free of cost, user friendly. Despite that, it is being 100% accurate. Germans are not using this navigation system. Now, my question is why? 100% accurate, user friendly, internet is free of cost. Despite that, people are not using, and people don't know the way as well. And despite that, they're not using, and Google was not there. Navigation system from Google was not there. And despite that, people are not using it. Now, so why? The people are not using this navigation system. Okay. Now, my point is, let us assume that they have invested somewhere close to $1 billion on this technology and a product by BMW. So BMW itself is a brand, and they're confused that why people are not using. So the reason was very simple. There was only single stupid reason. Now my point is, now my point is, this example is anyways not important. ठीक है? तो जिन बच्चों को हिंदी नहीं आता, can I use हिंदी? So now, despite being 100% accurate, लोग यूज नहीं कर रहे. अब दिक्कत क्या है? दिक्कत बड़ा सिंपल सा दिक्कत है कि जैसे ही नेविगेशन सिस्टम ओपन हुआ, देयर वाज अ फीमेल वॉइस. नाउ अब जर्मन्स कह रहे हैं इतने गंदे दिन आ गए हैं कि लड़की से रास्ता पूछना पड़ेगा, इतने गंदे दिन है हमारे. उन्होंने कहा हम इस नेविगेशन सिस्टम को यूज ही नहीं करते. डिस्पाइट ये एक्यूरेट है, डिस्पाइट दिस इज 100% एक्यूरेट, यूजर फ्रेंडली, XYZ फैक्टर्स आर देयर, हम इसे यूज नहीं करते बिकॉज देयर इज अ फीमेल वॉइस. नाउ माय पॉइंट इज, सोचो यही प्रोडक्ट इंडिया में आया, सेम प्रोडक्ट लॉन्च्ड इन इंडिया एज वेल. नाउ जब इंडिया में आया, and class this is based upon true facts, I'm not exaggerating. Okay, this product when come to India where people are illiterate, internet is expensive, and this navigation system is not accurate, and in India it becomes a hit product. Now my point is, now imagine your classes, school class जो भी करा है उसको imagine करो, especially boys imagine करो. In your class majority of बॉयज थे या गर्ल्स थी आपकी क्लासेस में थ्रू आउट एंटायर करियर? आपको किन से आपका पाला पड़ा है? सो एक वो कहता है ना कि हम तो इतने, चलो छोड़ो उसको रहने दो. तो हमारा किससे पाला पड़ा है? नहीं, गर्ल्स कॉलेज में नहीं, गर्ल्स कॉलेज में नहीं, अधिकतर मेजोरिटी ऑफ द केसेस मेट्रो में जाओ, क्या मिलता है हर जगह आपको? क्या मिलता है? लेडीज डिब्बे में नहीं, लड़कों वाले डिब्बे, मतलब जनरल डिब्बे में क्या मिलता है? हर जगह आपको इंडिया में लड़के ही लड़के हर जगह मिलते जाएंगे. ना मैं पॉइंट इज, इस लड़कों की भीड़ में अगर कोई लड़की हमसे बात करे, हमें कैसा लगेगा? इन लड़कों की भीड़ में हम बड़े दुखी हैं और एक लड़की हमसे आके बात करे और मैं आपको बोलूं कि यार ये तेरे से ना, मतलब तेरे को गलत ले जाएगी, जहां पे भी ले जा रही है. फॉर एग्जाम्पल मेरे पास स्कॉर्पियो, मैं गाड़ी में बैठा हूँ, मैंने नेविगेशन सिस्टम लॉन्च करा और मेरा दोस्त कह रहा है कि भाई ये तेरे को गलत ले जा रही है. ना मैं पॉइंट इज, क्या आप गलत जाना चाहोगे? एक लड़की आपको गलत ले जा रही है, भाई क्यों नहीं जाऊंगा, जहां भी ले जा रही है जाऊंगा. मैंने कहा तेरा लेक्चर मिस हो जाएगा. मैंने कौन सा बन के राकेश झुंझुन वाला बनना है? और 1-2 मिनट लेट हो भी गया तो क्या फर्क पड़ता है? Now my point is this basically on account of one, consumer behavior. There is no fault with the product. The product is 100% accurate only since in one country it is based upon female and they don't want to take directions from a female. That is the only reason for the failure of the product. Now my point is, in the market, in this chapter we are only learning about market efficiency. There could be scenarios where investors are behaving irrationally. Now we have to discuss about consumer behavior. Class, am I clear with the example of consumer behavior? So it's not necessarily that always the behavior by the consumer is going to be rational. Okay. Now, number one is information cascade. Now, what is the meaning of information cascade? Now, today there is a news, information cascade. Now, today there is a news that Rakesh Jhunjhunwala buys 5% stake in Tata Motors. So this is the news. Based upon the yesterday's block deal, Rakesh Jhunjhunwala buys 5% stake in Tata Motors. Now today share will go up or down only based upon this information. Now only based upon this information, share will go up or down only based upon this information. There is no further news with respect to the stock. Rakesh Jhunjhunwala buy 5% stock in Tata Motors. Now my point is, what do you mean by information cascade? The meaning of information cascade is when the other investors in the market are replicating an informed investor. So this is known as when the other investors in the market are replicating the informed investor. This is known as information cascade. Now it's in a way is improving the market efficiency. Now, किस context में उन्होंने लिखा why it improves the market efficiency? Because he's an informed one, he's an informed investor, he has performed his thorough research, and if the other investors are replicating it, that means they're creating a buying pressure. That means it will sooner come to its true intrinsic value. That means if you're copying the informed trader, it will eventually promote the market efficiency. Same wise, there's every day you will find this block deal. Now there's another block deal. Let us assume that that HDFC mutual fund increases the stake in Maruti Suzuki. Okay. Or there was one more news that Facebook invested 10% in Reliance Jio for X amount. And my point is, if this news is available in the public domain, what will happen with the stock like Reliance? Stock will Reliance, and they will keep on increasing. And this is known as information cascade. Now go through bullet number 1. Now, next point is loss aversion. Now, investors dislike losses more than the comparable gains, and such a behavior is observed in overreaction market. So now, loss aversion, we dislike losses more, and it is observed in overreaction market. Now my point is, there was a lockdown. Okay. Now there was a lockdown, and definitely the business of every other entity is going to be, every other company's profitability is going to be under struggle. Okay. So on account of complete lockdown in the country. Okay. And now entire stock market have fallen, and stock market more or less have fallen by, Nifty was at around 14,000 and it reaches 7,500, and the entire stock market fallen by 40%. Now my point is, on account of lockdown, a stock like PVR falls. Correct? Incorrect? So is it business of PVR hampered during lockdown? So this was the correct decision. Okay. it was good that a stock like PV had fallen because now no films are going to be released. Their profits is going to remain under pressure. They have to pay rentals. They have to pay their debt. Correct. Okay. Now a stock like Airtel falls. Now there's a complete lockdown. This company is into the telecommunication business, or a stock like Geo. So though Geo is not listed, so Airtel. Now during this particular period, you have consumed more of internet or less of internet when the entire country is in the lockdown. So now profit should increase, profit should reduce. High consumption, lower consumption. So definitely there's going to be higher consumption. Now maybe it's saying hypothetically. Now Britannia company posted a 50% growth in their profits. And as per the management commentary, the biscuit consumption during lockdown has almost doubled. Now there was a lockdown. And during lockdown, do you think that the business of FMCG companies are going to be hampered? No. But again, during lockdown, these companies have also fallen. Now, why they have fallen? Now, my point is, we dislike losses more. The moment there is a fall, we are now not in a capacity to hold this fall without thinking that whether the business is going to be hampered or not. It's 10% correct a stock like Maruti to fall, a stock like PVR to fall, a stock like Tata Motor to fall, because their business in a way are going to be hampered. But what is the rationale for a stock like Airtel to fall? Now another point. Now what is the business of Muthoot? Now again, the entire Nifty bank has fallen. Entire financial stocks were under pressure. Now why the pressure? Because there's a possibility that you won't be in a position to repay the loan. So their NPA may increase. And NPA eventually has increased for a bank like Bandhan. But now understand the business model of Muthoot. Now how Muthoot works. First, you have to give me, let us assume that you have pledged 40,000 rupee loan, or 40,000 rupee gold. Against this pledged gold, whatever the value is, against this pledged, we are going to lend you 20,000 rupee. Now my point is, LTV is 50%. Now what is the meaning of LTV 50%? Against the value of asset, we are only giving you 50% loan amount. And any idea what was happening during the lockdown? Gold prices were increasing or decreasing? Gold prices during that particular period. Now, during that particular period, gold prices were continuously increasing. Now, my point is, if continuously the prices of gold, 40,000 become 50, 50 become 60, hypothetically, my point is, if the prices of gold are continuously increasing, a stock like Muthoot should fall. Any reason NP of this company can increase? Any logic of NP of this company will increase? Answer is no. But even a stock like Muthoot, it was trading at 800 rupees. It was trading at 800 rupees. And during the lockdown, it touched 400 as well. And now again, it is trading at 1300. And my point is, this reaction is on account of loss aversion. Why loss aversion? The entire market is falling. Now we think that now the market will come to an end. The business of this company is not hampered at all. The entire market is falling, and on account of overreaction, we keep on selling. As a result, a share of 800 reaches 400. This is not a single reason for the stock to fall. But now again, upon consumer behavior, the stock touches a value of 400. There's a selling pressure. This selling pressure is on account of which consumer behavior? This selling pressure is on account of which consumer behavior? This selling pressure is on loss aversion. We dislike losses. The entire market is falling. Maybe Muthoot may fall as well. We dislike losses. The moment you are disliking losses, there's no rationale for selling except for overreaction. So this is an example of loss aversion. So class, we have covered 2 points. Today, Rakesh Jhunjhunwala buys 5% stake in Tata Motors. You have also purchased the same stock. This behavior is known as herding or information cascade. Very good. Second, there is no rationale for Mathud or for Airtel to fall, but since the entire market is falling, these stocks eventually seen the selling pressure. This is an example of over. This is an example of loss aversion and overreaction. Now go through point number 2. Point number 2. Okay, now next one is investors over confidence. Now let us assume that this time budget was very good. Okay, but let us assume that today the budget is very bad, and specifically from the point of view of banks. Now, if the budget is bad, then entire banking stocks are going to fall. But one bank will fall less. Now, there are two banks. Let us assume a bank like PNB. Okay, there's a possibility of increase in PA, or they're going to increase the trading cost, XYZ. All these banks will fall definitely. But one bank will fall less. That bank is going to be everyone is falling in the market. Everyone is falling. But that bank will fall less. Now, which bank is going to be? That bank is going to be HDFC. Now, my point is why HDFC will fall less in comparison to the other banks, like even the other banks like Kotak, ICICI, every other bank in the market. Now the point is, this is the biggest player. This is the largest player in the banking industry. And we may use this word. These banks are large enough to fail. So this typically we use this kind of language. A bank like HDFC is large enough to fail. Now my point is, same wise, if you go 20 years, 30 years back, same sort of confidence like we're having right now over HDFC, which bank demand this kind of confidence? Now, keep in mind your grandfather. So your grandfather has an accountant. So he has a preference for one particular bank, your grandfather, father. Now they're mad for a stock like SBI. Same wise, when it comes to car, we have one preference for one particular brand. That brand is Gaadi ho to ye ho. That brand is Maruti. Same wise, now my point is, that means now a stock like SBI, if you see the last 20 years return, SBI has not delivered any sort of return. Okay, so return kuch bhi nahi hai SBI ke case mein. Now my point is, even if there is a negative news with respect to HDFC, a negative news, do you think there's going to be a heavy selling pressure on this stock? Do you think there's going to be heavy selling pressure on the stock? The answer is no. And this is on account of investors over confidence. Now, this typically would be seen in those companies which are consistently delivering a good returns. And even if there is any negative news with respect to this particular company, the investors has the behavior of overlooking or ignoring that particular news. So this is known as investors over confidence. Now, this behavior has been observed in case of higher growth company, where investors are slow to factor in any negative news. Now, fourth one is mental accounting. Now, my point is, we Indians do have this sort of tendency as well, where we perform mental accounting. Now, my point is, let us assume that I'm continuously saving money, or let us assume that I'm very confident on one particular stock, that is HUL. And I think that during lockdown, it touches 1700. The business is not hampered, and I'm very bullish, and I strongly have the rationale that one day it will reach 2600. with strong reasons that it will touch 2600. And let us assume that I have a very good experience in the stock market as well. Okay, but right now I'm not having adequate funds, but I'm having one asset, that is my own house. Okay, the house value is 2 crore, and these are the correct values. Okay, my house value is 2 crore, and if in the same locality I take a premises on rent, the rental is going to be 20,000. So this is easily available. Now my point is, what my mind is saying, let's invest now. So if HUL becomes 2600, appreciation of how much? Appreciation of how much? Appreciation of nearly 50%. Or अगर मैं, if I'm investing 2 crore, my target is within 1 month, within 1 year. So 2 crore will become 3 crore within 1 year. This is my target. Okay. Now my point is, within 1 year, I can make a profit of 1 crore. And over 1 crore, I have to pay a rental of only 2,40,000 in the entire year. Now my point is, will my father allow me to sell this house and buy HUL, even if I give a guarantee like this? This one day it will become 2600. Let's sell the house. Let's move to a rented premises. Any day we have to pay a rental of 240. Now what you are performing? Now you're performing a mental accounting. Now you're performing a mental accounting. Now what your father will say based upon his experience, if it is like this, then everyone would be in the market selling his house and buying the HUL. So I don't think that you're smart enough, and I won't be allowing you to sell the house. Plus, am I correct with this? Now pick up any single stock. Pick up any single stock during the period of lockdown. Any other stock, any given stock. Every stock in the market has delivered a return close to 100% during this lockdown. Be it be any stock, Reliance, TCS, HDFC, be it be any stock, any even mid cap, small cap, any given stock has delivered a return equal to 100%. But why we don't do such kinds of activity? This is again on account of mental accounting. Now my point is, I want to prove one more point. Now, if you want to buy a house, the house value is 2 crore. Rental in the entire year is 2,40,000. So what is the rental yield? What is the rental yield? 240 divided by 2 crore. How much? Rental yield? नहीं, 12 थोड़ी होगा, नहीं. What is the rental yield? Now, rental yield is, plus in percentage term, 2,40,000 divided by 2 crore. 2,40,000 divided by 2 crore. So rental yield is 1.2%. Now my point is, you have two objectives. One, to buy a house worth 2 crore. Okay. Second, to invest in the stock market where there's a history of 50%, where you can earn 15% per annum. By default, majority of will prefer in the younger age buying a house or buying or investing in the share market. Now, what is the dream of your parents? To have a house or to have a HDFC bank, share of HDFC bank, if you're living in a rented house. So now we are again performing some sort of mental accounting, and based upon that mental accounting, again we behave irrationally. We may choose to buy house instead of investing in the market. So again, the behavior of investors is irrational. So point number 4. Now, next is disposition effect. If a stock is continuously falling, now some people has a habit of average out. Now, what is the meaning of average out? Now, the meaning of average out is the moment there is a fall, you will keep on buying. Now, for example, currently share is trading at 100, you bought one share. Now, yesterday, if it is at 80, now some people will try to average out. What is the meaning of average out? They will buy or they will sell. They will buy or they will sell. They will keep on buying more. Now, let us assume the price is 80. I will buy one more share. Now, earlier my average price was 100. Now my average price is, I'm having 2 shares, collectively invested 180, 90. Now let us assume share reaches 60, I buy one more. Now my average price is 240 divided by 3, that is 80, and so on. Now my point is, if we keep on doing average out on a stock like PC Jeweler, now what is the rationale we used to give? Now more of this, maybe we have trapped in a stock like Yes Bank, or we have trapped in a stock like PC Jewelers. So it was trading at a value of, Yes Bank was trading at a value of 350, and it eventually touched, I think, 5 rupees. Now my point is, if we keep on doing average out, average out, average out without any rationale, there could be possibility that eventually may end up in the losses. Now, maybe you people have incurred a loss in case of Yes Bank, PC Jewelers. And what is the reason of buying that? Without having the rationale, we say this kind of lines and we keep on buying. If you keep on doing the average out without having a rationale, could be possible in the companies where the corporate governance is weak, where the business model has impacted a lot, you end up making up the losses. So now the share 350 has not touched 5 directly. So the share was trading at 350, it reaches 200, then again 250, then again it reaches 5 rupees. So the movement is always like this. Now, what is the reason? Now, what is the reason for this jump? You don't have any rationale. You're basically buying that it has already fallen a lot. Now there's a time for reversal. So this is also known as bottom fishing as well. Now, my friends, bottom fishing is recommended. Keep on buying without any rationale. Only rationale is it has already fallen a lot. So answer is no. So bottom fishing is known as disposition effect. Then conservatism. We tend to be slow to react to new information. Now, for example, the news of coronavirus was in the month of December. But in the month of December, in the month of January, in the month of Feb, stock market was continuously increasing. And my point is, we are slow to react to new information. This is known as conservatism. Then representativeness. Representativeness means what has happened in the past will repeat itself in the future. This may or may not be true. For example, what is the rationale of buying HDFC? It is continuously giving a return of 15% every year. It will continue in the future as well. This is the rationale for HDFC. This is known as representativeness. And last, narrow framing. We don't have a broader view. We look at the issues from the isolations. That means we don't have a broader point of view while buying and selling the shares. So these are the consumer behaviors which has been observed in the market. 1, 2, 3, 4, 5, 6, 7, 8. Now all these points are double star, highly stable. With this, we have covered this chapter. Give a heading. Now today we are going to, what is the agenda for today? So today I'm going to complete 2 chapters. Both the chapters are going to be theory in nature and they're going to be pretty simple. The detailed part to be covered in level 2. Okay. But I try my level best to give justification by giving you more insights about a particular sector. Okay. Now give a heading. Reading. Company analysis. Company analysis. Past and present. हाँ एक बार फिर से रीड लिख लेंगे. Company analysis, past and present. Now, concept number A, research report. Concept number A, research report. Now, right? Research report can be of 2 types. Research report can be of 2 types. Number 1, it is known as initiating coverage. Then what is the name of second report? It is known as follow-up research report. Now, right, within initiating coverage. What is the meaning of initiating coverage? Point number 1, they are the detailed research report about a company. So what is the important word in initiating coverage? They are the detailed research report. It will cover financial analysis. It will cover financial analysis along with industry analysis. It will cover financial analysis along with industry analysis. Next point. Here we perform detailed comparative analysis. Detailed comparative analysis. Now my point is, whenever you're going to start your career, you want to learn about any company, the always prima facie step is to go through by the initiating coverage. Now let me show you one initiating coverage. Now I have a subscription of BQ Prime. Now here if I go to the research reports and I type here initiating coverage, now yesterday it was Urban Fashion. Now Urban Fashion, a focus player, attractive valuation, initiating coverage. Now if I click upon this, this is going to be a detailed research report. Now my point is, this is known as front matter. Now what is the meaning of front matter? Who has written this report? So this report is written by Himanshu Nair. Then what is the current market price? The current market price is 359. What is the target? Target is 515. And what is his recommendation? His recommendation is buy. Now these types of research reports are known as initiating coverage. Now same wise, if I again search on research reports, now there's a research report on JSW Steel. It is a report by Motilal Oswal. Now go through, have they used the word initiating coverage? No, that means it's a follow-up report. Now if I click upon this, report, what this report is saying, yesterday JSW Steel declared their result, Q2 result, then margins have improvised, beating the estimates. Now if I click upon this, now what analyst is saying? Now what analyst is saying? The current market price is 770. Our target price is 780. Upside is 1%, and our view is neutral. Neutral means we are not giving you any recommendation to buy the stock. Either it could be buy, it could be hold, it could be sell. Now they're saying that there's not much return is left. It is close to its target price. Then what is the recommendation? Recommendation is neutral. Now this will not be a detailed research report. It will only captures the new data which is available in the system. But what is the best part with initiating coverage? It is going to be a detailed research report. Now, right, follow-up research report. Follow-up research report captures new data available in market. Now, yesterday company declared their Q2 results. Is there a new data available in the market? Yes. Now my point is, yesterday ICICI Bank declared their results. The results were phenomenally well. Company declared a result of 10,000 crore profit as against estimates of 9,500. Now check yesterday, check tomorrow. There is going to be number of research reports on ICICI Bank. तो कल जब मंडे मार्केट खुलेगी, यहाँ पे एक बार ऐसे देख लेना. It is going to be a paid one. But what you will find the research report on ICICI Bank. You are going to find research reports on Kotak Bank. Even Kotak has declared the results yesterday. Now, as there is a new data available in the market, they are going to declare the results. Now, right, financial analysis. Within financial analysis, there are 2 points. Number one, net working capital. Net working capital. Number 2, degree of operating leverage, degree of financial leverage, and degree of total leverage. All right. Net working capital, degree of total leverage, degree of financial leverage, degree of operating leverage, financial leverage, and total leverage. Example. Number 1, company ROE 18% or 20%, which is better? ROE 18%, 20%, whichever is better. Not right. Investors are not crazy for profits. They are crazy for sustainable profits. Not right. Investors are not crazy for profits. They are crazy for sustainable profits. Again, I repeat. Today you have won 2 crore rupees by betting on Virat Kohli. Will your mother feel proud of you? Is your mother feeling proud of you? Answer is no. Is this 2 crore giving her the satisfaction? No. On the corresponding, if you get a salary of 2 lakh per month, that will give her more satisfaction. She will be thankful to the God. Now, what is there in 2 lakh which is not there in 2 crore? The point is that, sir, sustainability is not there. So we are not crazy for profits. We are crazy for sustainable profits. Now, right? ROE is equal to EAT upon equity. It is equal to EAT upon sales, sales upon assets, asset upon equity. Now, what are the first 2 terms? I don't know about it, but the last ratio is known as leverage ratio. Now, right? ROE should never be higher. ROE should never be higher because of leverage ratio. If it is higher, because of leverage ratio, if it is higher because of leverage ratio, it is not a sustainable or stable ROE. Now, this entire thing is known as dew point analysis. Where we are going to cover this? This we will cover in FRA. Okay. Shall I proceed? Now, right. Another example. Mr. A buys a stock for 100 with 2 possibilities, 80 or 120. Calculate ROE. It will be -20 to +20. What is leverage ratio? Leverage ratio is 1. Right, this is the minimum value. Leverage ratio minimum to be 1. It will always be higher than 1. Then write example. In previous example, now equity equal to 60, debt equal to 40. Calculate ROE. -33.33% to +33.33%. What is leverage ratio? That is going to be 100 upon 60. This is going to be 1.67. Now, interpretation of 1.67 is important. Now, write the interpretation. Now, write the interpretation. We are not going to invest into the companies. We are not going to invest into the companies where there is a debt. We are not going to invest into the companies where there is a debt. Debt comes with fixed obligation. Debt comes with fixed obligation. That is, whether you are making profit, or incurring loss. That is, whether you are making profit or incurring loss, you have to repay the loan. And if it is a loss, or gain, debt is acting as a catalyst. Debt is acting as a catalyst. That is, if there will be gains, those gains will be 67% higher. If there will be gains, those gains will be 67% higher. If there is a loss, that loss will be 67% higher. Now, my point is very simple. If you are not taking any debt, your volatility was -20 to +20. The moment you have taken a debt, is volatility increase? Yeah. Now, I don't like volatility. If I'm making a profit of 33%, still I'm not happy. This is one side. Tomorrow the stock can fall also. The losses can also be 33. So I won't be happy here. Leverage ratio here is? Now my point is 20% to be multiplied by 1.67. Am I getting the same numbers? So volatility has increased by 67%. Now what student says, sir, name any company in the steel sector, in the electricity sector, in the real estate sector, which is debt-free. Now Adani Enterprise, if I go in the steel side, Tata Steel, JSW Steel, these are capital intensive business. There's not even a single company which is debt-free. And yes, I'm saying that we are not going to invest in the companies where there is a debt, because debt comes with fixed obligation. It is going to make the earnings highly volatile. So I'm not going to invest into the companies where there is a debt. Then what is the another counter question? Then why other people are investing into? This is again beyond my scope to explain. But what is within my scope, I'm not going to invest my money into the companies which is debt-free. This rule is not applicable on financial companies. Now, there will not be any bank with no debt or any NBFC with no debt. So it is not applicable to banks and the NBFC sector. But yes, any manufacturing company, any service company with a debt, I'm not going to invest into. Why others are investing? That is beyond my scope to explain. Almost debt-free. A company has a market cap of 80,000 crore. Company has a loan of 1,000 crore. So keeping in mind the market cap, loan is nothing. चलिए आगे लिखेंगे. Example. In finance, right? Example. In finance, fixed cost is known as leverage. In finance, fixed cost is known as leverage. The next slide. In business, cost can be of two types. In business, cost can be of two types: variable cost and fixed cost. variable cost, and fixed cost. Now my point is, this is my classroom. It has a sitting capacity of 50 students. Whether this is a 0 student or 50 student, do I need to pay fixed amount to my landlord? So it is a cost of which nature? Fixed. Suppose I'm providing you with calculators. If there will be one student, how many calculator? If there will be 100 students, that means it's a. Now my question is very simple. In a business, it is good to have variable cost or fixed cost. In the business, it is good to have fixed cost or variable cost. Business, it is good to have fixed or variable cost. Okay, now right. चलिए लिखेंगे एग्जाम लिखेंगे we never invest into the companies. So this statement is true with initial stages. Okay, companies into the initial stages. So we never invest into the companies where there is a fixed cost. Again, I repeat, we never invest into the companies where there is a fixed cost within bracket initial stages. Initial stages. Now my point is, you want to start your business, you want to open up a restaurant in Connaught Place. You go and discuss with your father. What will be the first question of your dad? That in this business, there's going to be huge amount of fixed cost. What is the fixed cost? Number one, they're going to be rentals. Now your father will say, if there will not be any customer, will you end up into the loss? But on the corresponding, if the landlord says, I'm going to charge 20% of the sales. If sales is 100, how much he will charge? If sales is 0, how much he will charge? That means maximum. What can be the loss? Your losses are restricted to 0. But if it is a fixed cost, there's a possibility that you end up into losses. Yes. Now the classic example is, right, in the footwear sector, Bata and Relaxo are the market leaders. In the footwear sector, Bata and Relaxo are the market leaders. COVID happened, and in the country there is a lockdown. COVID happened, and there is a lockdown in the country. Which company's profit hampered significantly? Which company's profit hampered significantly? Make a guess. Now the answer is Bata end up into losses. Now my point is, if you go to any good shopping mall, DLF Mall of India, GIP or Vasant Kunj malls, do you find the store for Bata? Yes. Do you find the store for Bata? बाटा के स्टोर्स आपको दिखते हैं नहीं दिखते हैं? और जितनी पॉश मार्केट है वहां पे सब पे जगह आपको बाटा का स्टोर दिखता है. And all the stores are on rented basis. Now my point is, COVID happened, sales is 0, you're still paying rent. What happened? You end up into losses. How many of you have seen the outlets of Relaxo? Now Relaxo business model is something different. How Relaxo sells the product? Relaxo does not sell through its own outlet. They give the product to the retailers, and retailer will sell in the market. Now the burden of rent is on retailer. But what happened in case of Bata? Bata has its own stores. The burden of rent is on. Now the classic example is, during the period of COVID, Bata end up into significant losses. During the same period, Relaxo books significant profit. Now another reason why COVID hampered Bata in a more way, because Bata manufactures formal shoes, but Relaxo manufactures mainly slippers. During the period of COVID, the usage of slippers have increased significantly and the use of formal shoes have declined significantly. Now, let me show you the financial statements of both the companies. Now, so we are talking about FY21. Okay. Now, first is Bata India. Now help me. 21. Company booked a loss of 89 crore. In 20, company profit was 300 crore. Then there is a loss of 90 crore. Then 102 crore, 300 crore, still 300 crore. That means still this company has not making profit what it used to make in FY 20. Now let me show you for Relaxo. Now FY 21. Have they beat the numbers despite it's a COVID? In 20, profit is 226 crore. What is the profit? 291 crore. On the corresponding, Bata end up into losses. Now, why Bata is making the loss? Number one, their sales hampered because their product mode line is of formal shoes. Second reason is majority of the stores were on rental, and the burden of those rent is on the Bata. But this is not the case with Relaxo. In Relaxo, the burden is on the retailers. That is why Relaxo books the profit and Bata ends up into losses. So we never invest into the companies where there is a because if there's a fixed cost, there's a possibility you end up into. But if it's a variable cost, the possibility of ending into losses, that is going to be 0. You will never make a loss. Maximum profit and loss is equivalent to 0 rupees. For example, in my class, there is no student. Sales is 0. What is the cost? 0. What is my profit? 0. But I have to pay a rent. There's 0 student. What is my loss? Assuming rent is 50,000, my losses will be equivalent to 50. Okay. Now, right. Another example. Example. Calculate degree of operating leverage, degree of financial leverage, degree of total leverage. First, I will calculate it and then we move to the interpretation part. Okay, not right. Selling price per unit 10 rupee. Selling price per unit 10 rupee. Variable cost per unit 4 rupee. Selling price per unit 10 rupee. Variable cost per unit 4 rupee. Shall I proceed? Then write fixed cost. Fixed cost will always be in totality. Fixed cost on the business is 300. Operating fixed cost, that means rent. Then financial fixed cost, that is interest, assumed to be 50. Tax rate 10%. Again I repeat, selling price per unit 10 rupee, variable cost per unit 4 rupee, operating fixed cost, example is rent 300 rupees, financial fixed cost, example is interest 50 rupee, and tax at the rate of 10%. Shall I proceed? Now write year 0 or year 1, year 2, units sold 100 units, 100 quantity, 150 quantity. Now, sales. Help me with total sales. Year 1, 1000. Total variable cost. Total variable cost. Now, this is known as contribution. So, what is my contribution? My contribution per unit is 6 rupees. Totality, my contribution is how much? 600. So, contribution is 600. Now, what is the meaning of 600? I earn 10 rupees from you. I'm giving you calculated of 4 rupees. So, net what I'm earning, that is 6 rupees. This is known as contribution. Now, my point is, my operating fixed cost, how much? 300. This is known as EBIT. Alternative name of EBIT is operating profit. Now, what is my operating profit? 300. Now you have to subtract one more cost. Financial fixed cost. How much? 50. This is known as earning before taxation. 250. Now you have to pay income tax at a rate of 10%. How much income tax you will pay? 25. What is your EAT, net profit? So again, I repeat, I started with sales minus resultant is, from that you're going to deduct operating fixed cost. This is known as EB, earning before interest and tax. Alternative name is, from that you're going to deduct interest, EBT. I'm going to deduct income tax. I arrive at EAT. Now please complete for year 2. Please complete for year 2. Am I clear with calculation to all of you? Please complete for year 2. The next, what I want, add one more column. Class, please add one more column. Percentage change. So I want you to complete 3 columns. Year 1, profit. Year 2, and column number 3, percentage change. Four 495. 495. Percentage change, help me. 50%, 50%, 50%, 50%, 0%, 100%, 0%, 220. One 20, 120, 120. Please check all the calculations. Please check all the calculations. So my profit for year 1 is 225. My profit for year 2 is 495. And eventually there's a percentage change of 120. All of you getting the same answers? Am I clear with this format? Okay. Now first I'm going to calculate some ratios. As of now, focus only on the formula. We are not focusing on interpretation part. Okay. Now right. Degree of total leverage. Degree of total leverage. Formula is percentage change in EAT upon percentage change in sales. Percentage change in EAT upon percentage change in sales. 120% divided by 50%. This is going to be 2.4. All right, interpretation of 2.4. If sales change by 1%, if sales change by 1%, EAT changes by 2.4%. Again, if sales change by 1%, EAT changes by. Now my point is on the performance of the company. Has performance improvised or not? As an investor, you're happy or not? As an investor, you're happy or not? As an investor, you're happy or not? Now my point is, there comes the dilemma that we think that sales has increased only by 50%, profit has increased by 120, company's operating efficiency has increased. Now this is incorrect. Now this is only the one side of the picture. Think logically, why the profits are increasing? Because on account of two factors. This cost has increased by how much? Despite sales has increased by? And operating financial fixed cost has increased by how much? Despite sales has increased by 50. Because of which your EAT is increasing by 120%. Now my point is very simple. In this scenario, sales has increased by 50%. Could be possible that sales can reduce by 50%. Now what will happen if sales reduce by 50%? Again, DTL is going to be 2.4. If sales increase by 1, EAT will reduce by 2.4. So again, DTL higher is not better. Why? Because it is volatile. Again, I'm saying that as an investor, I'm not crazy for profits. I'm crazy for sustainable profit. ये इसलिए ज़्यादा आ रहा है क्योंकि two cost has increased by 0% despite sales has increased by 50. This is one side. Sales can also be reduced by 50%. Now let's check what happened. Now leave some space here. Okay, leave the entire page. Now again write year 1, year 2, percentage change, quantity sold 100, quantity sold 50 unit. Complete the entire table. You will start with sales minus variable cost. Sales minus variable cost 50. Start with sales minus variable cost, contribution minus operating fixed cost, EBIT, minus financial fixed cost, EBT, minus income tax, EAT. So year 1 it is 225. ऐसे ही कर दीजिए, जैसा करे ऐसे ही कर दीजिए. इसका मतलब है 50 rupees loss is there, 5 rupees loss belongs to the government, 45 rupees belongs to me. Fair enough. This we covered in FR again. If it is a 50 rupees profit, you are paying 5 rupees. Same wise, we are saying that 5 rupees loss belongs to the government. How this is adjusted practically, allow me some time. So we are getting a profit of minus 45, correct? सही करे ना? There is a loss of 50. इसको assume करिए it is a profit of 50. 5 rupees given to the government, 45. सही करे ना? इसको प्रॉफिट ऑफ 50 मानिए, तो गवर्नमेंट को कितना दे दोगे? तो आपके पास बचेंगे कितना? अब सब नेगेटिव में, मैंने कुछ गलत करा है? चलो आगे, चलिए। एक मिनट, ये कैसे आया? आपने लिखा 250 माइनस 25 225। अब मैं क्या लिखना चाहता हूँ? -50 माइनस -5 -50 + 5। सही करा मैंने, चलिए। Shall I proceed? Now help me with percentage change. This is going to be minus 50%, minus 50%, minus 50%, minus 50%. Now 0. It will fall by 100%, 0%. It will fall by 120%, 120%, and 120%. Let me verify the numbers. So what is the way to calculate? It is very simple. How we calculate all the changes? This number divide by this number minus 1. So please check, am I getting negative 120 here? This number divide by this number minus 1. Am I getting 120%? Am I getting 120%? Now again calculate DTL. DTL will be how much? Percentage change in EAT, 120%. Percentage change in sales, 50%. Again, this is going to be 2.4. Now what it's signifying? It is signifying that if sales fall by 1%, EAT will fall by 2.4%. That means what I'm trying to say is higher DTL is not good. DTL should be close to 1. If it is higher, it is signifying that profits are going to be volatile. If there is a gain, those gains will be higher, one side of the picture. If there will be losses, then losses will also be higher, because two costs are constant. They are not changing at all, because of which there will be volatility. तो हमें क्या हो जाएगा? फिक्स कॉस्ट की वजह से volatility बढ़ जाती है. Am I clear with this part? Now write degree of operating leverage, degree of financial leverage. Now this leverage captures two costs. One is rent, one is interest. Degree of operating leverage will only capture the impact of rent. It will only capture the impact of, not right, percentage change in EBIT upon percentage change in contribution or sales. Now help me, how much EBIT is changing? How much EBIT is changing? How much sales or contribution is changing? So what will be the answer? This will be 100%. This will be 50%. This will be equal to, now write the interpretation. If sales increase by 1%,
If sales increase by 1%, EBIT increase by 2%. This is one side. Write the corresponding statement. If sales fall by 1%, EBIT fall by 2%. So is it stable, volatile? It is volatile. We never like fixed operating cost. Same wise, write the formula here. Percentage change in EAT or EBT upon percentage change in EBIT. Now help me. EBT or EAT. What is the change? 120. What is the change in EBIT? So what will be the ratio? 120 upon 100. How much? 1 point. And right here, DTL is equal to DOL into DFL. 2 into 1.2. Am I getting 2.4? Degree of total leverage is equal to degree of operating leverage into degree of financial leverage. This is equal to 2 into 1.2 equal to 2.4. Now write the interpretation for this value. If EBIT increase by 1%, EAT will increase by 1.2%. Now, it is very simple to derive the formulas. Now, look very carefully. Till this point, is there any change? Sales changes by, variable cost changes by, contribution changes by. That means we cannot use anything. But EBIT changes by. Now, what will be the formula for degree of operating leverage? Try to make a formula. Percentage change in. This number will always be greater than 1. Percentage change in EBIT upon percentage change in contribution, variable cost और formula बन गया. अब same wise formula for degree of financial leverage. What will be the formula? Percentage change in EBT or EAT divided by percentage change in EBIT. And last formula would be simple, this 50 and 120. What will be the formula? Percentage change in EBT or EAT divided by percentage change in formula. Again, I want to repeat very carefully. 50, 50, 50, 0, 100. What will be the formula for degree of operating leverage? Percentage change in EBIT upon percentage change in sales or contribution or variable cost. Correct? Then 100, 0, 120. What will be the formula for degree of financial leverage? Percentage change in EBIT, percentage change in EBT or EAT divided by percentage change in. Now my point is, now I want to capture the impact of both of them. What will be the formula? Degree of total leverage, percentage change in EAT upon percentage change in. Clear hai? Now right. Formula for all three. Right, formula for all three. If right here, if it is very simple, if EBIT changes by 1%, if EBIT changes by 1%, EAT changes by Now write formula for degree of operating leverage. Help me. Percentage change in sales contribution. Next, formula for DFL, percentage change in EBT or upon percentage change in. The next formula for DTL. Number one formula, multiplication. Help me with that multiplication formula. DOL. Then another formula, simply multiply this and this will get cut. What will be the final formula? Percentage change EBT or EAT divided by sales contribution and write a note, most important. Write a note, most important. Practically, for small cap stocks. So I'm not talking about large cap. I'm talking about small cap. Note, practically for small companies such as Bata, Relaxo. Now, Bata has a market cap of 20,000 crore. Okay, sir, why you're using the word small? So this I'm comparing with Reliance TCS. Okay, now for small cap stocks like Bata, Relaxo, we always want DOL, DFL, DTL close to 1. This rule will not applicable for large companies because they're already operating at profit. Their chances of incurring loss is very less. So what I want them to be close to 1. Am I clear with this? Not right. Alternative formula. So right here, okay, just right here, alternative formula. Now again, it is very simple. You know that answer will always be greater than 1. Okay. Now what will be the formula? Now right. DOL is equal to contribution upon EBIT. That is 600 divided by. Answer will be. Please verify. Are we getting the same answer? Contribution upon EBIT. Are we getting the same answer? Same wise, frame the formula yourself for DFL. 300 upon 250. Verify. Are we getting 1.2? Verify. Are we getting 1.2? Again, I repeat. This is the part capturing the fixed cost. What will be the formula for DOL? 600 upon 300. What will be the formula for DFL? 300 upon 250. What will be the formula for DTL? 600 upon. Verify. Are you getting 2.4? So again, it is very simple. Again, it is very simple. Help me with the first alternative formula. What shall I write here? What shall I write here? Contribution upon EBIT. Alternatively, you can say contribution minus operating fixed cost. Then it will be EBIT upon EBIT minus interest. Alternatively, you can say EBT. And then finally, multiplication. What formula we arrive at? Contribution upon चलिए help करेंगे now. Last time. Come to the backside of the notebook. Come to the backside of the notebook. How many formulas? 3. Write DOL. Write DOL. Simply write DOL, DFL, DTL. Using this part, help me with the formula. DOL, DFL, DTL. Using this box only, help me with the formula. Contribution upon EBIT. Then second, EBIT upon EBT. Third will be contribution upon EBT. Now, help me with using this part. Help me with alternative formulas. Percentage change in upon percentage change in. The next one will be percentage change in upon percentage change in. And last one will be percentage change in EBT upon percentage change in. So just focusing on this part of the table. Just focusing on this part of the table, you are able to frame all the formulas. Only point that you have to remember is all these 3 figures will always be greater than 1. All of you getting the formulas? Take 2 minutes, please revise. Any doubt, please let me know. ये फॉर्मूले बन गए हैं आज आपने टेस्ट कराया आगे आगे डालनी आपके 93 चैप्टर्स हैं पर इसमें तेज क्या कराया है वैसे मैं समझा नहीं अच्छा तो आपने एक्सप्लेन नहीं कर आज अष्टमी इसलिए मैं तेज हूँ गिरी मैम आपको दिखाया ना पीक्यू प्राइम के अलावा हम सारे पेड सोर्सेज ही रहेंगे बट definitely I can download the reports and I can share on the WhatsApp group. Reliance जैसे stocks आपको नहीं करने you have to do those stocks which are into single line of business. Example Bata, Relaxo, Polycap. Even Reliance is not giving any good returns if you see. So research for those business into single line of business. Tire sector is there. Footwear में Bata, Metro, and टायर में C8 अपोलो, पॉलीकैप हेवल्स, चलिए ना, प्लीज राइट, प्लीज राइट, प्लीज राइट market size, please write market size. It is the summation of, it is summation of, it is the summation of revenue of all the companies. It is the summation of revenue of all the companies plus goods imported into the country, plus goods imported into the country. Now, if I say that tire sector size is 5,000 crore, what is the meaning of this? If I sum up the revenue of all the companies plus including imported goods, then how many tires are sold in a country? That is going to be 5,000 crore. Now, right, market share. Market share of MRF is 20% in tire sector. It signifies if size of industry is 5,000 crore, if size is 5,000 crore, then MRF revenue close to 1,000 crore. So one word is market size, one word is market share. Shall I proceed? The next slide. Net working capital is equal to debtor days, or is equal to debtor plus inventory minus creditor. Net working capital is equal to debtor days plus inventory minus creditor. Now, we want debtor to be, we want creditor to be, we want inventory to be lower, we want inventory to be lower till that time it is not impacting sales growth. Now my point is net working capital equal to 0, positive, negative. Now net working capital, if it is negative, that means you are the market leader. Now my point is, classic example is Maruti. Now Maruti sell the car to Vikas. So Vikas is debtor for them. Vikas is customer. Will Maruti offer me any sort of credit period? No. Will Maruti offer me any sort of credit period? You have to pay upfront, or you can take loan from a bank, but you have to pay me upfront. Correct? Same wise, Maruti buys tire from JK Tire. JK Tire is supplier. Do you think that Maruti has the power to take credit from JK Tire? And do you think that Maruti will say, I'm going to pay after 2 months and JK will agree? Because there's more competition. If you're not going to agree, then I'm going to give contract to somebody else. Now my point is, in case of Maruti, creditors are high, debtors are A. What is their net working capital? Their net working capital is negative. Same wise, go to any showroom of Maruti. Today you want to buy any CNG car. Will they give you the delivery? Will they give you the delivery? They're all the models, particularly CNG cars, they have a minimum waiting of 3 months. If they have a minimum waiting of 3 months, it signifies that the product is in great demand. Now, what is the working capital of Maruti? Maruti inventory is Inventory is 0. In debtor is, but they have creditor in the books. That means it is the market leader. Not right. Debtor, lower the better. Debtor, lower the better. It signifies you have more bargaining power with your customers. Creditor, higher the better, signifies more bargaining power with suppliers. Inventory, lower the better, till the time it is not impacting sales growth. Now, let me give you one more example of Wall Street. For Wall Street, who is the customer? Students are customers. Have they offered you any sort of credit period? Pay after 1 month, after 2 months, after 3 months? No. So in the books of TWSS, what is debtor? Who is the supplier? मैं supplier हूँ. मेरे को पेमेंट अपफ्रंट मिल जाता होगा. मेरे को कब मिलता होगा? महीने के आखिर में, 6 महीने बैच चल रहा है, महीने के आखिर में पैसे दिए तो मैं भाग जाऊंगा, बड़ा ही ऑब्वियस है, और मैं भागना भी चाहता हूँ. तो दे विल पे मी एट once my batch is completed. Okay, now my point is they are stopping my payment, but from the customer they receive the money on day 1. They have more bargaining power with their suppliers, they have more bargaining power with their customers. मैंने कहा मैं नहीं पढ़ाता, उन्होंने क्या कहा, दूसरा टीचर ले आएंगे. सेम वाइज आपने कहा मैं पैसे नहीं दूंगा, तो उन्होंने कहा कोई दिक्कत नहीं, आप दूसरे इंस्टीट्यूट चले जाओ. That means they have more bargaining power with the supplier, they have more bargaining power with the customers. Am I clear with this? Same as your teachers in your schools, they get salary at the end of the month, but your parents used to pay the quarterly fees. They receive the money at day 0, but teacher receives the money at 31st day. Now this is an example of they have more bargaining power with the suppliers, they have more bargaining powers with the customers. Am I clear? Now, absolute numbers. I scored 10 marks, 11 marks. Which one is better? This is out of 10. This is out of 100. So absolute numbers are not. What is comparable? They are going to be ratios. Not right. Calculate debtor days. Calculate debtor days. Now, calculate debtor days. Debtor is equal to 100. Sales is equal to 1000. Now, what is the meaning of this? To the customers, you make a sales of 1000 rupees. They have paid 900 rupees. How much still is receivable? That is going to be 100 rupees. Am I clear with the meaning of this? Not right. Debtor as percentage of sales equal to 10%. Now assume this is company A. For company B, this is 25%. Which company you will invest into? Which company you will invest into? Now, what is the interpretation? If sales is 100, 10 is still receivable. How much this company has received? If sales is 100, how much is receivable? 25. How much they have received? Now, which company you will invest into? Now, I'm going to invest into company A, क्योंकि यहाँ पे पैसे डूबने का डर सिर्फ 10 रुपए है. यहाँ पे पैसे डूबने का डर कितना है? That is going to be 25 rupees. So invest into company A. This answer is in percentage. Same answer we can calculate in terms of days also. Not right. Not right. Debtor days. This is equal to, in a year, there are how many days? 10% into 365. 36.5 days. Now write the interpretation. Write the interpretation of this part. Interpretation number 1. If we sold goods of rupees 100, if we sold goods rupees 100, how much payment we have received? We have received a payment of 90 rupees and 10 rupees yet to be recovered. Am I clear with interpretation 1? Am I clear with interpretation 1? Now write interpretation 2. In entire year, there are 365 days. There are 365 days. We have received payment for sales of 328 days. 328 days. And payment for 37 days of sales. And payment for 37 days of sales yet to be received. So it's very simple. One answer is in percentage terms and one answer is in days terms. Am I clear? Same wise, right? Calculate creditor days. How many steps? 2. Step number 1, creditor as a percentage of purchases. Step number 1, multiply by. Same wise, calculate inventory days. Now, before I jump to that inventory days, all of you have inventory of wheat in your house. आटा है सबके घर में. मैदा. Now compare atta versus maida. Which quantity you have more in your house? Quantity of maida, quantity of atta. Why atta more? Because the consumption is more. That means it depends upon, inventory depends upon consumption. During the period of Navratri, those who eat non-veg, what is inventory of chicken? 0. Why? Because consumption is 0 during the period of Navratri. अब हम सब wait कर रहे हैं बुधवार आएगा तो हम खाएंगे. So again, once the consumption is there, then we are going to have the inventory. Now, right. Step number 1, inventory as a percentage of consumption. Alternative name of consumption is cost of goods sold. Step number 2. Answer in step number 1. Multiply by 360. So again I repeat, debtor is calculated on sales. Creditor is calculated on and inventory is calculated on. Now write a note. Write a note. Note number 1. Write a note. Note number 1. COGS or consumption is equal to opening stock plus purchases minus closing stock. Now suppose you have 5 kilo of atta already at home. Your father has purchased 15 kilo more. Still you have 2 kilos. So how much you have consumed? That is going to be 18. So again I repeat, consumption is equal to opening stock plus purchase minus closing. Right? Note number 2. Whenever calculating any ratio, whenever calculating any ratio in the format of P&L upon balance sheet upon P&L, always take average of balance sheet item. Now, go back home in your class 12th, you referred T.S. Garewal ratios chapter. Go through all the ratios. Wherever the teacher has calculated any ratio in the format of P&L upon balance sheet, he used to take average of balance sheet item. Now, why we used to take average of balance sheet? Now, need not to write. Interest is 10 rupee. Opening loan is 100. Closing loan is 200. Again, I repeat. You are paying an interest of 10 rupee. Opening loan was 100. Closing loan is 200. I want to know your interest cost as a percentage of loan. एक बच्चा बोलेगा 10 upon 100. One will say 10 upon 200. One will say 10 upon 150. In all the three answers, some assumptions are involved. Let us understand this. Now, student A. Student A says 100, 200. How much you have borrowed during the period? 100. Now, what student A is saying, this 10 belongs only to this 100. That means additional 100 has been borrowed. So, assumption of student A is additional 100 borrowed at end. Student B says this 10 belongs to 200. 100 has been borrowed. So here, additional 100 has been borrowed beginning of the year. Now another student says 150. Meaning of 150 is additional 100 has been borrowed uniformly over the period. Which assumption is more realistic? Beginning, end, uniformly. Beginning, end, uniformly. Now, whenever you're going to calculate any ratio, ये P&L item है, ये balance sheet item है. Balance sheet item का क्या ले लेंगे? Average. Meaning of average is opening, closing, divide by 2. Same wise. Here, step number 1 is debtor upon sales. Debtor is balance sheet item. इसका क्या लेंगे? Average. Divided by sales. Next answer में क्या कर देंगे? 365. Same wise. Creditor, balance sheet item. What we will take? Average. Inventory, balance sheet item. What we will take? Average. Am I clear? Now right. Last. Important. Net working capital or right. Net operating cycle. Alternative name is cash conversion cycle. This is equal to debtor days plus inventory days minus creditor days. And if it is negative, you are the market leader. Now, now, let me show you for Hindustan. Now, if I go to ratios, please. Now, cash conversion cycle for the last 6 years, is it throughout negative? Is it throughout negative? Now, let's decode it. From the customers, you are receiving payment in. My focus is on FY19. From the customers, you are receiving payment in 14 days. Inventory you are holding for 50 days, close to 50 days. Correspondingly to the suppliers, you are making payment in 5 months. Your net working capital is negative. Another example, फिर से repeat करते हैं. From the customers, you are receiving payments at an interval of 14 days. You have an inventory of 50 days. And to the suppliers, you are making payment in 140 days. आपका net working capital कितना आ जाता है? That is going to be negative. Clear? Clear? Now let me show you for Apple. All the 6 years, net working capital, is it throughout negative? Now again, focus is on this year. The first column. To the customers, you are receiving payment in. What is the inventory? Inventory is only of 10 days. To the supplier, you are making payment in 120 days. Your net working capital is negative of 74 days. That means आपने औरों का पैसा ज्यादा रोक रखा है in comparison to your own money. This is the market power. Now my point is, if I check for Maruti, if I check for Reliance, if I check for any big player, you will always find negative. Now, are there many large players in the market? No. 99% will have a positive working capital. Only 1%, less than 1% of the companies will have a negative working capital. Examples are a handful of examples. Unilever, Nestle, Pepsi, Apple, they are the market leaders. But other than market leaders, for example, JK Tyre, C8, Apollo, XYZ companies, all of them are going to have a positive working capital. Positive working capital is not good. What is good? That is going to be negative working capital. Now, let me show you for Pepsi also. बच्चा कह रहा है बारबेक्यू ले लो, बारबेक्यू ले लेता हूं. हमारा पैसा रुका हुआ है और नेगेटिव का मतलब हमने किसी और का पैसा रोका हुआ है. अब इस पे भी बच्चा कहते हैं तो गलत बात सिखा रहे हो. फिर से रिपीट कर देता हूं. थप्पड़ मारना सही या गलत? गलत है. कोई आपके पापा को थप्पड़ मार दे और गलत है. आपके पापा किसी को थप्पड़ मार दे, सही है. सेम वाइज, कोई आपके पापा का पैसा खा जाए, आपको कैसा फील होगा? गंदा फील होगा. कोई आपके पापा किसी का पैसा खा जाए, अब पापा ने बात करी ना मर्द वाली, तभी तो मजा है. यही तो मेरे पापा हैं. अब कब अपने प्राउड, अब आप अपने फ्रेंड सर्कल में हो, कब आप अपने पापा की तारीफ करोगे? आप ये कहना चाहते हैं कि मेरे पापा का पैसा हर कोई खा जाता है या मेरे पापा किसी का खा जाते हैं? किसमें प्राउड है? दोनों में नहीं है. लेकिन अगर भगवान एक कर दे आपके साथ, आज भगवान बैठे साले जो तू बोलेगा वो करूंगा, तो आप क्या चाहते हो? भगवान से क्या मांगना चाहते हो? तो अष्टमी है, जो बोलोगे मांग दे दूंगा. भगवान का दो ही ऑप्शन है, या कोई तेरे बाप का पैसा खा जाए या बाप तेरा किसी का खा जाए. अब क्या बोलोगे? चलो बस, दोनों ही गलत है. तो आज बोल ही देते हैं सर, हे भगवान. बोलो आप, मैं तो नहीं बोलूंगा. मेरे साथ ऐसा हो जाए, मैं नहीं बोलूंगा, क्योंकि मैं तो यही चाहता हूँ कि भैया अगर पावर आए तो मेरे पापा किसी का रोके. मैं ये कहना चाहता हूँ. बट अगर किसी का कॉन्ट्रा भी हो तो बोल दो, वैसे ही अष्टमी हो जाएगा. मेरा दिल कहता है. सब लोग क्या बोलेंगे? अगर एक चूज करना हो, पापा किसी का खा लें या आपके पापा का कोई खा जाए पैसा? पापा किसी का खा लें तो ज्यादा अच्छा है. चलिए, फाइनेंस है. नाउ लुक फॉर बारबेक्यू. Again, now in barbecue, You pay upfront. So what is debtor days? 2 days. Inventory they are holding for 20 days. From the to the supplier, they're making payment in 60 days. Now let me show you from some positive also, like JK Tire. Ma'am, barbecue is a new one, but barbecue you won't find mode of debtor, mode of inventory. So the inventory and debtor will be very much close to zero. They more have suppliers. So their bargaining power with suppliers is slightly reduced. Earlier they were making payment in 2 months. Now they are making payment in 57 days. But बाकी इनमें आपको ना इन्वेंट्री दिखेगा ना आपको डेटर दिखेगा. Good. Now let me show you for JK Tire. JK में आप देखिए, is it negative? Is it negative? No. From the suppliers, sorry, to the customers, they're receiving payment in 2 months. They're holding inventory for 85 days. And to the suppliers, they're making payment in, their working capital is positive 75 days. Now, if I check the formula, here, now look into the formula what they have used. Debtor means account receivable, opening, closing, divided by 2. So all the ratios where there's a numerator, where it is in the format of P&L, balance sheet, P&L, we are always going to take average of balance sheet item. Balance sheet item means increase, decrease is uniformly over the. Am I clear with this? Now, let me come to my question bank. Question number 4. Hint for question number 4 is you have to use alternative 2 formula. Question number 4. Formula for DOL is contribution upon EBIT. Formula for DFL is EBIT upon EBT. Question number 4. Question number 4. Question number 4. Now let me write the solution now. Solution. DOL is equal to EBIT, is equal to contribution upon EBIT. DFL is EBIT upon EBT. Now let me complete. You have sold 10,000 unit at a price of 5. What will be my sales? So sales is 50,000. Variable cost 3 rupees per unit. Resultant is known as, my total contribution is 20,000. From that, I'm going to deduct my operating fixed cost. My cost is 8. This is known as EBIT. This is going to be 12,000 minus interest 2,000. This is going to be 10. Now what will be the formula? 20,000 upon 12,000. 1.67. 12 upon 10. This will be 1.2. So what is the answer? Here I'm getting 1.67. Here I'm getting 1.2. So the answer is हाँ कर सकते हैं, तब भी कंट्रीब्यूशन तो निकालना पड़ेगा ना. Shall I proceed? Answer question number 3. What is the market size for pet food? मैं रीड कर देता हूं. MRF revenue is 500. MRF share is 10%. What is the market size of tire sector? Again, I repeat. MRF revenue is 500 million. MRF share is 10%. What is the size of tire sector? What is the size of tire sector? तो आपने क्या कहा? Right. Solution number 2. Solution number 3. Market share of MRF 10%. MRF revenue $500 million. ना right. Size. अब हम लिखते थे MRF revenue is equal to share into size. Now this is 500 million. This is 10%. What is the size of the sector? So size is 5,000 million. Alternatively, if I have to take in terms of billion, how much billion? 5 billion. So what will be the answer? Answer will not be A. Answer will be C. Again, I repeat. They want you the size of the sector. They don't want the size of company. So again, repeat. How did it? MRF revenue is 500. MRF share is, what is the size of the sector? So size is 5 billion. Am I clear? Now try to answer question number 1. Subsequent to initiating coverage is true. Subsequent to initiating coverage is true. That means we are talking about follow-up report. So it provides recommendation in light of new data available in the market. कहते एक होती है इनिशिएटिंग, एक होती है फॉलोअप. फॉलोअप क्या बताती है? न्यू डेटा. एक बार चेक करेंगे. हैव इट डन सेम इन द नोट्स? फॉलोअप प्रोवाइड्स न्यू डेटा and initiating coverage provides detailed data. ठीक है ना? राइट. Hint for question number 2. Hint for question number 2. There can be two source of data. Two source of data. One public. Another one proprietary. There are two source of data. One public, one proprietary. Now public, anything which is available in the public domain. Now my point is, today go back home, money control, you check price of Reliance. Will you be able to access this website? Will you be able to access this website? Yes, it is free of cost available. But now my point is, I'm using Capital IQ also. Go back home and try to log in on this website. Will you be able to log in? This is known as proprietary. What is the meaning of proprietary? For which you have paid for the subscription. Same wise, if I talk about BQ Prime, Again, I have taken the subscription of that. I'm paying a price. This is known as proprietary. All right, public. They are available. They are available free of cost in the public domain. Proprietary, you have to pay. You have to pay fees to access the data. You have to pay a fees to access the data. Try to answer question number 2. B or C? Primary means companies providing. Bloomberg is a third-party source. So it is a proprietary database. Please go through all the 4. सब्सिक्वेंट लिखा बेटा, सब्सिक्वेंट का मतलब उसके बाद जो रिपोर्ट आती है उसको क्या कहते हैं. Take 2 minutes, please revise. Any doubt, please let me know.
सर सॉल्यूशन 3 समझ नहीं आया.
बेटा सॉल्यूशन 3 क्या कह रहा है? एमआरएफ का रेवेन्यू 500 मिलियन है, करेक्ट, और एमआरएफ का शेयर 10% है. तो आपको टोटल सेक्टर का साइज निकालना है. तो टोटल सेक्टर का साइज कितना होगा? दैट इज 5000 मिलियन. मेरा 10% है, तो एमआरएफ का रेवेन्यू कितना हो गया? 500. आपको ये गिवन है, ये गिवन है, ये पार्ट निकालना है.
ओके सर.
गलत है. सब्सिक्वेंट टू इनिशिएटिंग कवरेज लिखा है. फॉलोअप रिपोर्ट सब्सिक्वेंट नहीं पढ़ रहे हैं. सब्सिक्वेंट टू इनिशिएटिंग कवरेज, वन इनिशिएटिंग कवरेज इज देयर, उसके बाद जो रिपोर्ट आती है उसमें क्या होता है? राइट, जस्ट राइट. सॉल्यूशन 2, question number 3. Now, please. Total tire sector size is 5,000 crore. MRF share is 10%. Revenue of MRF equal to 500 crore. This is A, this is B, this is X. So can I say that A multiplied by B, this is X? Now go through the question very carefully. What is given? They have given you this figure. They have given you this figure. So you have to find out A. What is B? 10. What is X? 500. Then what will be the value of A? So value of A will be 5,000. Jenny, is it clear? Am I clear with all 4? Am I clear with all 4? Am I clear with all 4? Okay. Now write economies of scale. Now write economies of scale. Now write economies of scale. Economies of scale means as you produce more, cost per unit is declining. Economies of scale means as you're producing more, cost per unit is declining. Now my point is, suppose today you open up your pizza store, your outlet open at 11 a.m. For first pizza, you will take 45 minutes. For second pizza, you will take 45 minutes, more than 45 minutes, less than 45 minutes. Now you will say that oven is already heated. Now I'm going to take less time. This is known as economies of scale. Now, moment you're going to produce more, your cost will decline. This is known as economies of scale, right? Economies of scope. Economies of scope. Economies of scope. Currently, Vikas is teaching only CFA student. They are paying a cost for operations team and sales team. Tomorrow he planned to teach FRM also. Now think logically. Do you think that I'm going to hire more people into my sales team? No. This is known as economies of scope. What is the meaning of economies of scope? Now my office remains same. I'm entering into new business, but that will not lead to duplication of work. That does not mean I'm going to hire more staffs. This is known as economies of scope. So now economies of scale. If you're producing more, your cost is declining. Economies of scope, you're entering into some new business and your cost is dividing. So right, in economies of scale, we are producing more. In economies of scope, we are entering into new business. Now, earlier, Domino's used to sell only pizza. But now today you go to their outlets, they are selling burgers, they are selling garlic bread, they are selling some XYZ, more items. Economies of scale, economies of scope. That will be an example of economies of scope. Am I clear? So with this, we have covered this chapter. Okay. Whatever we have covered in the class, this is going to be more than sufficient. Okay. The remaining part, all the three chapters are interlinked to each other. More explanation for this part, I'm going to give in next chapter. Okay. So whatever we have covered in the class, this is going to be more than sufficient. Am I clear? Chaliye. Now take 2 minutes. Please revise in totality. Chaliye, before going for a break, solve question number 9. So please write a hint. Company A, company B. Please write company A, company B. Company B, DOL, how much? 5. DFL, how much? So what will be DTL? Please write 5 to 10. 5 to 10. For company A, DFL is given. Calculate DOL, calculate DFL, and solve the question. Solve question number 9. Solve question number 9.
A.
Now let me solve. Question number 9. Company B, DOL DFL, DTL. Five, 2, 10. For company A, this is 2. Now what will be DOL? This is going to be contribution upon contribution minus operating fixed cost. My contribution will be 40 million. 40 million minus 20. So this will be how much? 2. This will be how much? 4. Now company A has higher degree of total leverage. Is it true? So statement number A is incorrect. Statement number A is incorrect. Then it has lower sensitivity of EBIT to sales. Which ratio? DOL. So is DOL less? So what will be the correct answer? So the correct answer is not A. Correct answer is B. Again, I want to repeat. Company B, DOL is 5, DFL is 2, DTL will be 10. For company number A, what will be DOL? This is going to be contribution upon contribution minus operating fixed cost. This is going to be 40 million divided by 20 million, 2. So what will be the answer? 2, 2. Resultant will be 4. अब ये बताइए कंपनी नंबर ए का DTL is higher. Is it true? DTL is higher. Is it true? No. DOL is lower. Is it true? So what will be the answer? Answer is. Okay. Now before going for a break, my last question is, there are 4 companies. One manufactures only passenger vehicle tire. Sorry, commercial vehicle, passenger vehicle, 2-wheeler, 3-wheeler, and last one is OTR. So let me repeat my question. There is company A which manufactures tire only for commercial vehicle. That means truck, buses. There is one company which manufactures tires only for cars, including Ola, Uber. There is one company manufacture tires for 2-wheeler, 3-wheeler. There is one company manufacturing tires for commercial vehicles, like which is used in construction site. OTR means off the road. Off the road means these are not meant to be done on road. For example, JCBs. Let me show you what I'm trying to say. JCB, backhoe. Now these type of equipments, they're not meant for to be run on the roads. They're meant for to be used on construction site. These are known as OTR. Now my point is, for which company, assuming both of them have a profit, all the companies have a profit of 1 crore, for which you will pay high price and why? Again, I repeat, 4 companies. It manufactures trucks only of trucks and buses, cars, 2-wheeler, OTR. You want to buy only one company. All of the 4 companies are having same profits, for which you will pay high P multiple and Y. किस कंपनी को महंगा खरीदोगे और क्यों? को महंगा खरीदोगे क्यों? तो कुछ बच्चे बोल रहे हैं 2-wheeler 3-wheeler टारगेट ऑडियंस ज्यादा बड़ा है. ओके. Any other answer apart from 2-wheeler 3-wheeler? OTR. Why OTR? अच्छा महंगे तो इसलिए. चलिए. Where sustainable profits are there? Why passenger vehicle? Chali. So that means this we are going to learn in next class. Okay, next part of the lecture. This will be known as industry analysis. Okay. Now in the next part, what we are going to do, there's one chapter. There is one chapter separately now. The name of the chapter is Industry and Competitive Analysis. There we discussed for which company we are going to pay high multiple. But again, I'm saying that it has nothing to do with financials. It has nothing to do with financials. It will be based upon consumer behavior. Again, I repeat, it has nothing to do with financials. It will be based upon consumer behavior. Am I clear? चलिए लेवल 3 में जब आप जाएंगे 50% का एक टॉपिक आएगा कंज्यूमर बिहेवियर के ऊपर. So I try my level best to do the justice. We covered one case study of tire sector. There I try to explain what is the meaning of consumer behavior. Okay, chaliye. Now I'm not proceeding. Time is 11. Enjoy your break till 11:30. Industry and competitiveness analysis. The name of the chapter is Industry and Competitive Analysis. Okay. Now write concept number A. Concept number A. In this chapter we will learn. In this chapter we will learn how to perform industry analysis. How to perform industry analysis. Okay. Shall I proceed? Okay. Now need not write anything. Okay. Now practically, whenever you're going to start your work in the organizations, this is going to be the most important step, and this is going to be the most time consuming. Okay. Now, practically, I have worked upon one sector, that is tire. So I want to give that example. Now, in the tire, if I talk about tire sector, so the tire sector has a size of 5,000 crore. This is a reality number. What is the meaning of this? If I add up the revenue of all the tire companies, including the including the imported products, then the size is 5,000 crore. Now, how we perform this industry analysis practically? So, one database that I use very oftenly, that is CRISIL Research. Now, if I go to CRISIL Research, now I go to industries. Now, let us assume I want to research upon tire sector. I will go to tire sector, and then there's a detailed research reports. These are some paid reports. Okay. Now, what it is trying to say, strong momentum in the OEM, that is original equipment manufacturer demand, revival and replacement to help 9 to 11% tire growth. That means they provide by what rate tire sector will grow. Then they also provide with respect to individual companies, how a particular company is performing. For example, TVS, C8, MRF, JK Tire. Another database that I use very oftenly, that is ICRA Research. If I go here, I click upon research. I want to research upon tire sector. Now, these are some paid reports. Now, one report will cost some 20,000. Now, soften natural rubber prices to support industry margins in FY24. Now, what it is trying to say is rubber prices may have fallen. I don't know. But as per this report, the heading of this report is rubber prices have fallen, because of which the margins of the company are going to improvise. Okay. And recently, C8 comes with their Q2 numbers. The day result has announced stock has increased by 7%. So we go through this research reports and say whether the company performance is good or bad. Okay. Now, I don't have any research report as of now, but we try how we conduct the analysis. But again, the basis is, the important part is, it has nothing to do with financials. First, the consideration is, that is the consumer behavior. Okay. Now, let me give one simple example. There are two companies. One manufactures only commercial vehicle tires. One company manufactures only passenger vehicle tires. This is one way. Now, my point is, for which company you will pay a higher price or which company is more risky. Am I clear? Now my point is, need not to write anything. Now I'm talking about passenger vehicle. Now passenger vehicle means cars. What is the life of car in terms of year? Generally, on an average. आप लोग कितनी गाड़ी चलाते हैं साल के टर्म्स में? At what interval you change your car? At an interval of 1 year, 2 year, 3 year? At an interval of average Indian 5 to 10. Chaliye, let me take 10 years. And how much car you run in terms of kilometer in that 10 years? 1.5 lakh. So what I'm saying that, okay, in terms of years, the car life is 10 years, and in terms of kilometer, the life is 1.5 lakh. Now my point is, when you purchase a car, it comes with a tire. When you buy the car, it comes with already fitted tire. What is the life of tire? What is the life of tire? Now, life of tire is what is claimed by the company, that is 1 lakh kilometer. That is claimed by the companies, but that might not be true always, because keeping in mind the road conditions, I can assume 70-80%. Then that means you have to replace the tire at an interval of every 75,000 or at the interval of every 5 years. That means now I'm going to divide market into two parts. One market is known as OEM market, original equipment manufacturer. Another market is known as replacement market or retail market. Now my point is, tires purchased by Maruti Suzuki from JK Tire, OEM market. OEM stands for original equipment manufacturer. Once, because of wear tear, you go to a shop and replace the tire, this market will be known as replacement market. Now my point is, again, let's go through the line. What is given? Strong momentum in OEM market. That means there's a strong demand from Tata Motors, Maruti Suzuki, Hyundai, and revival in replacement market to help 9 to 11% tire growth. Now, what it is trying to say? There's a strong demand from Maruti and revival in demand from replacement sector, because of which we are forecasting that sales will increase by 10 to 11% in real terms. That means quantity sold will increase by 9 to 11%. Now, my question is very simple. Compare this segment with commercial vehicle. What is the life of commercial vehicle in terms of years? In terms of years, 6 years. What is the life of trucks? On the roads, generally you find new trucks or the older ones? Brand new trucks or the older ones? So ये ज़्यादा चलते होंगे, कम चलते होंगे? So 6 years, more than 6 years. Now the legal life is 15 years. And the better part is they're even older than that on the roads. Now running. What is the running of this? The running of truck is on an average 1 lakh kilometer every 6 months. Now, how I'm getting this data? This data is given in the research reports. Now, my point is very simple. How many times the owner of truck needs to replace the tire? Some 30 times. Now, my point is, in the commercial vehicle, which market is bigger? Tire purchased by Tata Motors, only one time. Purchased by truck owner, 31 times. Which market is bigger in case of trucks? OEM replacement. Now, first conclusion that I want to draw. In case of passenger vehicle, size of OEM, size of replacement, more or less equal. But in case of commercial, size of replacement market is way bigger than OEM. Am I clear with my first conclusion? Am I clear? Now truck driver needs to replace the tire at an interval of 6 months. You need to replace the tire at an interval of 5 years. Truck driver replace the tires close to 29 to 30 times. You need to replace the tire how many times? You need to replace the tire in the entire life tenure only maximum 1 time. Go back home, ask your father, whatever the car you're having, ask the father or mother how many times we have replaced the tire. Hardly there will be anyone in the class, any parents in the class who will say 2 times or 3 times. Majority of you will say that is going to be 1 time. Now my point is very simple. Which market is more risky? OEM market or replacement market? Which market is more risky and why? Which market is more risky and why? OEM market or replacement market? नालायक है. Which market is more risky? OEM market or replacement market?
Replacement.
चलिए लिखेंगे. We understand that tire is sold in 3 markets. We understand that tire is sold in 3 markets. Number 1, OEM, original equipment manufacturer. Number 1, OEM, original equipment manufacturer. Number 2, replacement or retail market. Number 3, export. Number 3, export. Shall I proceed? Now write product segment. Now write product segment. Where tire can be used: commercial vehicle, passenger vehicle, 2-wheeler, 3-wheeler, off the road. Last one is others. In others, I have included racing cars. I have included tractor. I have included tire of aeroplanes. So all that included in others category. Tire of cycle, that is included in other category. OTR full form is off the road. 2-wheeler, 3-wheeler. PV stands for passenger vehicle. CV stands for commercial vehicle. One is market segment. Another one is product segment. Shall I proceed? Now right. OEM versus replacement. OEM versus replacement. Now, which market is more riskier? Okay. Let me answer it. In replacement, tire is purchased by Vikas. In OEM, tire is purchased by Maruti. Now my point is very simple. In retail market, suppose there is one student who loved to have Golgappa before attending my class. One Golgappa is at 10 rupee. आज डेट है 1 जनवरी. आज इसमें कितने रुपए खर्चे होंगे? 10 rupee. He used to have only one Golgappa, 10 rupee. What will be the price of Golgappa on 31st January? You have to make a guess. Equal to 10, more than 10, less than 10. You have to make a guess. Equal to 10, more than 10, less than 10. जो गोलगप्पे खाते हैं वही सोचिए कि आप 1 महीने बाद उस दुकान पे गए तो आपसे ज्यादा लेगा, कम लेगा, बराबर लेगा. How many of you are saying more? हाँ, रोज जाएंगे. चलो, 1 महीने में इन्फ्लेशन आ गई है. हाँ, मेरे को नहीं पता. आप डेली गोलगप्पे की दुकान पे जा रहे हैं. 31 जनवरी का गोलगप्पे का रेट है. आप 100 करोड़ की शर्त लगा रहे हो तो 10 से महंगा, 10 या 10 से कम, एक रेट चाहिए. कौन सा? You go to the shop after 6 months. You have to make a guess. What is the price of one Golgappa? Equal to 10, more than 10, less than 10. Equal to 10, more than 10, less than 10. गोलगप्पे की कौन सी मार्केट होती है? Now my point is very simple. You go on 1st January, you go on 31st January, you go on 30th June. High probability is price of Golgappa will be equal to 10 rupee. Now my point is, no matter what the inflation is, high probability is in the short run, selling price is going to remain constant. Same wise, purchase one toothpaste. Again, go to the shop tomorrow, purchase the toothpaste. High probability is if today the price is 100, tomorrow the prices will also be 100. After 3 months, high probability is it is going to be 100. But on the contrary, input cost, is it constant or fluctuating on regular basis? Assuming only one input is there, that is the aloo. Price is constant or volatile? Now, selling price is constant. Input cost is volatile. What will be profit margins? Stable, volatile. Now, profit margins are going to be volatile. When the potato prices are very low, profits are going to be very high. When prices of potato are very high, he cannot pass on to the customer. The profits will be very low. Now, who is taking that volatility? That volatility is taken care by the seller. Now, my point is OEM. When Maruti placed the order to buy the tires, will it be a single quantity? 1 tire, 2 tire? So quantities will be bulk. Will it be recurring order, non-recurring order? Recurring order. Now my point is JK Tire enter into a contract with Maruti that we will supply you 1 lakh tire per month. In this contract, will price be mentioned? Will not be mentioned. Will price be mentioned? Will not be mentioned. Now the beauty is that in the contract, price will not be mentioned. Now why price will not be mentioned? Now think logically. Can I say that Maruti is nothing but assembler of goods? They don't have their own engine. They don't have steel. They don't have tires. They don't have their engine. They don't have airbags. What it does, it gets all the goods from the suppliers and assemble the car in their facility. That means, can I say that it is nothing but assembler? Now go to your home. In the car, it is written that airbag is by company SRS. Tire will be of some another company. Engine is of some another company. Steel is from another company. It is nothing but assembler. And if I fix the price, now one input is rubber. If rubber price increase significantly, do you think that JK Tire will continue to supply the goods? No, he will not. And is it going to hamper my production? Now what Maruti does, Maruti says that it is going to be an open PO. Open PO stands for it is going to be an open purchase order. I will provide you with my manufacturing cost. If my manufacturing cost is 100, my margin will be fixed. That is 10%. What will be selling price? 110. If manufacturing cost is 200, 10%. What will be selling price? 220. If manufacturing cost is 500, what will be my selling price? That is going to be 550. Now my point is, if manufacturing cost is 0, hypothetically, what will be selling price? 0. Can I end up into the losses? Can I end up into the losses? Can I end up into the losses? Now what is the best part with OEM? The best part with OEM is, as input cost is changing in the same proportion, selling price is also changing. Profit margins will be volatile, stable. Profit margins are going to be stable. That is going to be 10%. Now my point is, in replacement, what is the problem? Selling price is fixed. Input cost is variable. As a result, profit margins are going to be volatile. But in case of OEM, contracts are based upon open PO. Selling price is not fixed. What is fixed? Profit margins. If input cost increased, selling price will also increase. If input price reduced, selling price will also reduce. Now, right, replacement market. In replacement market, in short run, selling price is fixed. Input cost is volatile, leading to profit margins. Leading to profit margins highly volatile. If input cost is low, profit margins will be higher, and vice versa. Now, right, OEM contract are based upon open purchase order. Where quantity to be supplied is mentioned. However, selling price will not be mentioned. Selling prices will be calculated with the help of input cost incurred, leading to input cost incurred, or with the help of manufacturing cost incurred, leading to dash profit margins, leading to stable profit margins. आप एक चीज ये सोचिए, to manufacture the tire we need rubber are of two type. One is natural rubber, another one is synthetic rubber. Synthetic rubber we extract from crude oil. Natural rubber we get from trees. Both the rubbers we don't have in our country. It's a imported product. Now my point is how I can fix a contract for 1 year. I am not going to take this volatility. Maruti enters into a contract that I am going to take the volatility. Contract will be based upon open PO. Whatever the input cost you have incurred, on that there will be markup of 10%, and accordingly we determine the selling prices. Now my point is, which market is more risky? OEM market, replacement market? Now replacement market is more risky. Now my point is, one is passenger vehicle, one is commercial vehicle. We just covered that in passenger vehicle, replacement is equal to OEM. But here, replacement is greater than OEM. Out of the two products, which product is more risky? Now, CV is more risky. This is one example. Another example. Now, when you go to replace the tire, when Vikas will go to replace the tire, at the interval of 5 years, what is Vikas' requirement? Quality or cheap? Quality comes expensive. Will Vikas buy cheap product or will Vikas buy expensive product? What is my area of concern? I want quality or I want cheap product. What is my consumer behavior? What is my behavior? I'm going to buy quality or I'm going to buy cheap product. Let me help you. How much it will cost you? So it depends upon the size of the tire. Assume that I have a Ciaz car. So weight will be 10 kilo or weight will be 15 kilo. I need how many kilo of tire? I need 60 kilo. and price is somewhere close to 300 rupees per kilo. So what will be my total expense? 18,000 at the interval of every 5 years. How many times I'm going to incur this expense? Only one time. I want quality. I want cheap product. What is the difference between quality and expensive product? So let us assume there's a difference of 30%. So 30% would roughly somewhat close to 21,000. अच्छा प्रोडक्ट 21,000 का है या 24,000 ले लेते हैं. अच्छा प्रोडक्ट 24,000 का है और चीपर प्रोडक्ट 18,000 का है. What I will prefer? Will you pay 24? Will you pay 18? Now my point is, this is the car used by me for my official purpose. This is the car used by my parents. This is the car used by my children. This is the car used by my wife. I will give preference to quality. Now my point is, let me come to this truck owner part. In India, let us assume that truck has a loading capacity of 100 kilos. It can take a maximum weight of 100 kilos. Problem of underloading, overloading. If there's an overloading, can truck collapse and meet with an accident? In that accident, can truck driver lose his life? Now my point is, they can lose their life. Then why there's a problem of overloading? जब उसकी जान जा सकती है तो ओवरलोडिंग क्यों करते हैं?
Profit and insurance.
Some extra amount to earn some extra amount. Correct. Same wise, my question is, now think logically. Here the expense will be at an interval of every 6 months. Vikas has only one car. Truck owner will have only one truck? No, there will be fleet of trucks. Now let us assume he has 10 cars or 10 trucks. Weight of one tire is 15 kilo for car. For truck also 15 kilo. It is 60 kilo. Multiply by 4. Here multiply by 6. Multiply by 300. Calculate the expense. I'm having 10 vehicles. I need 60 kilo per tire. My expense will be 10,80,000 at the interval of every. Now my question is, I want quality, I want cheap product. अब आप क्या कह रहे हो? The consumer behavior of passenger vehicle is, I want quality, but the consumer behavior of truck driver or truck owner is, I want a cheap product. I don't want quality, I want a cheap product. अब सवाल बड़ा ही सिंपल है. जैसे ही चीप आ गया तो माइंड में कौन आ जाता है? चीप से माइंड में कौन आ रहा है आपके माइंड में? नालायक. क्या कौन आ रहा है? कौन आ रहा था? चीप से नालायक को. बच्चा कह रहा है रिलैक्स हो. रिलैक्स हो कहां से होगा? चीप से कौन आ जाएगा माइंड में? अब दुनिया का largest manufacturer of tire कौन है? That is going to be China. Now my point is very simple. Those companies whose manufacture passenger vehicle tire, they only compete among themselves. But those companies which manufacture commercial vehicle tires, they have to compete among themselves. Plus they have to compete along with China. That means intensity of competition has increased. तो इनकी profitability ज्यादा होती होगी, इनकी profitability कम होती होगी. यहाँ पे जब competition बढ़ गया, then the profitability is going to be lower. Now the problem has not resolved yet. This sector has one more problem. Now what is the another problem? Now write, please write. Now write problems with CV sector. Number one, higher percentage of replacement market. Higher percentage of replacement market, because of which profit margins will be profit margins will be volatile. Second, end consumer in case of passenger vehicle, end consumer in case of commercial vehicle is highly price sensitive. They prefer cheap product over quality. Hence, manufacturers have to compete among themselves, as well as China. Intensity of competition is more. Hence, profit will remain subdued. जहां पे सप्लायर ज्यादा हो जाएंगे वहां पे मार्जिन्स क्या हो जाएंगे, वहां पे फिर मार्जिन्स आपके सबड्यूट हो जाएंगे या मार्जिन्स आपके कम हो जाएंगे. Now write the third problem. Third problem is, in India there is a inverted duty structure. In India there is a inverted duty structure. Now, what is the meaning of inverted duty structure? Now, please, we export rice. We are the exporter of rice, or we are the exporter of IT service. Same wise, we are the importer of iPhone. Okay? One is export, one is import. Imported product, that means foreign product coming to India. Export means we are sending the goods to some another country. Now, suppose we are sending rice to America. Will Indian government levy duty on this export? Will Indian government levy duty on this export? Then who will levy the duty? US will levy the duty. Same wise, when iPhone is coming to India, who will levy the duty? India or America? India will levy the duty. Correct? Now my point is very simple. That means duty will always be on import. It is never on. We want to promote the export. There are few products where there is export duty, but 99% there is an import duty. We want to promote export. We want to reduce the import. Correct? Now my point is very simple. To manufacture the tire, we need rubber. We don't have rubber. This rubber we basically get from Thailand. Same wise, one more thing is required, that is synthetic rubber. It is extracted from crude oil. We don't have synthetic rubber also. That means it is an imported product. This imported product will be used by MRF. Now my point is, I'm going to charge duty on this. Suppose duty on this rubber is 10%, burden of which to be laid on MRF. Correct? Now my point is, from China, we are getting final tire. That means final product. What should be duty on that final product? Equal to 10%, more than 10%, less than 10%. You are the finance minister. You have to select the duty equal to 10%, more than 10%, less than 10%. MRF आपका खुद का बंदा है, उससे 10 ले रहे हो, तो बाहर वाले बंदों से ज्यादा लोगे कम लोगे? तो बच्चे ने कहा, I want to charge 25%. In majority of the cases, this is true. But what happened in tire sector? There is an inverted duty structure. Inverted duty structure means the final product which is coming from a China, on that duty is only 10. But on the raw material which is used by MRF, on that duty is 25%. Now my point is very simple. For import-export, tire sector, do we have favorable import-export policy? Answer is no. That is the another problem of this particular sector. Again, I want to repeat, majority of the cases, what you will find, majority of the cases you will find that on input, duty to be lower, on final product, duty to be higher. In majority of the product. But tire is a few sector जहां पे आपको क्या मिलेगा, जहां पे आपको उल्टा दिखेगा. फाइनल प्रोडक्ट के ऊपर ड्यूटी क्या है, कम है. इनपुट के ऊपर ड्यूटी क्या है, ज्यादा है. ये भी क्या है, इस सेक्टर की एक बहुत बड़ी प्रॉब्लम है. नाउ अब ऐसा हम क्यों करते हैं, ये भी मैं आंसर दे देता हूं. द पॉइंट इज दैट वी वांट टू इंप्रूव आवर रिलेशनशिप विद चाइना. अब हमें किसी ना किसी की तो बलि चढ़ानी थी, तो हमने किस सेक्टर को पिक कर लिया, विच इज नॉट important from Indian economy point of view. So in order to improve the relationship, we say that, okay, on tire, we are going to reduce the duty. But majority of the cases, you will find that we want to protect the domestic industries. Then my counter question is, first problem is with CV. Replacement is more. Profit margins will be less. Profit margins will be volatile. Second problem is क्या था, sorry, intensity of competition is more. And third problem is that is going to be inverted duty structure, because of which we pay a lower multiple for commercial vehicle tire and we pay a higher multiple for passenger vehicle tire. So इस तरीके से हम क्या करते हैं, we perform the industry analysis. Now I'm going to share one report with you. Okay, that report is pretty old. That report is 2009 dated, but whatever the facts and figures I have used, 1 lakh, 15 years, 10 years, those facts and figures are mentioned in that particular report. So I strongly recommend that. It is not important from exam point of view, but definitely go through that research reports. This will provide you the insight how we perform the sectorial analysis. Now you have to name one sector, one product where there is an export duty. Generally, there will not be any export duty. There is no export duty, but there are few products. Try and name the guess of the product where the government levies, government does not want you to export the product.
Alcohol.
Now the answer is on sugar in a country, there is a export product. It is a product of necessity. We don't want you to supply this goods to some other country. Same wise, when the prices of onion increase significantly or the prices of some other necessities, generally wheat or rice की price इतनी बढ़ती नहीं है, but the prices of sugar, prices of onion, prices of tomato increase significantly in the country. During that particular period of time, what government does, in order to reduce the exports, government increase the export duty. Generally, we don't levy the export duty, but yes, on necessities, we levy the export duty, and sugar is one of those sectors. That means your business are impacted by competitions, plus it is impacted by the policies of government. Policies of government may not be favorable for you. For some business, it is favorable. For some business, it is not. Same wise for the business of cigarette, for the business of drugs, it is not favorable. Same wise for the business of sugar. You need any help from us, we are going to supply you the land. We are going to supply you some necessities. We are going to supply the subsidy. But we don't want to promote the export of this particular product. Okay. So in this particular manner, we perform the industry analysis. Am I clear with this? Hanji, boli.
Sure.
वो तो शुगर पे लेती है, वो तो शुगर पे लेगी और आपको इंडियन गवर्नमेंट को भी पैसा देना पड़ेगा. So assume that Bill Gates is want sugar. Now suppose price is 10, export duty will be 10, 20 will be import duty. So total price he has to pay, that is going to be 130 rupees. So final burden is supplied to is given to the whoever is going to buy the product. Am I clear with this? Am I clear with industry analysis? Now the best part is the market leader of tire sector is Balkrishnan Industries. Majority of you may not heard the name of this company, but it is the market leader. Now the market, why it is the market leader? Now look into the P multiple of this stock. Balkrishnan Industries. P multiple is how much? P multiple is how much? 45. Now look into the P multiple of MRF. How much is the P multiple? 37. Look into the P multiple of JK Tire. How much is the P multiple? 20. Look into the P multiple of C8. How much is the P multiple? Then why 45 for a company like Balkrishnan? Now Balkrishnan is a market leader in OTR tires. OTR, off the road. अब why OTR को सबसे ज्यादा मल्टीपल मिलता है? Think logically. एक टायर की लाइफ होती है 1 लाख किलोमीटर. जेसीबी जैसी गाड़ियां कितनी चलती होंगी? In terms of kilometer, 0 kilometer. They're not meant to run on the roads. They're meant to be used on construction sites. अगर उन्हें एक जगह से दूसरी जगह जाना भी होता है, वो कहां से जाते होंगे? Loading on the truck and they transport it. Now my point is very simple. OTR, 100% it is going to be OEM market. All the products are not standardized. These are tailor-made. And when it's a tailor-made as per the need of the customer, तो हम margins भी आपसे क्या ले लेंगे? हम margins भी आपसे ज़्यादा ले लेंगे. So this company is the market leader in the entire tire segment. Same wise, I asked majority of you which bank is bigger, Bajaj Finance or Kotak. Majority of you says Kotak. Answer is incorrect. Now look into the market cap of Kotak. Only 3,50,000. Look into the market cap of Bajaj Finance. That is 4,70,000. Now again, the king of this sector is Bajaj Finance. Look into the P multiple. How much? 35. 35. Look into the P multiple of Kotak. Look into the P multiple of Kotak. How much? 21. Look into the P multiple of HDFC Bank. How much? 21. Look into the P multiple of ICICI Bank. How much? 17. Who is the king of this sector? The king is Bajaj Finance. And you won't find any NBFC stock, any banking stock at a P multiple of 35. Now, why we are paying such a high P? Because the rate at which this company is growing. This company competitive advantage is very high. आज आप इस कंपनी से लोन लीजिए, आप इस पे एक बार डिफॉल्ट करके दिखाइए, सिर्फ आप एक EMI डिफॉल्ट करके दिखाइए. ऐसा कहा जाता है क्योंकि मैंने इस कंपनी में काम कर रखा है, अगर आपके पास पैसे नहीं है तो आप मम्मी पापा से दीजिए, मम्मी पापा के पास नहीं है दादा दादी से दीजिए, और पर दादा दादी अगर डेथ भी हो चुकी है सालों वहां से भी निकाल लेते हैं. ये आपको इतनी गालियां देंगे, जो गालियां आपने सुनी भी नहीं होंगी, वो ऐसी ऐसी आपको गालियां देंगे, और लिटरली ऐसा लगता है कि खानों में से खून निकल रहा. तो कभी आपको लगे कि क्यों बजाज फाइनेंस इतना हाई पी पे लिखता है, एक लोन लेना और उस लोन के ऊपर क्या कर देना? डिफॉल्ट कर देना. फिर देखना वो आपसे पैसे कैसे निकालते हैं. एट टाइम्स ये इतना पैसे निकालने के लिए पहले ही काम करते थे, अब नहीं करते हैं. ये आपके घर इवन छक्के भी भिजवा देते हैं, आपके ऑफिस में छक्के भेज देंगे और बोलेंगे कि भैया हमारे पैसे दो. अब बच्चा कह रहा है पुलिस में कंप्लेंट करूंगा. पुलिस वाला भी जब आएगा तो आपको मारेगा या उसको मारेगा? डिफॉल्ट किसने करा है? आपने करे, तो पुलिस वाला भी आपको मारेगा ही. और अगर आप इतने ही पुलिस वाले के पास आपकी इतनी हिम्मत होती तो आप लोन ही ना पे कर देते. ठीक है, तो कभी भी अगर आपको डिफॉल्ट करना हो, मन हो पंगा लेने का कि प्रूव हो कि मैं मर्द हूं, तो क्या करने का? लोन किससे लेने का? और कितनी EMI डिफॉल्ट करके दिखाने का? सिर्फ एक EMI डिफॉल्ट कर देना, दूध का दूध और पानी का पानी हो जाएगा. कि आप सच्ची में मर्द, आई मीन लेडीज को भी करना कर लीजिएगा और जेंट्स को भी करना कर लीजिएगा, प्रूव हो जाएगा कि आप मर्द हैं या नहीं. हाँ, कौन सी वाली कॉस्ट? नहीं, वसूली वाले तो डेली इनके बैठे होते हैं.
सर
अरे एचडीएफसी में बहुत, आप एचडीएफसी का भी पैसा नहीं खा सकते हो। आप मर्द की ना लोअर कैटेगरी में हो, मतलब ना मर्द वाली कैटेगरी में हो, ठीक है। आपको लग रहा है मैं एचडीएफसी का खा सकता हूँ, एचडीएफसी का भी नहीं खा सकते हो। जो बहुत ही हमारी क्लास में कोई एकदम बॉडी बिल्डर टाइप हो, जिसको किसी से डर नहीं लगता, वो भी एचडीएफसी का नहीं खा सकता। सो दिस कंपनी हैज अ ग्रॉस एनपी ऑफ लेस देन 1%। बजाज फाइनेंस, कोटक, एचडीएफसी, आप इन कंपनीज का पैसा नहीं खा सकते। खा भी लिया तो मैक्सिमम आप एचडीएफसी और कोटक का फिर भी खा ला, अगर बहुत ही बदतमीज हो, लेकिन बजाज का तो नहीं खा सकते।
सर ओईएम में एक क्वेश्चन है।
फर्क नहीं पड़ता, बट हाँ, चलिए अब लिखें, स्टार्ट
सर
करें ना, प्लीज राइट,
सर एक क्वेश्चन है।
प्लीज राइट। स्टेप नंबर 1, राइट concept number 8.
सर
Industry analysis involves 5 steps. Industry analysis involves 5 steps. Number 1, define the sector. Number 1, define the sector. Now, right? Suppose we are doing valuation of JK Tire. We are doing valuation of JK Tire. This company earns 90% revenue from CV sector. So how JK Tire is making money? 90% of their revenue is from CV sector. Right? Step number 2. Define the industry size. Define the industry size, growth, and profitability. More than 50% revenue, more than 50% of the revenue of tire sector is from CV segment. Is from CV segment. Profit in this segment, profit in this segment will be subdued and volatile. The next, right? Step number 3, analyze the industry structure. Analyze the industry structure. Within bracket, Porter 5 forces. Within bracket, Porter 5 forces. Now we are going to explain the Porter 5 forces. Number 1, threat of new entrant. Threat of new entrant. Now help me. Somebody wants to enter into telecom business. Easy, difficult? Somebody wants to enter into coaching industry. Difficult, easy? All right. In coaching business, barrier to entry are low. And in telecom sector, barriers to entry are high. Then threat of substitutes. Threat of substitute. Threat of substitute. In coaching business, generally there is no threat of substitute. In coaching business, generally there is no threat of substitute. Now, if you want to do CFA, you have to do CFA. There's no substitute product. But in case of automobile, particularly Maruti, market leader in petrol segment, facing tough competition from any substitute product of petrol cars, facing tough competition from Tata Motors in EV segment. Third, bargaining power of customer. Bargaining power of customer. In coaching industry, bargaining power of customer is less. They have to pay upfront. Bargaining power is dependent upon number of buyers. More the number of buyers, think logically, bargaining power of customer will be high or low? High or low? मेरे पास आप इतने सारे बच्चे हो तो मेरी डिमांड है, तभी तो मैं क्या बोल रहा हूं, फीस अपफ्रंट. सो लिखेंगे बार्गेनिंग पावर इज लो. फोर्थ, bargaining power of supplier. In coaching industry, bargaining power of supplier is मेरी bargaining power ज्यादा है कम है? Bargaining power is less because large numbers of teachers available in the market. That is the competition. That is not a substitute. वहां पे भी जाके CFA ही पड़ेगा ना. एक मिनट, बच्चा कह रहा है कि सर कैसी बच्चे, आपने बोला नो थ्रेट ऑफ सब्स्टिट्यूट, आपका सब्स्टिट्यूट है, मेरा सब्स्टिट्यूट नहीं बोल रहा, CFA का सब्स्टिट्यूट बोल रहा हूं. लिखेंगे लास्ट इंटेंसिटी ऑफ कंपटीशन. Intensity of competition. Intensity of competition. Higher the number of players in the market, competition is tough and margins will be low. Now help me. In CA, typically they charges 10,000 rupees. In UPSC, the fees is 3 lakh rupees. For CFA, the fees is 30,000 rupees. Now, my point is, good UPSC coaching institute, they are charging 3 lakh rupees. Example, Drishti. Now, my point is, are there large number of good IAS coaching institute? अगर ज्यादा अच्छे होते तो 3 लाख रुपए चार्ज कर पाते? No. Same wise for CA, they are charging only 10,000 rupees per subject. That means there are a lot number of suppliers in the market. Now, if I talk about telecom, now telecom is ruled by only 2 players. One is Jio, one is Airtel. Same wise, if I talk about banking channels, it is ruled by 3 companies: ICICI Bank, Kotak Bank, and HDFC Bank. Then there will be less number of suppliers, less number of players in the market. They will be in a position to charge higher price. Large number of suppliers, then you cannot charge a higher price. Now right. To check concentration of sector, to check concentration of the sector, to check concentration of the sector, we calculate, ये स्पेलिंग यहां से देख लेना, we calculate HHI index. आपको पूरा लिखना है, पता नहीं क्या प्रोनाउंस होगा, लिख लो. Concentration of the sector using HHI. आप घर जाके प्रैक्टिस कर लीजिएगा कैसे होता है. Using HHI. Now write example. Write example. In bankings or in auto sector, market share of companies, Maruti 50%, Tata 30%, Mahindra, this is a hypothetical number, Mahindra 20%. Okay, now what I will do, simply take the square and add up the numbers. HHI is equal to 50 का square, 30 का square, 20 का square. Add up and help me with the number. It is going to be 3800. Please verify. Now write. If HHI below 1500, if HHI below 1500, it signifies there are high number of players in the market. Competition is more. Then if HHI 1500 to 2500, this is known as moderate concentration. And if it is greater than 2500, then it is highly concentration. Highly concentration means there are few players and those few players are having large market share. Now this is not good for competition. Am I clear? Now please try to solve question number 2. Please try to solve question number 2. Now answer will be 3800. How you're going to solve? You're going to square it and then you're going to add up the numbers. Next slide. Step number 4. Analyze the external factors. Step number 4. Analyze the external factor. Analyze the external factor. इसमें लिखेंगे for this we use pistol. For this we use pistol, highly testable. For this we use pistol. Now again I repeat, for industry structure we use Porter's 5 forces. Then for external factors we are going to use pistol. Now write P. P stands for political, E stands for economic, S stands for, T stands for, L stands for, E stands for environmental, right? As it is. It will ask which of the following is external factor. Go through the pistol.
सर सर किसी भी प्रोडक्ट की प्राइस उसकी विजिबिलिटी डिफाइन
Shall I
करती
start?
है
Now,
सर
name one sector where the government policy is not good for a particular sector. Now, example is sugar. Indian government does not want that the prices of sugar should increase. But sugar is manufactured from sugarcane. Sugarcane is supplied by farmers. Now, what government wants? Farmers should receive a higher price. अब देखिए कॉन्ट्राडिक्टरी व्यू. गवर्नमेंट क्या चाहती है? जो हमें गन्ने दे रहे हैं उनको कीमत हम क्या दें, लेकिन जब मार्केट में शुगर बिके तो किस कीमत पे बिके? Is it contradictory view? Now, one sector which is badly impacted by sugar by the government policy, that is sugar. Now, we want farmers to get a higher price for their inputs, but we don't want that the sugar manufacturer to sell the sugar in the market at a higher price. Now, right? Political influence. Example: sugar. Government wants farmers should get higher prices for sugarcane. But they don't want companies to sell the final product at higher price. Next, right? Economic influence. Currently, there is a problem of inflation. To control inflation, RBI increase the interest rates in the economy. As a result, taking loans from a bank will become expensive. It will hurt profitability of banking sector. Become expensive and it will hurt profitability of banking sector. Now in US, rate of interest was 0.5%. Currently in US, the interest rate is more than 5%. More than 5%. Now my point is, do you think that people will borrow at 5%, which used to borrow at 0.5? अब क्या लोग borrow करेंगे पैसा? तो profitability किसकी कम हो जाएगी? Banks की. This is on account of which factor? Now, right? Social factor. एक सेकेंड. Tanish, please unmute. तो कह रहे हमारी आवाज नहीं आ रही है. क्या? Tanish, you want to say something?
सर
हाँ जी,
सर किसी भी प्रोडक्ट की विजिबिलिटी, उसका प्राइस उसकी विजिबिलिटी डिफाइन पे वेरी करता है।
मैं सवाल नहीं समझा, सॉरी।
आपने एग्जांपल दिया था आईएएस की फीस और सीएफए की फीस का।
किसका?
आपने अभी एग्जांपल दिया था ना आईएएस की फीस और सीएफए की फीस का।
हाँ हाँ हाँ।
अगर आईएएस टीयर 2 और टीयर 1 सिटीज में कॉमन है,
हम्म
बट सीएफए टीयर 2 सिटीज में कॉमन नहीं है,
हम्म
लोग उसके बारे में नहीं जानते इतना।
हम्म
ये भी किसी भी प्रोडक्ट के लिए ये एक फैक्टर हो सकता है, उसकी
डेमोग्राफिक
विजिबिलिटी
फैक्टर्स भी
नहीं है।
डेफिनेटली प्लेज एन इंपॉर्टेंट रोल, डेफिनेटली।
ओके। और एक और चीज सर, ओईएम वाले एग्जांपल में जहाँ पे आपने मारुति का बताया था, अगर वहां पे जेके टायर अपना प्राइस में बढ़ा दे तो
हम्म
मारुति अपने प्राइस बढ़ाएगा।
मारुति कोशिश करता है कि मैं प्राइस ना बढ़ाऊं।
अगर अगर हाइपोथेटिकली 50% जेके टायर अपने प्राइस बढ़ा दे तो मारुति अपने
टायर का
प्राइस बढ़ाएगा।
कंपोनेंट इन टोटल प्राइस ऑफ कार इज वेरी लेस, इट इज नॉट गोइंग टू इम्पैक्ट
हम्म।
मारुति अ लॉट।
बट अगर सेम केस में ऑडी हो तो ऑडी को ये चीज नहीं फर्क पड़ेगी, ऑडी बिल्कुल नहीं बढ़ाएगा। तो इंडस्ट्री
तो
वाइज
ये
भी तो
ऑल्टो
वेरी
की
करेगा।
ऑल्टो में भी फर्क नहीं पड़ेगा।
ओके।
हाँ।
ठीक।
ठीक
थैंक
है,
यू सर।
चलिए। जनरली मारुति करती कैसे है? मारुति ऑलरेडी गाड़ी की कीमत थोड़ी सी इन्फ्लेट कर देती है। अगर गाड़ी की कीमत 6 लाख है तो कर देगी 7 लाख, या नॉट 7 लाख, 6.5 लाख। फिर वो आपको क्या दे देते हैं? कैश डिस्काउंट। इन अ पर्टिकुलर मंथ वेयर इनपुट प्राइसेस इंक्रीज सिग्निफिकेंटली, दे वोंट गिव यू कैश डिस्काउंट। द मंथ वेयर प्राइसेस हैव फॉलन सिग्निफिकेंटली, they used to say that there's a cash discount of 24,000, there's a cash discount of 30%. In this way Maruti manages the prices, correct? चलिए लिखेंगे। कहाँ पे थे? सोशल। नाउ सोशल इन्फ्लुएंस, एग्जांपल इज सिगरेट, एग्जांपल इज सिगरेट, alcohol, education. Now society wants there should be more and more school colleges. Society wants there should be less liquor shop, there should be less shops which are selling the tobacco in the country. Then right, technological, example phones, laptop, another other type of gadgets. Then legal, classic example is Delta Corp, or example is Google. Right now Google is having a battle with their US laws, regulators regarding the privacy of data. This is some legal influence. Then environmental, example Tata Steel, where running of factory has a severe impact on environment. Same wise we can also say paper industry. To manufacture the paper we have to cut trees, again it's going to have impact on the environment. तो आपको इन एक्सटर्नल फैक्टर्स को भी कंसीडर करना पड़ेगा। नेक्स्ट राइट, फिफ्थ वन, कॉम्पिटिटिव एडवांटेज।
एक्सक्यूज मी सर।
हम्म
सर जैसे गवर्नमेंट ने अभी इंपोर्ट पे रिस्ट्रिक्शंस लगा रखे ऑफ लैपटॉप्स एंड मोबाइल फोन,
हम्म
तो टैब्स वगैरह पे, तो वो कौन से फैक्टर में आएगा?
पॉलिटिकल इन्फ्लुएंस है।
पॉलिटिकल?
हम्म
बट वो तो इसलिए है ना कि मतलब बाहर से हम कम इंपोर्ट करें।
देखिए, या तो
तो
इकोनॉमिक में आएगा या पॉलिटिकल में आएगा। नाउ फॉर एग्जांपल वी डोंट वांट द प्राइसेस ऑफ शुगर टू इंक्रीज, इट्स अ पॉलिटिकल फैक्टर, करेक्ट? नाउ इफ
यस।
यू वांट टू कंट्रोल द इन्फ्लेशन इन द कंट्री देन इट विल बी इकोनॉमिक फैक्टर।
ओके।
सर अगर गवर्नमेंट अल्कोहल प्रमोट कर रही है, वो रेवेन्यू के लिए कर रही है।
लेकिन गवर्नमेंट बोलती नहीं है कि मैं कर रही हूँ, कर रही है, हाँ कर रही है, लेकिन बोलती नहीं है। वो कहती है मैं ज्यादा
नहीं,
चार्ज कर प्रमोट कर रही हूँ।
बोलने का मतलब सबको लाइसेंस दे रही है। गुड़ अगर आप कंपेयर करो गुड़गांव में, गुड़गांव में एन नंबर ऑफ शॉप्स हैं, लेकिन वहां पे जो प्राइस है वो सेम नहीं है, वो आपको मिनिमम सेलिंग प्राइस पे दे रहे हैं, तो इसका क्या मतलब हुआ कि वो रेवेन्यू की वजह से कर रहे हैं?
मतलब लिमिटेड नॉलेज है, अभी मैं सोच के बताता हूँ, ऑन द स्पॉट तो क्लिक नहीं कर रही आप, कहाँ ले जा रहे हो मुझे, बट चलते
नहीं
हैं।
नहीं सर,
हाँ हाँ
आपने जो एग्जांपल दिया ना सोशल
हाँ।
इन्फ्लुएंस का, सर उसमें पूछ रहा हूँ कि
में
अल्कोहल है,
हम्म
गुड़गांव में जो गवर्नमेंट जो नंबर ऑफ लाइसेंसेस जो दे रहे हैं लोगों को,
हम्म।
तो वो क्यों, रेवेन्यू उसका एक फैक्टर है।
एक फैक्टर क्या, यही एक इकलौता फैक्टर है, और क्या फैक्टर, उनके मासी के लड़के थोड़ी लग रहे हैं। जो लाइसेंस दे रहे हैं किस लिए दे रहे हैं, पैसे, एक्स्ट्रा पैसा कमाने के लिए। बच्चा कह रहे और कोई फैक्टर है, सिर्फ यही फैक्टर, और कोई फैक्टर नहीं है। सेम वाइज मैं आपको पढ़ा रहा हूँ, मेरे पीछे मोटो क्या है, या मुझे बहुत अच्छे लगते हो, या मैं इकोनॉमी में चेंज लाना चाहता हूँ। चलिए चलिए लिखेंगे, फिफ्थ पॉइंट, कॉम्पिटेटिव एडवांटेज। कॉम्पिटेटिव एडवांटेज, फर्स्ट कंपनी टू स्टार्ट कंज्यूमर ड्यूरेबल लोन्स। फर्स्ट कंपनी टू स्टार्ट consumer durable loans. Now you buy furniture on EMIs, you buy laptop on EMIs. This is known as consumer durable. First company to start consumer durable loan is Bajaj Finance. First company to start consumer durable loans is Bajaj Finance. They have competitive advantage or first mover advantage over others. Next, Muthoot Finance has competitive advantage over Manappuram. Muthoot Finance has competitive advantage over Manappuram by having their branches in the urban area, as well as rural areas. Same as any advantage of HDFC over SBI? Corporate governance, service, app, ease of doing business, that is more with HDFC. These are the competitive advantage. Now right, strategies of a manufacturer. Number one, cost leadership. Number two, differentiation. Number three, focus. Now, strategies of a manufacturer: cost leadership, differentiation, focus. Cost leadership. Here, manufacturer tries to offer the product at lowest cost. Here, the manufacturer tries to offer the product at lowest cost. Focus is on operational efficiency. Underline the word operational efficiency. Focus is on operational efficiency. Now, any company where you buy because it is cheap, we go because it is cheap. DMart. Another example is Reliance Jio. All right. Example. DMart, comma, Reliance Jio, comma, Reliance Trend, comma, Zudio. Then differentiation strategy. Here company try to say My product is different from others. Example, Patanjali. Example, Patanjali. Example, coaching institute. Now, I never say that my content is exactly similar to that particular competitor. I will say that there's some difference here if you come to this coaching institute. Now, my point is, problem here is, underline the word problem here is, we may charge very high premium for product differentiation. Then focus. Only a niche market is targeted. I don't want everybody to buy my product. I want to focus only on a segment of a population. Example, Apple. डिफरेंशिएशन में नहीं कह सकते हैं, क्योंकि डिफरेंशिएशन तो ये है कि मेरा प्रोडक्ट डिफरेंट है, बट एप्पल ये कहते हैं मेरा प्रोडक्ट बेस्ट है, नहीं मैं हूं. That is why I'm not following Android, I'm using iOS. All the companies that are using Android, we can say that there's a differentiation strategy. Our megapixel is this, our screen is this, but Apple will not fall into that category. Now, write focus strategy. Example, okay, don't write Apple, write LV. LV के बैग्स, कॉमा गुची, और जो जो आपको अच्छा लगता है. रोल्स रॉयस, एस्टा मार्टिन, जो जो आप खरीदना चाहते हो सब लिख दो. मिलनी तो है नहीं, लिख दो. एस्टा मार्टिन, मैकलेन, और जो भी आपकी और नॉलेज है, मेरी तो नहीं है, लिमिटेड है. चलिए, नालायक बच्चा जॉनसन एंड जॉनसन लिख रहा है. जॉनसन जॉनसन का पाउडर तो अपने घर में भी है, तो नीश मार्केट कहां से हुआ? जो चीज आपके पास है वो नीश मार्केट नहीं है. तो इस तरीके से हम ले सकते हैं, ठीक है, क्योंकि हम किस में नहीं आते, नीच में नहीं आते हैं, हम नीच में आते हैं. ठीक है, चलिए लिखेंगे नेक्स्ट. सिक्लिकल वर्सेस, मोस्ट इंपॉर्टेंट, सिक्लिकल वर्सेस डिफेंसिव. नीच नहीं, a segment of the market. Same wise, ये तो बन तो अमीरों पे ही रहा है, क्योंकि कम वो लोग अमीर ही हैं, गरीबी में तो सब आ जाते हैं ना. डीमार्ट, अब मैं क्या नहीं, दो मैं कह सकता हूँ डीमार्ट भी गरीबों के लिए बना है? नहीं, गलत हो जाएगा. यदि फोकस इज कॉस्ट, बट आप अभी यही मान लो कि अमीरों के प्रोडक्ट. ठीक है, चलिए. नाउ प्लीज राइट cyclical versus defensive stock. Cyclical versus defensive stock, most important. Cyclical versus defensive stock. Cyclical versus defensive stock. Companies, those who are manufacturing essential commodities. Companies, those who are manufacturing essential commodities, are known as defensive stocks. Companies, those who are manufacturing essential commodities, are known as defensive stock. Example,
FMCG.
Hindustan Unilever Limited, comma, ITC, comma, Tata Consumer, within bracket, FMCG sector, fast moving consumable goods. During the period of COVID, entire market was bleeding in red, except for HUL. Now, this company manufactures necessities. Now, my point is, tomorrow your salary increased 10 times. You used to have 2 cups of tea, Tata, Taj Mahal. Now, my point is, once you become ultra rich, how many cups of tea you will have? और अगर कल को बहुत ही गरीब हो जाओ तब भी. That means quantity is volatile or quantity is stable. Now, right, defensive sectors have stable earnings. Underline the word, no matter what happens in the economy. Defensive sectors have stable income no matter what happens in the economy. Cyclical. Here the earnings are highly volatile. Example, Maruti Suzuki. Tata Steel, DLF. If interest rate will reduce, क्या आप ज्यादा गाड़ियां खरीदेंगे? अगर आप गाड़ी खरीदना चाहते हो तो क्या खरीद लेंगे? और इंटरेस्ट रेट बढ़ जाए तो क्या गाड़ी के डिसीजन को डिफर कर देंगे? It is dependent upon economic factors. Same wise, having a tea, using shampoo, using soap, is it dependent upon interest rates? No. But one thing is dependent upon interest rate. Buying a house, buying a car, these are known as cyclical. Cyclical means that depends upon economic factors. Am I clear? Right? When interest rates are very high, people tend to defer the decision of buying a house, buying a car, buying a house, etc. Okay. Now my last point is Pepsi, cyclical, defensive. Pepsi, cyclical, defensive. Pepsi, cyclical, defensive. कल को इंटरेस्ट रेट बहुत महंगे हो गए तभी पेप्सी पियोगे क्या? और कम हो जो पीते हैं और कम हो गए तो तभी पियोगे क्या? So it is a defensive stock. Now I want to show you one point that is very important. Now, right, defensive stocks will defeat law of demand. Now, let me show you Pepsi annual report. Now, very carefully, my focus is on Pepsi beverage North America. Price increased by, despite that, there's a volume growth of defeating the law of demand. Now, what law of demand says? As price increase, demand will fall. But this is not the case with Pepsi. It is a defensive sector. Now, they have one more product by the name Fitro Lays. All whatever you eat, Lays, Kurkure, Leher, all this come under this brand. Prices increased by 17%. How much sales has declined? Again, defeating the law of demand. These sectors are known as defensive sector. Whenever you want to put your money, when there's a panic in the market, that is going to be the defensive sectors. In defensive sectors, the probability to make huge profits will not be there. But at the same time, the probability to make huge losses will also not be there. These are known as defensive sectors. Am I clear with this? Now, try to answer question number 2. Not relative to competitors. Even for Coca-Cola, earnings are not volatile. So what should be the answer? Sensitive of earnings to the business cycle. Question number 3, Porter 5 forces. So let me recall what we run in Porter. Threat of bargaining power of, and last intensity upon amongst competition. Try to answer question number 3.
B.
What is incorrect in A? What is incorrect in C? Power of regulators. Now, what is the correct answer? Answer is B. Try to answer question number 4. Which of the following is cost leadership strategy?
B.
Now, here we promote how much quantity we want to sell. Modest to high. No, we want to sell large quantities. We don't want to sell modest to high. We want to sell large quantities. Now, right? Growth companies versus mature companies. Growth companies versus mature companies. For Bajaj Finance, market paying a P multiple of 35. Whereas HDFC is available at a P multiple of 20. Why? Because Bajaj is growing at a higher pace in comparison to competition. Bajaj is example of growth company. HDFC is example of mature company. So at times, students ask me, what are the good stocks to research upon? Yesterday, we covered Polycab, RR Cables, Apar Industries, and Havels. Today, I'm saying that if you want to research upon NBFCs, first stock that should be on your radar, that is going to be Bajaj Finance. Second stock that should be on your radar, that is Chola Mandalam. During the period of COVID, 3 years back, it was available at a price of 200. Today, it is trading in the market at a price of 1300. A growth of 7.5 in less than 3 years. Third stock, which should be in your radar, that is going to be Muthoot Finance. Muthoot Finance is available at the lowest P multiple. तो कुछ ये stocks आपके अपने mobiles पे कहीं पे भी आप अपना ऐड कर लीजिए. They should be on your radar that we have to research upon. ठीक है? Then for defensive sector, 3 stocks should be on your radar which are at a very high P multiple. Unilever, Nestle, ITC, Tata Consumer, even Britannia and Dabur. So these should be the stocks which should be in your radar. ठीक है? चलिए. Next slide. Industry classification. Industry classification can be done by private players as well as government. Private players also known as commercial providers. Commercial industry classification providers. Private players are also known as commercial industry classification providers. Okay. Now please look into my software. Did not write anything. Please. Now I want to find comparable company of JK Tyre. Okay. I want to find comparable of JK Tyre. To perform competitive analysis. Now this is known as screening. Look very carefully. This is known as screening. Now in my software, I will go to quick screener. Now I will provide certain conditions to my system, and this system will help me with the companies meeting those conditions. Now industry. Now this classification is provided by S&P 500. This is software by S&P. So industry classification is by S&P. Now I want comparable company of JK Tyre. I click on this. I type here tire. Now there's one sector, tire and rubber. I further click subsector, then motor vehicle. I further click. Now help me, which category shall I choose? It is subsector. Heavy duty, high performance, light truck, passenger car, tire tubes. अभी क्या लिखवाया था? जेके टायर 90% 80% रेवेन्यू कौन से कमाता है, तो कौन से सिलेक्ट करना चाहिए? नालायक है. Then geography, where the head office of that company should be. I want that country to be India. Then I want comparable which is listed on the stock exchange. So I want public company. Now I press upon view result. Now what system will do? The companies which are meeting all the three conditions, he will help me with the name of those companies. अब देखते हैं इनको. नहीं खोला बेइज्जती हो जाएगी, और आप भी यही चाहते हैं कि हो जाए सर की. नहीं चाहते आप. देखिए, now my point is it gives you a name of Apollo, Balkrishnan, Birla Tires, C8, Goodyear, Innovative, JK, MRF. Now my point is when we do this type of analysis, practically I'm going to reject Goodyear. Goodyear earns majority of the revenue from tractor. I'm going to reject Balkrishnan. Balkrishnan earns majority of the revenue from OTR. Rest all the companies will be comparable of JK Tyre. So how we find the comparable companies? Using this screening function, we provide some sort of filters to the system. Then those companies who are meeting the conditions, system will help us the name of those companies. Now, right? Industry classifications. Industry classification by private players. By private players. Right? Number one, Global Industry Classification Standard. Global Industry Classification Standard. The one that we covered in the class. The one that we covered in the class is an example of GICS. The one we covered in the class is an example of GICS. It is developed by, this classification is developed by S&P. This is developed by S&P. Here first software important line, select the sector, then industry group, then industries, and then sub industry. Please write. I'm going to explain what it's trying to say. First sector, industry group, industry, sub industry. Shall I proceed? Now what I'm trying to say, when I given the industry, so the industry was consumer discretionary. Now consumer discretionary is the sector. Then we have industry group. Then we have sub industry, and finally I selected the industry heavy duty. So it starts with sector. Next, right, industry classification benchmark. Industry classification benchmark. And last one is effective business classification. Last one is effective business classification. Now, एक बार लिख लीजिए. Now, I don't have any ideas of these two classifications, okay? But the one that we covered in the class, that is an example of GICS. So it first divide by sector, industry group, industry, and sub-industries. All right. These classifications are based upon product and services. Further, we provide filters for location of head office, and listing location of the company. So मैंने geography में क्या डाला था? India. And then it should be a listed company of India. These are the further filters that we provide to the system. Now, what you have to remember? Only you have to remember that there is one industry classification by GICS. It is developed by S&P. Here, first it divides by sector, industry, and then it is going to be sub-industry. This much you have to remember for exam. Then there is one more classification by the name ICB. Now you have to mug up this word. It starts with industries. So how to remember it? I for ICB, I for industry. And RBC, it is going to be start with economic factors. Now, what exactly these two are, I don't have a knowledge on this, but this is something that you have to mug up. Again, I want to repeat, GICS, it starts with sector. ICB, it starts with, and RBC, it starts with economic factors. This much you have to remember. They classify the product as per, they classify the companies as per product and service. Then we can provide the filter for head office, then we can provide the filters for, that is going to be the listing. These are the filters, and it helps us with the comparable companies. Now, right, problem with classification. Now, where shall I classify Reliance Industry? As a petrochemical, oil refinery, retail, telecom. This is a problem. How to classify ITC? It's a tobacco company, it's a FMCG company, it's a atta manufacturing company. How to classify it? It's a hotel company. Now the problem is, right, it fails to properly classify the companies in multiple line of business. Example, ITC, Reliance. Companies which are present in multiple line of business. Companies which are present in multiple line of business is known as conglomerate. Is known as conglomerate. Is known as conglomerate. Is known as conglomerate. Now, if I type here ITC, now help me with the classification. What classification it is giving? Tobacco. Same wise, if I go for Reliance, now oil and gas. This company is into petrochemicals, this company is into garments, this company is into refinery, this company is into digital services, this company is into telecom. But what prima facie it is giving me, that is going to be oil and gas. Am I clear? Chaliye, take 2 minutes, revise whatever we have covered. Then we are moving to question 1. मैं करा दूं या घर से कर लोगे? फिर अगली क्लास में कहो करा दो, 15 मिनट की बात है, जैसे मर्जी, जाना चले जाओ, करवा दे। हाँ, इसमें एक और बेटा, अब यहाँ कह रहे हो बेटा, ये oil to chemical, oil and gas, retail, digital, others. रिवाइज करिए फटाफट। नहीं बाबा, तुम्हारे पर्सनल प्रेजेंटेशन हम क्लास में कहाँ लिखते हैं? आप ये बताओ, अपनी वीडियो को कैसे ये बताओ कैसे चलाते हो उससे? मेरे भी मन में यही सवाल आ रहा था। Correct, cigarette है. But these days, ITC also earns from FMCG business. They earns, but गलत है ना, वही तो कह रहे हैं। चलिए, try to answer question number 1. Question number 1. Product and now नहीं please. एक ये भी है और ये भी है। ओके, चलिए, क्वेश्चन नंबर 1. Question number 1. Least likely. This filter we have not provided. What type of filter we can provide? Location we can provide listing, but what we cannot provide? Geographical composition of revenue. Skip question number 3rd. Answer question number 4th. अच्छा, मैं रिपीट कर देता हूं. गवर्नमेंट की रूल्स एंड रेगुलेशंस काफी ज्यादा स्ट्रिक्ट हो चुके हैं. डर नए लोगों का आने का बढ़ गया, कम हो गया. गवर्नमेंट अब बहुत स्ट्रिक्ट हो गई है, तो अब लोग नए लोग आएंगे नहीं आएंगे. सो थ्रेट ऑफ न्यू एंट्रेंट इंक्रीज डिक्रीज. डिक्रीज. अगेन नए लोग इस बिजनेस में आएंगे नहीं आएंगे. सो इट विल डिक्रीज. ना राइट. Now write question number 6 very carefully. For industry concentration, we covered HHI. For industry profitability, we cover Porter. Then pistol is based upon industry themes. Now write question number 6. Question number 6. Industry concentration. We check with the help of HHI. Industry profitability. We check with the help of Porter. And pistol is based upon external factors. External factors common to all industry players. Now what I'm trying to say, tomorrow government increase import duty on rubber, it is going to impact C8 MRF in the same manner, right within industry theme. Common to all industry players, within bracket industry theme. That means it is going to impact all the players of the industry. Question number 10th. Sensitive means volatile. क्या लूं? Question number 9th. Which of the following will be defensive stock? Defensive means where earnings are stable. Question number 8. What is the problem of differentiation strategy? Question number 7. No, right? Hint for question number 7, right? In cost leadership, we try to manufacture the product at lowest cost. Example, DMart. Majority of the stores of DMart in the center of the city, in the center of the city, in the outskirts of the city, in the outskirts of the city, and hence have lower burden of rent. I've given you more than sufficient hint. Help me with the answer. The answer is A. They are not close to the customers. They are away from the customers. Now, right? Proximity to customers. Proximity means pass. Proximity to customers is a strategy of focus. That is a part of focus strategy. That is not a part of cost leadership. Shall I proceed? Now, right. Innovation dilemma versus sustainable innovation. Shall I start? Now, our teacher decided that he is going to solve each and every question in the class. Our teacher decided that he is going to solve each and every question in the class. And he thinks that by doing so, product quality will increase significantly. This is known as sustainable innovation. This is known as sustainable innovation. If a teacher decide, ये लिखना है investors dilemma में. If a teacher decides to enter into new market, this is known as innovators dilemma. Please go through, help me with the answer. Either it is B or C. If you want to improve the product of your, if you want to improve the quality of existing product, sustainable. If you want to enter into this business, that business, then it is innovator's dilemma. So either do this or that. This is an example of dilemma. Now, right, question number 3, double star. Question number 3, double star. Question number 3, double star. Now, lower industry concentration, right? Lower industry concentration means there are more players in the market. There are more players in the market. Hence, their bargaining power will be less. Their bargaining power will be less. Full stop. However, important line. However, they still charge higher prices. Higher prices if in service sector, in a particular local area. Now, what I'm trying to say, suppose property dealers, there are not many property dealers in the market. So that means a large numbers of suppliers in the market. Now, still a property dealer can charge a higher price because he's providing a service in a particular area. Now my point is, in that particular scenario, there's still the possibility that you can charge a higher price. Now please go through question number 3 again. Service oriented. Write one more exception to that. Or supplier is providing goods with high differentiation. Example, Apple. Now my point is, there are large numbers of cell phone manufacturers in the country. Still, Apple is able to charge the premium. How come? Because on account of differentiation. Now, what is the problem in option number C? With लो की जगह क्या होना चाहिए था? तब भी आप हाई प्राइस चार्ज कर सकते हो, या फिर आप कौन से बिजनेस में तब आप हाई प्राइस चार्ज कर सकते हो? सर्विस, दैट टू इन अ पर्टिकुलर एरिया. So important word with service is service in local area, and important word with manufacturer is there should be a high product differentiation. Then also there are large numbers of players. Then also you can charge a higher price. Okay. So with this we have completed this chapter. Next Saturday, Sunday, I'm going to complete alternative investments. Okay. One chapter is left of equity, and Saturday, Sunday, my objective will be to complete AI along with that one chapter. So please watch the pre-recorded of alternative investments before coming to the class. Now, why we are doing this much of analysis? So going forward, you have to prepare the forecasted financial statements. You have to forecast what will be the profitability of Reliance Industries, and then you have to arrive at a price. What we do practically, we take into consideration the historical data. With the help of those historical data, we try to forecast the future profits. Then we discount those profit using the WACC or KE, and then we arrive at a valuation. Okay. Now, why forecasts are important? Because whatever the price we are paying today, that is for the future profit that the company is going to earn. So now in this chapter, what we will learn, how to prepare forecasted financial statements in a very simple manner. Okay. Now, right, format of income statement. So this we covered in detail in FRA. Sales minus cost of goods sold. This will give us gross profit minus selling general admin expense. Selling general admin expense. We arrive at EBITDA minus depreciation and amortization. We arrive at EBIT minus interest, EBT minus tax, EAT. So this is a simple format of a company. We start with sales minus COGS. What is the meaning of COGS? That means the direct cost to manufacture that product. Then we minus other indirect expenses. We arrive at EBITDA, then minus depreciation, then minus interest, then minus tax. This is the format for income statement. Okay. Where we are going to cover this in detail. In detail, we are going to cover in FRA. Now, right, format for balance sheet. So right along on the right hand side, format for balance sheet: equity, debt, creditor, fixed asset, debtor, cash, inventory. This is a simple format. What is the meaning of fixed asset? That is the plant and machinery. What is the meaning of debtor? The customers to whom you have sold the goods on credit. Then what is the meaning of inventory? Goods lying unsold in your warehouses. Then we have equity. That means the money that you have invested. Debt means the borrowings that you have done. And creditor means your suppliers from whom you have purchased the goods on credit. So before I proceed with the technical part, the basic meaning of all the words, am I clear? Debtor, creditor, COGS, journal admin, depreciation, basic words. Am I clear with this to all of you? Okay. Now my point is, we only make one assumption, that is the assumption of sales. Rest, all these stuffs will be relative to sales. Now, what is the meaning of this line? I only make a projection, what will be the sales of Reliance? For example, 100 rupees. Rest, each and everything will be relative to sales. For example, what will be COGS? 10% of sales. What will be fixed asset? 20% of sales. What will be working capital? 30% of sales. That means how many assumptions you have to make? Only one assumption. Rest, all the assumptions will be relative to sales. That means calculated with the help of sales. Am I clear? Now, right. How to forecast sales? How to forecast sales? How to forecast sales? To forecast the sales, there are two methods. To forecast the sales, there are two methods. Number one, top-down approach. Number two, bottom-up approach. Now, my point is, let us assume you are making sales forecast for my business. Now, my business is a coaching institute. Is it a very significant component of entire GDP? My business? No. Then what approach I will use? I directly use the approach that is bottom up. Now, bottom up means, sir, you will ask me, sir, how many students you have? What is the fees that you are collecting? Then you ask me, how many students growth you are anticipating, or how many centers you are planning to open up? What is the increase in your fees you are anticipating, sir? And you calculate the number. But now my point is, if I talk about Maruti Suzuki, or I talk about HDFC Bank, now whatever the business they are into, for example, HDFC is in the beginning, is in the banking business. Maruti is in the automobile business. Automobile or banking, contributing significantly to my GDP. Yes. And are these players a significant player of that sector? Then what type of approach we will use? That is going to be top down. Now, for example, what is the meaning of top down? Now, first we will make a forecast how much India GDP will increase. For example, India GDP will increase by 10%. Then you have to make an estimate how much banking sector will contribute. Then you will decide from that contribution, how much contribution will be from HDFC Bank. That means for blue chip companies, generally we use top-down approach. We start with the growth of India, then that particular sector, then how much this particular company will contribute. But for a small players like me, then what approach we are going to use? That is going to be bottom-up. Am I clear with the both two approaches? One is top-down, one is bottom-up. For blue chip companies, generally we prefer top-down. And for smaller companies, what type of approach we follow? That is going to be bottom-up. So, right. In top-down, we take into consideration India's GDP growth rate, comma, sectorial growth rate, India's GDP growth rate, sectorial growth rate, and how much target company will contribute in that growth. Then bottom up. We directly ask the company about the growth drivers. We directly ask the company about growth drivers. For example, we have to make estimate of sales for Vikas sir. We directly ask him how many centers he's planning to open in the future. How many centers he's planning to open in the future? How many students he's anticipating? How many students he's anticipating per center? And growth in the fees that he's charging. So this type of approach is known as bottom up. But if you're doing a sectorial analysis, GDPs, then that is known as top down. This approach is generally preferred for smaller companies or those sectors which have a very less contribution to GDP. Any idea which sector contributes the most to the GDP? That is the banking sector. Banking contributes the most to your GDP. But in US, that is going to be an IT. Okay. Shall I proceed? Chaliye. Now while forecasting, we take into consideration following documents. Number one, historical growth rate. Number two, growth rate achieved by competitors. Number one, historical growth rate. Number two, the growth rate achieved by the comparable companies. Third, independent research reports. Within bracket, we refer independent research reports. And next, management guidance. Management guidance. Now, what I'm trying to say, suppose I say that I will be teaching 10,000 students of CFA next year. Currently, I'm sitting at only 1,000 students. Is it realistic? Now, whether it is realistic or not, now what you will do some peer analysis. What my competitor companies are forecasting the growth. Then what is my current number? At what rate sector is growing? Then you find whether that is realistic or not. Then we do refer independent research report, but we are just referring. इसका मतलब ये नहीं उसने ये कहा तो मैं मान लूंगा. We are just referring what are the opinions of other independent players. Now, for example, how we do this practically. So research that I use very extensively, that is CRISIL research. Now, if I go to crisilresearch.com, and let us assume that I want to research upon tire sector. So industry, I want tire. Now they will give me a entire report that what growth the sector is anticipating. Now, for example, strong momentum in OEM. OEM means original equipment manufacturer. That means they're talking about Maruti. Strong demand from Maruti and revival in replacement. Replacement का मतलब है जो टायर आप खुद रिटेल शॉप से खरीदते हो. To help tire sector to achieve a growth of 9 to 11%. That means tire is demanded by two players. First, it is demanded by Maruti. It is known as OEM, original equipment manufacturer. Then you have a car, there's a VATO, Now you want to replace the tire. That demand is known as by retail player. Now what it is saying that keeping into the demand from OEM and replacement, we anticipate that tire sector to achieve a growth of 9 to 11%. Same wise, let us assume that I want to make with respect to crude oil or natural gas. Then natural gas prices to remain healthy at this much price. Now my point is, we refer these type of research reports. Are these paid ones? Answer is yes. Then another way to do a sectorial research, that is ICRA research. Now again, let us assume that I want to research upon tire sector. Sorry, ICRA खुल गया है. ICRA research.in. I think they have merged both the. Now let us assume that I want to research on banking sector. Now these are the banking reports. Business growth continues, near-term profitability to stabilize around the current level. Now one report is for 20,000. So these types of research reports we take into considerations. Am I clear? So this is known as top-down approach. Another one is bottom-up. Then we written one more word, that is management guidance. Now let me show you that also. Now please write Bajaj Finance EPS, earning per share 190.53 for financial year ending 31st March 2023. Is this data available in the public domain? Now what I will do, I will download their investor presentation and let me look what guidance management is giving. Now if I look into the guidance, this is investors presentation. Now what guidance they're giving for upcoming year? Now company is saying Bajaj Finance consolidated long-term guidance. Long-term guidance means they're talking about 3 years. What they're saying, our profit growth will be in the corridor of 23 to 24%. अब बजाज फाइनेंस जैसी मैनेजमेंट बहुत रिलायबल मैनेजमेंट है. whatever they promised for the last 10 years, they are able to overachieve it. Now how much they are saying that we will achieve a profit at least 23 to 24% in next 3 years. 190.53 is there. Can you extrapolate the numbers for FY 24, 25, 26? Please extrapolate using a rate 25%. Please extrapolate using a rate 25%. Please extrapolate using 23%, 25%. I want EPS for next 3 years. Now what numbers we are getting? 238, 297, 372. Now let me check what analysts are anticipating. Let me check what analysts are anticipating. Now verify the estimates by analyst. 24, they are estimating 237, 302, 379. क्या आपके भी यही numbers हैं? Now my point is how they're anticipating, that is with the help of guidance. Will we take into consideration the guidance of all the management? Answer is no. We take into consideration only the guidance of that management, which is highly reliable. Now if I talk about companies like Infosys, TCS, Bajaj Finance, HDFC Bank, ICICI Bank, these managements are the management with strong corporate governance. Whatever they are saying, yes, there is a probability they will achieve it. So we give extra weightage to this. But each and every management is trustworthy. Answer is no. Particularly if I talk about companies like DHFL, I talk about companies like PC Jewelers. These are unreliable management, so we don't give emphasis on that. But yes, guidance from a management like Bajaj Finance, that is a very reliable guidance. This is the one way to make the forecast. Am I clear with this? Am I clear with this? चलिए. Now right. अच्छा एक बार देखते हैं. Now next right COGS. Next right COGS. In COGS, majority of the cost is variable cost. In COGS, majority of the cost is variable cost. We used to forecast by comparing a ratio, by calculating a ratio, COGS upon sales for historical year. Now help me a comparable of Pepsi, Coke. So one is Pepsi, one is Coke. And let us assume that Pepsi COGS is 30%. So what will be the gross margin? 70%. Now help me, COGS of Coke in percentage terms will be higher or lower? Higher or lower? Gross profit higher or lower in comparison to Pepsi? कोक का ग्रॉस प्रॉफिट ज्यादा होगा या कम होगा इन कंपैरिजन टू पेप्सी? या बराबर होगा? क्लोज होगा. चलिए, नाउ आंसर इज इनकरेक्ट. Now, whenever we are going a peer comparison, we should analyze the competitors well in advance. Now, Pepsi, what Pepsi manufactures? Pepsi manufactures Pepsi, Mirinda, Aquafina. These are the products by Pepsi. Does it manufacture anything else? Does it manufacture anything else apart from the beverage business? Hey, Lays. Lays कौन बनाता है? Pepsi बनाती है. कुरकुरे कौन बनाता है? Pepsi बनाती है. क्या कोको कोला का भी कोई नमकीन आपने खाया है? कोको कोला का कोई चिप्स खाया है मार्केट में? लेकिन क्या पेप्सी के चिप्स आते हैं? यस, दैट इज बाय द नेम लेस. सेम वाइज दे हैव वन मोर ब्रांड, क्विकर ओट्स, दैट इज आल्सो ओन्ड बाय पेप्सी. बट ऑन द कॉन्ट्ररी, कोको कोला इज ओनली अ बेवरेज सेगमेंट प्लेयर. नाउ माय पॉइंट इज, it is only in beverages. It is in food as well as beverages. Now my point is, the company which is only in beverage, their gross profit margins will be higher or lower in comparison to a company which is in food as well. पानी वालों का ज्यादा होगा. कोको कोला को बनाने के लिए सिर्फ क्या चाहिए? पानी and sugar. But here you need raw material also. So Pepsi's profit will be less in comparison to Coca-Cola. So here we don't make a comparison at consolidated level. Here we make a comparison at division wise. We compare Pepsi beverage division with Coca-Cola, and what we find, yes, there the margins are going to be equal to each other. But consolidated level, the margins will not be equal. That means we never make comparison at aggregation. We always segregate that and then we do the comparison. Am I clear with this? Am I clear? Not right. It is always recommended. It is always recommended never to do comparison at consolidated level or comparison in totality. Comparison should be in division wise or business to business wise. Comparison should be division wise or business to business wise rather than at consolidated level. Further, Further, we should only forecast organic items or organic growth, organic items and organic growth, and ignore or take management guidance for inorganic part. अब बच्चे ने कहा सर आपने दो वर्ड यूज करे, वन इज ऑर्गेनिक, वन इज इनऑर्गेनिक. Now what I'm saying, we should forecast organic and we should ignore inorganic. Now what is the meaning of organic, inorganic? Organic, inorganic. चलिए. So what is the meaning of organic? The meaning of organic is I'm setting up new factories or number of students increase, I'm opening up new centers. This is known as organic growth. What is inorganic? Now, Byju's has acquired Akash Institute. Will their revenues will increase? Yes, their profit will increase. This is inorganic growth. Same wise, Physics Wall has acquired this company. Now, acquisitions. If you're doing acquisitions, if you're going through acquisitions, this is inorganic growth. Forecasting inorganic growth, it is not within the power of analyst. What I can forecast, maximum I can forecast the organic growth. तो आपको inorganic growth forecast नहीं करनी, or you can take the help of management to understand the inorganic growth. But what should you focus upon? That is the organic part. अब बच्चे ने कहा सर, will management gives this data? Answer is yes. Let me show you that. Now this is the annual report of Pepsi. Now if I do Control F, organic. Now help me in totality how to read this. This is Petrole, North America. What is the total growth they have reported in 22? 19%. But वो कहता है 2% is on account of inorganic. Then what is the organic growth? Organic growth is only 17%. That means the growth on account of increase in revenue or growth on account of quantity and price. This is known as organic. अब पेप्सी ने क्या कहा? मैंने कीमतें कितनी बढ़ाई हैं? सिर्फ ये ग्रोथ मेरे लिए इंपॉर्टेंट है, नॉट दी 19%. सेम वाइज इफ आई टॉक अबाउट APAC, in APAC the total growth is 4. Least concerned, I'm only concerned with growth of 11. Now how that 11 is coming? 4 on account of increase in quantity sold and 6 on account of by increasing the prices. This is known as organic. So what should we focus upon? Only the organic part. We should not focus upon the inorganic part. Same wise, let us assume that your mother used to sell ice creams. She used to boil milk. One day she forget and the milk was on the gas. And there's a wastage of milk. Organic wastage, inorganic wastage. मतलब wastage, abnormal waste. Organic मतलब recurring. Inorganic means non-recurring. Inorganic. Now my point is, shall I take that consideration of that mistake that your mother has committed? Shall I take into consideration for the future periods? No. So you should always consider the organic part. Same wise, company will say, whatever the COGS we are reporting, what is organic, what is inorganic? Let me show you that also. Again, Petrole, North America. What is the total growth they have reported? But as an analyst, we are only concerned with 17, which is on account of either increase in prices or increase in quantity sold. In APAC, what is the growth they have reported? That is the total growth I'm least concerned with. Only concerned with the growth of 11, out of which 4 on account of increase in quantity and 6 on account of increase in prices. अब ध्यान से देखते हैं, क्या इन्होंने COGS में भी कुछ ऐसा दे रखा है? In US, they use a word cost of sale. Now, What is the reported COGS? 40,576. Core, organic. What is the organic figure? That is going to be 40,290. That means we should take into consideration not the entire growth. We should take into consideration only the organic. Clear? Next, right? Selling general admin. Selling general admin generally comprises fixed cost. Example, salary. And that should grow in line with inflation. That should grow in line with inflation. Depreciation. It should be dependent upon, or it should be calculated with the help of. It should be calculated with the help of. Answer करिए. It should be calculated with the help of. Depreciation should be calculated with the help of. CapEx plan. Company is planning in the future. Interest to be dependent upon. Interest to be dependent upon. Loans you have taken. Tax to be calculated as per income tax rules in your country. Now, in India, the income tax rate is 25%. 100 rupees if you is your EBT, how much income tax you will pay? 25. 75 will be your EAT. To calculate the interest, we have to take into consideration the borrowings. To calculate the depreciation, we have to take into consideration capex. And to calculate the selling general admin, it should be grow in line with inflation. फिर से repeat करता हूँ. COGS to be in line with sales. COGS to be in line with sales. Selling general admin to be grow in line with inflation. Depreciation should be dependent upon capex. Interest to be dependent upon debt, and tax to be dependent upon the income tax laws in your country. Am I clear with all five? Now let me check what type of questions are testable. Please solve question number. Please solve question number 3rd. Acha, a question है, how we understand whether the company is growing organically, inorganically? In the books of company, you will find goodwill. If goodwill is there, that is inorganic growth. Go back home, check the books of Tech Mahindra, check the books of Byju's. They will have goodwill. That means there's a organic growth. But in the books of TCS, Infosys, you never find goodwill. That means they're growing organically. Answer करिए question number 3rd. अच्छा, देख के नहीं होगा, आपको हाथ चलाने पड़ेंगे. क्वेश्चन नंबर 3rd. आंसर क्वेश्चन नंबर 3rd. Formula for gross profit margin is gross profit upon sales. To calculate gross profit, it is sales minus COGS. Help me with answer to question number 3. आंसर करिए। What is selling price? 10. What is gross profit margin? So right. Question number 3. Scenario 1. Selling price per unit 10 rupee. What should be gross profit per unit? 6 rupee. What is my COGS? 4. Now what question is saying? For the next period, input cost expected to increase by 15%. Currently it is 40. It will increase by 15%. 40, 4 multiply by 1.15. कितना लिखूं? 4.6. The analysts expect the company to increase the selling price by 12%. Currently it is 10. Help me with gross profit. 7 कैसे आएगा? 6.6. Calculate the gross profit margin. 58.9. Earlier it was 60. It has reduced by 1.1%. What should be the answer? Answer is A. Am I clear with this? Now please, in the similar manner, solve question number 8. In the same manner, solve question number 8. Acha, let me repeat again. Answer is not C. Answer is A. Earlier margin was 60. It has been reduced to 58.9. That is a reduction of 1%. Answer question number 8. The answer? One answer is B. I'm waiting for more replies. Your operating cost will reduce by 15%. Your selling price will reduce by 5%. Your current margin is 40%. What is the forecasted margin? So I can write question number 8. Scenario 1. What is my margins currently? My currently margin is, so can I assume my selling price per unit 100, cost per unit 60, gross profit per unit 40, gross profit margin 40%. Now what happened in scenario 2? Your selling price has reduced by 5%. What is the new price? Your input cost has reduced by 15%. 60 multiplied by 0.85. What is the new gross profit? What is new gross profit margin? 46 point. So what will be the answer? Answer will be B. अब बच्चा कहता है सर आप एक चीज को बार बार इग्नोर कर रहे हो, वॉल्यूम सेल्स. Volume sales are talking about total volume that I'm selling. Here, if I was selling 100 quantity, here I'm selling 108. I will multiply by respective numbers. Will it has any impact on the ratio? Answer is no. Am I clear with both the ones? Question number 3, question number 8. Clear hai? Now please answer. Please answer. Zoom students, am I clear with both of them? Chaliye, please answer. Question number 5th. Please answer question number 5th. Which of the following is least appropriate? Till now, you're talking about Manish Malhotra, who is into tailored to made orders. Now he's entering into mass production. What is not relevant? That is going to be historical results. Now the business segment is altogether different. Answer question number 3rd. Answer question number 3rd. What is the example of top-down driver? जहां पे भी आप मार्केट शेयर की बात कर रहे हो, that means which approach you are using, that is going to be top down. Am I clear? Now my point is, when we look into Bajaj Finance, what estimates they were given? 23 to 24. Now my point is, that means whenever we give a number, that is using a range. Now, if we being optimistic, it is 24. But if you take into consideration the difficulties, then it is 23. So हम कभी भी एक number नहीं देंगे. We always give a range, that is known as scenario analysis. Keeping in mind the different scenarios, we will always give a range. Try to answer question number 4th. Now, Bajaj management is saying we have a profit growth of 23 to 24%. You arrive at a number of 24%. Now, which of the following is correct? A कह रहा है, analyst has been overly optimistic. If you are overly optimistic, then answer should be more than 24. ये तो ये कह रहा है, एनालिस्ट जो है जितनी ग्रोथ आ सकती है उससे बहुत बढ़ चढ़ के ले रहा है. तो अगर बढ़ चढ़ के ले रहे हो तो नंबर भी बढ़ चढ़ के आना चाहिए था. वो क्या कह रहे हैं, नंबर बढ़ चढ़ के आ रहा है या इन लाइन विद मैनेजमेंट गाइडेंस आ रहा है? तो फिर ओवरली एस्टिमेट कैसे आ जाएगा? व्हाट नाउ, व्हाट इज द करेक्ट आंसर? The management expectation is towards the true end, but generally management does not give a single number. They always give the range, keeping in mind the pessimistic scenarios and keeping in mind the optimistic scenarios. Now, what should be the correct answer? The answer is B. Why is incorrect? Because your number is within that range towards the upper end. Why it should be over optimistic? Overly optimistic means you're assuming a growth of 27, 29, 30%. You're not breaching that range. Your number is within that range. So A will become incorrect. Am I clear with this? Am I clear? Now, right. There are few businesses which are highly cyclical. There are few businesses which are highly cyclical. To forecast the sales of those businesses, we should take into consideration management guidance, or analyst discretion? Now my point is very simple. If I look into the P&L of Bajaj Finance, is it continuously increasing? This year was an exceptional year because of COVID. If I ignore that, is it continuously increasing? Is it continuously increasing? Is it cyclical? Answer is no. If it is cyclical, then there will be profit losses. Has the company make any sort of loss? Is it cyclical? No. Now let me talk about a company like Tata Steel. Now look into the profits. Are they cyclical? Are they volatile? 1 lakh, 15,000, 74,000, 4 lakh, 87,000, and now they're running into losses. Is it volatile? For volatile, you cannot take the average. Now, what shall I do? Either ask the management or use your discretion. Now try to answer question number 1. Now try to answer question number 1. For highly cyclical sector, we should never use the averages. Rather, we should use the discretion. आंसर करेंगे ठीक है अभी तक चलिए क्वेश्चन नंबर 1 has 2 correct answers. Question number 1, they have given 1, but there are 2 correct answers to this. Help me. Which of the following are the correct answers? B is correct. It should be based upon individual. It should not be based upon aggregation. And the correct answer is C. What is not correct? Forecast should be based upon, no. Forecast should not be based upon some third-party report. We should verify the numbers what we are anticipating with the help of third-party research reports. कहने का मतलब क्या है? क्रिस्टल ने कहा 9 से 10% की ग्रोथ होगी, अपने मॉडल में ये मत ले लेना. Do your independent research and then verify whatever the numbers you are computing, whether the crystal is also arriving at the same number or not. That means to get the number from independent sources. So A is incorrect, but yes, B and C, both of them are correct. I didn't get the logic, जो मैंने इसका आंसर पढ़ा, why they have deleted B. But if you refer at the back, then the correct answer that they have mentioned, that is option number C. But both B and C, if I look into logically, both of them are the correct answers. अब मेरे को नहीं समझ आया उन्होंने B क्यों डिलीट करा है, but what they have marked as the correct answer, that is the C, but logically both of them are correct. Now come to balance sheet part. So with this we have completed income statement. Revise for 2 minutes. Any doubt, please let me know. To forecast the sales, how many methods? 2 methods. One is top down, one is bottom up. But for cyclical business, we are not going to take the averages. We are going to use the discretion. Then we come to COGS. COGS means variable cost, computed as a percentage of sales. Then we come to selling general admin. Generally, these are going to be, should be growth in line with inflation. Then we come to depreciation, to be forecasted with the help of capex. Interest to be forecasted with the help of debt. And taxation to be calculated in line with the taxation rules in your country. Take 2 minutes, please revise. चलिए. Now, balance sheet. We have equity, debt, fixed asset, debtor, inventory, cash, and we have creditor. Help me a good name for this. Positive, negative, net working capital. Negative signifies you are the market leader. Now my point is, in maths, test 1, I scored 10 marks. And in test 2, I scored 12 marks. Which test I performed better? 2. ये था 10 marks का, ये था 1000 marks का. That means our numbers comparable. Absolute numbers are never comparable. What is comparable? That is always going to be the ratios. Now my point is, to forecast the debtor days, to forecast the debtor, I will calculate one ratio by the name debtor days. To calculate the inventory, I'm going to calculate the ratio, that is inventory days. To calculate the creditor, I'm going to calculate one ratio. Now help me, what is the formula for debtor days? Debtor upon sales into, for inventory it is inventory upon into 365, and for creditor it is going to be per creditor upon purchases into 365. Now my point is, have you already forecasted the sales figure, COGS figure, purchase figure? Already क्या forecast करके आए हो? Now my point is, if I go to a balance sheet of Hindustan Unilever, I calculate the ratios, I calculate these ratios, and help me debtor days. Is it within a range? Is it generally within a range? What is the lowest? What is the highest? Is it too narrow range? Is it too narrow range? नहीं, बहुत बड़ी रेंज है, बहुत छोटी रेंज है. अब मैंने कहा तुम्हें डेटर डेज फोरकास्ट करने हैं, तो बच्चे ने कहा 12 से लेकर 17 तक कुछ भी ले लो. किसी बच्चे ने कहा 15 डेज ले लो. अब मेरा सवाल बड़ा सिंपल है. Here you put 15. Already you forecasted the number of sales. 365 is there. Can we find out the number of debtors? Same wise, help me. Inventory days. What is the lowest number? 47. What is the highest number? Too broad range, too narrow range. Too narrow. बच्चे ने कहा मोटा माटी 50 दिन की इन्वेंट्री ले लो. Now look into the payables. What is the maximum? 140. What is the lowest? अब यहाँ पे रेंज थोड़ा वाइडर हो गया है. Then here what we will do? Either we will take the median or we can ask the management. In this manner, we are going to forecast the net working capital. But we never want the net working capital to be a higher number. We always want it to be a negative. If it is negative, that means you are a market leader. Now, same wise, let me show you Apple. What is debtor days? Debtor days. Lowest is 21, highest is 32. Inventory. Lowest is 8.8, highest is too wide range, too narrow range. Then payables. Lowest is 82, and highest is 140. Using this, we are going to forecast the numbers. Now my point is, write fixed asset. Write fixed asset. At least fixed asset should be equal to depreciation. At least fixed asset should be equal to amount of depreciation. That is, this is known as maintenance capex. This is known as maintenance capex. कहने का मतलब क्या है? जितना फिक्स एसेट आपने यूज करा है, इतना तो हम कैपेक्स मानेंगे ही मानेंगे, ताकि आप अपनी सेल्स को आगे मेंटेन कर पाओ. फॉर फर्दर कैपेक्स we calculate one ratio. For further capex, we calculate one ratio, fixed asset turnover ratio. And using this, compute capex that company can invest. Further, double start point. Further, we should always ask the management. We should always ask the management how much capex they are planning. How much capex they are planning. Now, can you name any company which upfront says how much capex they are planning in upcoming 3, 4 years, 5 years? Which is very, very on all the public forums, they disclose this number. Now, one such company is Reliance, which are very clear how much capex they're going to do in upcoming 5 years, 6 years. They come up with 5-year roadmap, 10-year roadmap. Few years back, they come up with in next 5 years, I'm going to make my company debt free. That means they're very much, they give the estimates very upfront. Another company is Balkrishnan Industries Limited. They give a 5-year roadmap. Another company is Polycap. Polycap has given a 5-year estimates. Now my point is, we ask the management how much capex they are planning. Now, write one example. Sales 100, fixed asset 20. What is fixed asset turnover ratio? 5x. What is the meaning of this? With the help of 1 rupee of fixed asset, we are able to generate a sales of 5. Now sales is 150. We assume that this ratio to remain constant. What should be fixed asset? 30. Sales कितने से बढ़ रही है? 50%. To able to meet this sales, company should invest into fixed asset 50% more. This is one way by calculating fixed asset turnover ratio. So how many ways we have? 2. First, ask the management. Another way is calculating the ratio. Whatever the ratio we have achieved in the past, we assume the ratio to remain constant. Now let me check for Apple. What is fixed asset turnover ratio? What is the lowest range? 6.6. What is the highest range? तो मोटा माटी क्या मान लूंगा, जो भी कैपेक्स आगे होगा, fixed asset turnover ratio is going to remain constant at a level of 7. We already have sales. Can we compute fixed asset? Answer is yes. And the another way is we should always ask the management how much capex they are planning. Now try to answer question number 2. We should always ask the management guidance for the capital expenditures. Clear hai? Now write. First we prepare, right? First we analyze. First we analyze historical data of compatible companies. First we analyze historical data of target company, historical data of compatible companies. We understand the guidance given by the management, and we conduct thorough sectorial analysis. Step number 2, we prepare forecasted financial statements. Step number 3, we create, right here, we create summary. Examples of summary: we calculate free cash flow to firm, free cash flow to equity. Then we report ad hoc items. Then we Then we report ad hoc items such as any legal proceedings against the company or any contingent liability. मतलब कुछ ऐसी बातें जिसका फाइनेंशियल से कोई लेना देना नहीं है, बट स्टिल हम अपने यूजर को बताना चाहते हैं. फॉर एग्जाम्पल, इफ इट इज अदानी, then Hindenburg report, I definitely give a note here that there is one report by the Hindenburg. This is known as ad hoc reports. Now try to answer question number 2. Revenue is a part of forecasted financial statements. Free cash flow is the part of summary. Contingent is a part of ad hoc report. अब देखिएगा, चलिए try to answer question number 7. Double star. Sorry, let me answer it. Question number 7. Generally for capex, we should ask the management. What question says? Management guidance is not available. Now there are 3 alternative routes. What out of 3 is correct? Okay. B is saying take the industry average capital expenditure. So this is Vikas, CFA teacher. आपको इसका करना था. Now what you ask, what is the average in industry that you should take into consideration? Now average capex is 5,000 crore, 1,000 crore, 2,000 crore. Shall I take the average of industry? Industry means the total capex by all the players, unka average. Is it a correct one? Okay. Then C, company's average capex. Now my average capex is 500, 100, 200. This is option number C. Take the average of what company has incurred historically. For example, cash flow. If I look for the Apple, capex. This is the capex by Apple. Take the average of this. This is one way. And then it is A. A saying usage of plant and machinery capacity, that is using ratios. A is correct or C is correct? Now मैंने क्या कहा था? Absolute numbers are never comparable. We should always calculate the ratios. Now if you are planning a growth of sales is 100, you are planning a growth of 50%, then capex should also increase by 50%. That means we will calculate using the ratio. What is the difference between A and C? C is saying take the average of absolute numbers. A is saying calculate the number using ratios. Which is correct, A or C? So the correct answer is clear. Hai? So with this, we have completed the forecasting chapter.